Let's begin the CA final part 2 advanced auditing GOAT notes based revision. Yes guys, I am uploading the GOAT notes revision based classes for all these chapters part 2 which you are waiting for so long. Internal audit alone chat revision. By the way, before kindly watch this introduction without a failure, then only go to the timestamp and watch. I know you're in hurry to watch the class. Just 2 minutes you wait, watch this introduction. Let me show you one Excel sheet. Okay, you just scan this particular one through your friend phone or somebody. You will be routed through this playlist. Okay, this playlist you will be routed through. Here already part 1 audit marathon uploaded. Inside this already many chapters were already uploaded. 1 minute. So what are all uploaded? Audit report is uploaded, 600 series uploaded, specialized areas that is uploaded, professional ethics is uploaded, 450 NBFC audit. Whereas now in this video that you're watching, NBFC once again I'm uploading, which is latest version. In that what you watched is a different version, but that is also GOAT notes based. In the second recently, just in August month 2025, I took this revision again. So all these are latest revision. Whereas related service review and PFI, these 3 topics I already did previously from GOAT notes day before exam. That one I'm once again merging everything at one place. I'm keeping it. Okay, that's it. So digital audit, group audit, bank audit, NBFC, internal, SDG, all these topics. You know what? 100 marks plus weightage syllabus is uploaded this time for marathon. Those of you watching for September attempt or Jan attempt or May 26, Jan 26, whatever it is, 100 plus marks weightage of marathon. I told right, you'll be routed through one playlist. Okay, what is that playlist? Once let me show you the playlist. Okay, so if you go to playlist here, so part 1, this green color, what is that? This is GOAT notes revision. Right now part 2, that is also GOAT notes revision. Whereas chart revision is also given for 12 hours. Below you see chart revision already uploaded. Apart from that, CA Inter you have some standards. Remember 200 series, that and all was given in this QR code standards. 200 series and 500 series standards. In-depth discussion will be there in the QR code standards. Chart revision from CA Inter. Getting it? So if you watch in this particular playlist 4 videos, part 1, part 2, GOAT notes, QR resources and chart revision, that's it. You are prepared for 100 marks of the paper. Trust me, the kind of clarity that you're going to get is amazing. And like here I have given which chapter what revision is given. For some chapters, no, only chart revision I gave. For some chapters, I gave entire revision. GOAT revision I gave, chart revision I gave. So like that, I have given, what chapters I have covered in either chart revision or GOAT revision or both. And only 3 topics I have not covered at all in the revision this time. Materiality concept, PSU audit, and then 7th concept, 17th one, investigation, due diligence, forensic. These 3 together occupy maximum 15 marks. Rest 100 plus marks weightage is covered. Okay, and this PDF also you can download in our website, srestforcacma.com. Just open free resources. Inside that click CA Intro. You just go to chart revision folder. Inside the chart related PDF you can download. There itself this revision video will revision related update PDF will also be downloaded. That's it. So why late? Continue watching, and most importantly, do not forget to share your valuable whatever you learned from this just as a comment, and also like and subscribe. Continue watching. That's it. Have a nice time. So let's begin the standards on related services, which is 4000 series, a simplest chapter. This is 9th chapter in your ICA book, which is a simplest chapter, and easily you can secure minimum 2 marks MCQ will be there, or a 4 or 5 marks descriptive question also might be there. Such a simplest chapter, guys. Related services, like we all know, even if you have seen, if you have observed my reporting topic, there itself I clearly told that the various services that we provide are broadly 2 types. We chartered accountants provide 2 types of broad services. One is assurance engagement, non-assurance engagement. If at all the service that we are providing does not involve any assurance or third party, in the sense there is no degree of confidence given to third party, then that services are called as related services, and for them standards on related services do apply. Standards on related services apply. Now, first of all, there are 2 standards in this particular topic. One is 4400, 4410. 2 topics were there. One is 4400. You see the 4400 standard, agreed upon procedures. Engagement, you are engaged to perform an agreed upon procedure regarding financial information. Remember guys, though they said financial information, within the standard they also told that if at all you are agreed upon, if at all you are accepting any agreed upon procedure for non-financial information also, that is also permitted. For example, a company is preparing business responsibility and sustainability report. In that particular, some information the company asked you to either compile. For example, 4410 is there. What is this 4410 is talking about? Compilation engagement, compilation of financial information, or even it can be applied for non-financial information as well, no problem at all. So 4410, agreed upon procedure for financial, compilation engagement for financial. For example, one of the example of non-financial information is business responsibility and sustainability reporting. Inside that, the many companies have to give some disclosures, some leadership disclosures, essential disclosures, something they need to give. So if at all you are assisting the company in performing certain procedures regarding those items or compiling those items, then also these standards can be applied. Fine. What is a popular agreed upon procedures that we really find? For example, a bank called you exclusively for conducting stock audit on behalf of the bank, okay, as an internal assignment. That might come under agreed upon procedure, stock audit, where you just have to go to a borrower place and then verify the physical stock and then report to the banker whatever the physical stock that you found. No assurance, nothing. You just have to perform the procedures which you agreed with the banker. That's it. Nothing much work. No assurance is given. You're not giving any opinion, all that. Now, so related services. Related services means what? These are all something which are not an assurance engagements, like tax return preparation services, consulting services, all that. So these standards on related services like agreed upon and compilation deals with. What is an agreed upon procedure? In an agreed upon procedure, auditor is engaged on a fact finding job, or a specific procedure will be performed on the subject matter, either in respect of a specific element of the financial, account of the financial, item of the financial. What is the role of the practice? No, you need not be auditor of the entity where you are providing related service. No, you need not be auditor. Remember, by the way, I can be an auditor of the company also, and I can also provide related services. Often many students have confusion. Sir, an auditor of a company cannot provide related services. So you can provide. Yeah, in professional ethics you have seen management, consultancy and other services. Many of that will come under related services only. Maybe agreed upon procedure standard might apply, might not apply. That's it. Now let's begin the first and foremost standard 4400, engagements to perform agreed upon procedures. Engagements to perform agreed upon procedures on financial information. Without first I discuss the actual standard, let me discuss let me sorry let me discuss about reporting on agreed upon procedure. Like, how do we give a report on agreed upon procedure? Generally there will be a title, just like I have showed in 800 series and 700 series. Here also there will be a title to the agreed upon procedure report. We will mention report on agreed upon procedures performed by so and so practitioner. Like that you may give a heading. If you want 4400, actually in the regular class, all that I show, all that reports, we discuss those reports in from IC illustrations, all that. But since it's a marathon, it's not possible to cover all that. I request you to once go to ICI website 4400. You can simply Google it. 4400 standard PDF you can download. You can Google it. In that standard last you will find illustration on that. So title will be there, address whoever have appointed you, and especially you need to make certain statements in the report. You need to make certain statements. What are the statements? Most important statements. You need to make a statement that procedures are not an audit, procedures performed are not a review, so no assurance is provided. Specifically in the agreed upon procedure report, you specifically have to tell this is not an audit, this is not a review, and no assurance is provided. Further, you must make a statement that if at all additional procedures like audit and review performed, it might reveal some other matters. Getting it? So in an agreed upon procedure on financial information, you don't have to obtain evidence whether the financial information is right or wrong. You don't have to obtain any evidence. Whereas even in compilation engagement also, suppose compilation means what? 4410 standard, 4410. What compilation standard says? A company specifically calls you to prepare balance sheet P&L as per schedule 3, division 1, division 2, division 3, because they don't have that many internal resources, they're not familiar with schedule 3, all that. So they called you and you went to the company and you prepared balance sheet P&L based on the trial balance given by them. You don't have to verify whether trial balance is right or wrong. Remember, you are here to assist them. You are using your financial reporting expertise and assist them in preparing the financial statements. That's it. You don't have to verify accuracy of the trial balance. However, if you came to know in the process of compilation that the information given is apparently wrong, then you should tell the management, please change it. Knowingly don't compile information based on wrong data. That doesn't mean whether the data is right or wrong, you don't have to obtain any evidence. Simple. So you need to make these statements. Further, you need to make a statement that report is purely restricted to those with whom you agreed procedure. You need to clearly make a statement that engagement is conducted as per related services. You need to clearly make a statement that procedures were agreed with the recipient, and you need to clearly mention that it's only a fact finding report, including errors, including exceptions, all that. And you should also list out what are the procedures that you exactly performed. Briefly you can list out. And finally, date of the report and place of signature and documentation. And remember, auditor must and should document which are important for evidence that an engagement was carried out as per SRS. Since it does not involve any assurance sorry, since it does not involve assurance, you can't escape saying there is no assurance involved. Why documentation? No, documentation is must. If you perform an agreed upon procedure or compilation engagement, wherever you do, whatever you do, documentation is compulsory. That's it. So this is the report of agreed upon procedure. Now, what is the ethical requirement? General principles of agreed upon procedure. What is it? Very simple. You must comply with code of ethics. Any work you accept, relevant ethical requirements you should satisfy. Remember, there is a standard SQC which says that auditor has to accept, auditor while accepting and continuing a client relationship and specific engagement, relevant ethical requirements. So in every engagement, one of the ethical requirement is what? You need to check your competence. Without knowing your competence, without you being competent, you should not accept that work. But of course, this is a non-assurance engagement, right? Independence may not be mandatory. You see here, independence may not be, just a minute, independence may not be mandatory. So an engage, however, client may request you, the person, third party who is asking, for example, he might request you to be independent also. If at all the auditor is not independent, in the report you must specifically mention the statement. And what are the fundamental principles? Integrity, objectivity, competence, due care, conduct, professional conduct, technical standards, all this. That's it. Straight away they may ask you a question on this. Straight away, a 5 marks question, straight away, or 4 marks question. And I told you, right, they will ask you a statement. Agreed upon procedure has been completed by you, and you have to give a report. There are certain statements which auditor has to give as a disclaimer or give in the agreed upon procedure report. What are those statements? 5 marks. So like this they may ask you. Finally, so what is the difference between audit and agreed upon procedure? Straight away a 4 marks question might be possible. Straight away a 4 marks question might be possible. So what is the difference between audit? Audit means opinion. Okay, it involves assurance. Whereas in agreed upon procedure, we only report factual findings. Like we do something, whatever we find, we report. We go for stock audit, we'll do physical verification. How much as per record, how much as per physical is there, whether statement filed by the borrower to the banker, quarterly stock statement, whether that stock is physically there or not. We just go find out and report it. Factual finding job. That's it. No assurance is given. Users draw their own conclusions. Agreed upon procedures are considered as non-assurance. And give examples. Compare names of major suppliers and amounts. For example, accounts payable related agreed upon procedure. Like you need to compare supplier's name and trial balance, get a confirmation from them, compare amounts in the trial balance, report actual findings, do reconciliation. That's it. This is an example with respect to trade payables. That's it. So in exam they'll ask you this itself, straight away a 4 marks question. Very simple. Then what is the objective of the auditor in this? Very simple. The auditor does not provide any assurance. User assess the procedures and findings to draw their own conclusions. Auditor will do some procedures and he'll just give findings. Restricted. This is restricted to those who agree to the procedures. Others and all may misinterpret. Whenever the report is restricted, you should clearly tell that this is not useful for others. This is only for the recipient purpose. That's it. Like just 1 or 2 more. Terms of engagement. Obviously, just like audit, just like review, just like any other engagement, we must establish terms of engagement in order to avoid confusion. Auditor has to ensure that the representative of the client understand the agreed upon procedures and conditions of the engagement. An engagement letter is important to avoid misunderstanding, where you need to clearly set objective, scope, auditor responsibilities. By the way, in this standard, just because the word auditor is used, that doesn't mean audit. We are basically referred as what? Auditors. practitioners, professional accountants, we are basically referred as such, so no problem at all. And what are the, engagement letter should clearly include what are the list of procedures that we agreed upon, and a statement that description of the report will be restricted only to agreed parties. In the engagement letter itself, I should tell management, you should not give this report to outsiders. That's why you see agreed upon procedure report will below big bold capital letters confidential, that wordings will be there. And next, matters to be agreed. What is the nature of the engagement? For example, stock audit. Purpose of the engagement to verify whether borrower filed statements, borrower stock statements are matching or not. Identification of the financial information to which inventory in hand, inventory in go down. For example, what are the specific procedures? Auditor has to physically visit and do all that. Limitations and distributions. The auditor cannot verify third party premises. Suppose the company has a inventory with third party, okay, so that's one of the limitation when verifying physical inventory. If limitation is if at all the limitation is something like legally conflicting, do not accept the engagement. And finally, plan and perform the procedure. Obviously, any engagement that we perform, if it has to be effective, it has to be planned. You should plan the work. Execution planning, we call this as what, execution planning. Only then your engagement will be effective. So what are the procedures that we do in audit? What procedures we do? Inquiry, inspection, observation, confirmation, recalculation, reperformance, analytical. Same here also. Inquiry, recommendation, observation, inspection, obtaining confirmations. That's it. The auditor shall carry out agreed upon procedures and use the evidence to obtain a report of factual findings. Over the standard. That's it. 4400, hardly 13 minutes. I hope you understood. Getting it? So look at objective. What is the difference between audit and agreed upon? What are the general principles, ethical requirements, independence regarding terms of engagement? And then they discussed about matters to be agreed. Straight away, this itself can be asked as a 3 marks or 4 marks question. And finally, planning and performing the procedures. Agreed upon procedures must be planned so that an effective work can be done. And you can perform the following procedures, which includes finally reporting. So identification of the information, financial or non-financial. I told you, even though the standard heading is financial information, you can also perform agreed upon on non-financial information. Inventory audit is a non-financial. Best example. That's it. 4400 is completed. Now let's discuss about 4410, compilation engagement. Compilation means what? Preparing. Exactly, in the context of related services, what is compilation? Compilation of financial information as per applicable financial reporting framework, which may be general purpose framework, which may be special purpose framework. A company has to prepare financial statements which may be a special purpose or which may be special general purpose. They want to prepare restated financials, or they may want to prepare summary financials, or they may want to prepare single financial. Whatever it is, they want to prepare, but they are not competent, so they approached you because you are competent, right? So they approached you. So now they are asking you, sir, can you please help us to prepare financial statements, because you are a financial reporting expertise. No, they don't know that you only studied important questions. It's okay, I'm just joking. Okay, fine. So they are thinking that you are an expert in financial reporting, so they're asking your assistance. So that's a compilation. I'm sorry. What is a compilation engagement? Practitioner uses his accounting expertise, financial reporting expertise to aid, nothing but to assist management in preparing, presenting financial information and issuing a report. You better use the word assist. Okay, and management generally may ask professional accountant to assist preparation and presentation of financials. Remember, you are only assisting them in preparing financials as per schedule 3. This is not an assurance engagement. You do not verify accuracy and completeness of the information given to you so that you prepare. So they gave a trial balance. You don't have to check whether it is true and fair or not, whether the information is correct. That is not your business. They gave you trial balance, compile balance sheet and P&L as per schedule 3 format and give them back. That's it. Then what is the purpose generally? Why compilation engagement? Clients may approach you because they have to prepare annually the financial statements, mandatory periodical reporting, or internal purpose, or for transactional purpose, some special purpose financials they need to prepare, and they did not find any auditor, so they found you, and external reporting purpose. For these purposes, generally compilation of financial statements will be done and the management will approach you. And remember, most important SQC is obviously applicable. Since 4410 is also an engagement as per engagement and quality control framework, SQC will obviously apply. So here it applies to compilation of historical financial information, compilation engagement for non-historical as well as non-financial information can also be performed. This standard can be used with necessary adaptation. For example, a business responsibility sustainability report. A company is preparing business responsibility sustainability report. They are not that much familiar with what are exactly how to prepare that. You know it very well, so you can assist them in preparing business responsibility. That is not a financial statement, that is not a historical financial information, that is not a financial information at all. Okay, still this standard can be applied there, the principles of the standard can be applied there. And next no, before I discuss all this, first let me talk about the report. Always first we will see the report. You know, reporting requirement is most important. If you understand reporting requirement correctly, remaining content is dead easy. Title, addressee, which is based on the terms of engagement, and you must provide a statement that practitioner has compiled financial information, balance sheet, P&L based on information provided by the management. You must clearly mention this statement, and you must clearly mention a description of what are responsibilities in a compilation. What is the responsibility? They need to give you the data, they need to give you reliable, correct, accurate, complete data. That is their responsibility. And explanation that since it is not an assurance engagement, we are not required to verify accuracy and completeness. This is most important. You know, this is called as caveats. These are called as what? Caveats. What are the important caveats which auditor has to mention in a compilation report? You need to mention the most important caveat. Since this is not an assurance engagement, auditor is not required to verify accuracy and completeness of information, and practitioner does not express any opinion or a review. We don't either audit, we neither audit nor review. We clearly mention that. Further, if at all you are doing a compilation of special purpose financials, you should also clearly describe the purpose and who are the users for whose purpose this compilation report is given, and alert to the readers that financial information may not be suitable for others. For alert to know, you can use always emphasis of matter paragraph for alerting the users. And practitioner report, practitioner signature, and of course you will clearly mention what are your responsibilities, and you will also state that engagement was performed as per SRS. You know, they may ask you a straight question. Practitioner's report is final outcome of a compilation engagement. What are the few important caveats or important statements which a practitioner has to make in a compilation report? They may ask you this. Getting it? They may ask you this. So the statement that you have compiled financial information based on management provided data, a statement about management responsibilities, identification of the framework applicable, if at all a special purpose framework reference shall be given, identification of financial title, all that, and description of their description of your responsibilities, and a statement that you have complied with SRS, and explanation that this is not an assurance, it does not involve audit, does not involve review, so we don't have to verify accuracy of the information. But remember, most important point many students which they don't understand is propose amendments. Here a 3 marks or 4 marks question, they may ask you in exam straight away. You see, in our book it is performing the compilation engagement. Okay, fine, you understood what is compilation, you understood how to give a report on compilation. How to perform this engagement? Very simple. First understand the matter, which financial statements they're asking me. Understand, look at the entity business, look at the accounting system and records, look at the financial reporting framework. Is it a general purpose or special purpose? So understand the context, then only you can assist the management in the right way, then only you can tell what is the right accounting policy, then only you can tell them what is the right accounting estimate, all that. So without understanding business and all, you can't do a compilation engagement. Now compile the information. How to compile the financial information? 4 marks question they may ask you. Compile information using records, documents, explanations provided by management. Any significant judgments, assumptions, accounting estimates were there? No. Discuss with management and top management. Review compiled information in light of entities, business and applicable framework. Whatever you compile, no, just cross check with the business analytical procedure you apply. Report any incomplete, any inaccurate, any unsatisfactory information to management and request for correction. If at all you identify something incomplete, report any incomplete, inaccurate, unsatisfactory. Suppose if at all you found something incomplete, you found something inaccurate, you found something unsatisfactory, report it to the management. Withdraw if management fails to provide necessary information. And you know what, in the following 3 cases you must recommend amendments. What are they? Financial information, no. That statements which you prepared, no, that does not contain applicable financial reporting framework reference, tell them to amend it. Amendments are needed to prevent MMS. Indirectly, what does it mean? If at all you are aware of any material misstatement in the compiled information, tell the management to propose. or compiled information is misleading. See, you don't have to get evidence on whether it is right or not, but if you know something is wrong, tell the management to amend it, so they may test you as an MCQ. An auditor who has found a mistake in the financial information compiled by him, there is a material misstatement he found, he communicated to the management replied that since you are not giving assurance, it is not your duty. Wrong. Auditor has to propose. Suppose no management refusing to amend, it's a very big mistake is there, but they're not they're refusing. If withdrawal is not possible, see whether you have to report to any legal authority. Generally withdraw. If withdrawal is not possible, you just withdraw if management refuses to amendment. If withdrawal is not possible, see whether you can communicate to any legal and professional bodies, regulatory authorities. And finally, get an acknowledgement from management that they take responsibility for final version. They will not use your name because you are not responsible party for the financials. You only assisted them. Ultimately, for the compiled information, who is ultimately responsible? Management only. They only have to approve the financials. You only assisted them. Yeah, you are not responsible party for preparation of financial statements. And communicate with management any important significant matters that arise during the engagement. Compilation, performing compilation, a 5 marks question might come. Any of this can be tested. And finally, next, ethical requirements. Obviously all the irrelevant ethical requirements is compulsory, but independence, since it's a non-assurance, independence requirement may not be compulsory. However, law, regulation, terms of engagement may impose independence requirement. Further, can you how to accept this work and then continue this work? You can agree on terms with the management and engaging party, if at all management is not the engaging party, and you must know intended use, where this information is going to be used, to whom this information is going to be distributed, what are the restrictions on me while compiling this information. You must know all this. What is the purpose of the information, what framework, also identify what framework they're following, applicable financial reporting framework. Also, what is the objective and scope of engagement, what you need to do, get an acknowledgement, what are your responsibilities, what are management is responsible for information, yes or no, to prepare financials as per acceptable. They are responsible for maintaining internal controls, they are responsible for accuracy and completeness of records, they are responsible for judgments that are required. They may ask you 4 marks question, what are management responsibilities in a compilation engagement, a 3 marks or 4 marks question. You just have to write these points. And finally, what is the expected form of report. These are all contents of engagement letter. These are all nothing but what? Contents of engagement letter. And finally, all these terms, you must record it in an engagement letter which is prior to starting the work. That's it. Major standard is over, almost over. So scope of the standard, remember, management retains full responsibility for financial information, including in applying judgment, selecting accounting policies. They are ultimately responsible. You cannot blame. See, just because you assisted in preparation, tomorrow if something is wrong, they can't blame you. Management is only ultimately and solely responsible for the compiled information. And remember, different financial reportings may be used, yes or no, for compiling. So that's why you need to understand why this financial information is used, all that. And that's it. In some cases, no, management would have already prepared a draft financials where you just have to set right it properly. That's it. So then, what is the objective? The practitioner, you and me, we are practitioners, have to apply accounting and financial reporting expertise to assist management in preparing and presenting financial information as per applicable framework. The practitioner's report must be issued in accordance with SRS. That's it. Over. Compilation engagement, hardly related services is over within half an hour. And now I just want to talk some important issue. I just want to talk about an important issue. Many are feeling anxiety. Many are feeling with they're having the problem of stress, stress and anxiety. So, like, what is this stress and anxiety is all about? I know we are in the last month of the exam. Definitely some of you might be feel very stressful and anxiety. Okay, there is a difference between pressure. Right now I am in huge pressure, work pressure. Morning I'm having almost 5 hours of class, fast track CA final batch. Okay, CA final batch, Google Drive, on all that is there. Okay, evening again I'm doing marathon like this in live. And of course maybe tomorrow you're watching a merged version of this, but I'm just telling, almost 7 hours. This is a work pressure. In the next 10 days what I have, I'm already in the April 1st week. In the next 15 days I have to deliver close to 120 hours of content, close to in the next 15-20 days. That's the content which I have to deliver. Imagine the kind of pressure that I have. But I'm not stressful about this. I'm not having anxiety on this. The only reason I am working on it without wasting my time, without thinking about when this will happen, when that will happen. Ayo, I'm not wasting. I am utilizing whenever time is there, whenever energy is there. I am not worrying. I am only finishing my works. You feel stressful only when you are postponing the things or accumulating your pending work. Anxiety is also only because of the stress. The anxiety, the stress, all that comes by not performing your duties. If you're daily, if you're studying, if you're studying daily correctly on time, you don't feel stressful. You will not feel stressful at all. Maybe you may have voluminous syllabus. For example, you're a CA final student or CA inter student. So you're planning for May 25 exams, for example. The exams are hardly 1 month away. Just 1 month also not left, for example. Okay. You are feeling extremely stressful and you're only thinking about how will I write exam, should I skip this attempt, should I go for next attempt? No, first time is there. You have 250 hours of time is there even now. I'm doing this on April 3rd 2025, this video right now. Okay, you still have 250 hours of time, 250 hours of time in your hand. 250 hours, it's not something small. You feel stressful because you're only thinking and not working. What is most important in order to come out of stress? Forget about the result, whether you will successful or unsuccessful. Forget about the result. Why are you thinking about result? May 2nd, May 3rd, my exam starts. Or if you're planning for group 2, May 7th or 8th, your exam starts. How should I beat this? Within this time, how should I beat this? Forget whether result will be favorable or not. Fight until you win. Fight with your 100% energy. Fight with your 100% efficiency. Try to hit the target. Your only target is try to hit. Often I throw challenges with my colleagues, with my all of them. Some of them will obviously beat my colleagues or beat my friends. Some of them will doubt me. Will it happen? Will it happen? I boldly them. Yes, it will happen. I will make it. They don't trust. Some of them trust, some of them don't trust, some of them think Harsha is overconfident. Let it be. I am working. I know it will certainly happen. At least, if not 100 out of 100, at least I can achieve 90. For that I'm working. Challenge yourself. Throw challenges to yourself. One of your friend is coming and saying you, 25 days only, nothing can be done. It's okay. Accept the challenge. Challenge him. I will show and prove it to you. I will study the hardest and show you within this 1 month. I will try my level best and clear the attempt. Show him. Throw a challenge. Accept the challenge. Your mind works different if you accept a challenge. Believe me, guys. You have really good amount of time. The only thing is you just have to study. Stop worrying. Start working. Stress is a byproduct of worry. Worry is a byproduct of not working. The more you think about, though so much pending syllabus is there, whether I will cover it or not, whether I will qualify this exam or not, all your problems, forget about that, man. Why are you thinking all that? Just start studying immediately. Forget about the result. Forget about the syllabus pending. Straight away, daily. Let me be like a super rock solid. 12 hours you study. Make yourself. You know what? I'm taking almost in a day 6 to 7 hours. That to a fast track batch and almost a marathon. Okay, which is equal to 25 to 30 hours of corporate job. 25 to 30 hours of corporate job. That much energy is required for 7 hours of class. That to a subject like auditing where I have to continuously talk. Imagine the energy. That too, how energetic I talk. So stop excuses. It is you who is claiming excuses. You don't have any right to claim excuses. All that you really did so much. You really did so much. Okay, I don't know whether you did in the past so much or not, but if at all you already been halfway through this 1 month, become like a monk, work like a monk. Next 24 days, challenge, you have to clear the exam. Okay, the only people who feel always stressful is the one who only think, they don't act. Only these people are highly stressful. Those who act more and think less, they never get stressed. Right now I'm not stressful, but I'm having lots of work pressure that I can handle. It's okay, I can handle. I have work pressure, so much work pressure is there, so much work is there. I'm pressurized, actually, technically speaking, but I'm not stressful at all. I'm not having guilt. I'm not having, worry. I only think about, I should complete work faster, I should take a break. That's what I think. I don't have a guilt. If you plan something tomorrow, a schedule, you didn't work on it, guilt will start. Your guilt is accumulated a lot today. Today you're feeling so much stressful because your guilt is so much in your mind. The only way that you can come out of guilt is start working. Start working immediately. You will come out of guilt very quickly. That's it. Okay. All the very best. Go well. Do well. Go ahead. Yeah. So, review of financial information. There is a beautiful chart book which I have. A minute, please. I think, yes, I think it's perfect now. Just a minute. Yes, perfect it is. So, actually, I have developed one chart book also. The work is still going on. So that is the reason I decided not to use this. Almost it is a 10 pages chart notes for review. But anyhow, this itself is already, this goat notes, that's something which I already made, is already a very refined version. This itself is a fantastic notes. Okay, so directly we'll discuss from this itself. Now I am going to cover only key concepts. But before that, let me discuss exceptional questions in review chapter. In ICA book, there are test your understanding questions, right? 1, 3, 4. In TYU, 1, 3, 4. These 3 questions are something different. Like what exactly the different? You see here. Here, there is a company which is which has entered into contract with another company. In that note, there is a condition where this company, Roma, the original company, required to get the financial statements reviewed for a year on a quarterly basis in accordance with financial reporting provisions of a contract. Oh, here the financial statements have to be reviewed as per financial, which are prepared as per financial reporting provisions of a contract. Here the financial statements are prepared using special purpose framework, and those financial statements has to be reviewed. Generally, when you see this particular question, immediately many students, what they write, SEA 800 answer also they will write. But look at, they are asking about review. Can the company get its financials reviewed from a professional accountant in practice? Absolutely yes. As per SRU 2400, the professional accountant in practice can accept that an engagement. See, what is 2400 talks about mainly? 2400 talks about engagement to review. Engagement to review historical financial information. If it is historical, that's enough. This may be general purpose financials or this may be special purpose financials, doesn't matter. So these can be reviewed. Next, so that's it. Then there is another question, test your understanding 3, which is also bit exceptional, bit different. Here the company machinery and inventories of plant were uninsured, and what happened, there is a massive major fire accident in company and plant and machinery, all that they resulted in massive disruption in the operations. Machinery and plant were not insured at all, leading to substantial losses. The company has disclosed it in interim financial information appropriately. Going concern issue, they disclosed appropriately in the interim financial. The moment it is interim financial information, you should recollect the standard called 2410. If you recollect, SEA 570, SEA 570 is applicable in the context of audit of general purpose financial statements. There, if a material uncertainty related to going concern is there and that is disclosed appropriately in the financial statements, we give unqualified opinion, and in material uncertainty related to going concern, side heading will be there, right? There we draw attention to that point. But 2410 in the standard, this standard is updated long back before 2017. It is not updated. Earlier, no, going concern material uncertainty we have to highlight, right? Because see, going concern, company going concern is uncertain. They honestly disclosed, yeah. You can't give any modified conclusion there. Getting it? In a review, we don't call it as opinion, we call it as conclusion. So you can't give a modified conclusion there. So it's an unmodified conclusion because it's clearly honestly disclosed. So unqualified conclusion on going concern only you can give. But going concern point, something severely they disclosed. Where you will highlight that in emphasis of matter paragraph. You must highlight that going concern issue in emphasis. Remember, this point is not correct in case of audit engagement. In audit report, no. Going concern issue we will highlight in material uncertainty, MURGC, material uncertainty related to going concern para. Whereas in review, material uncertainty related to going concern is highlighted in emphasis of matter paragraph. I already told in 3000 series, 3000 series, 2000 series, the practitioner auditor's report format is different. The auditor's report format is different. So again in 2410, this review of interim financial information is performed by whom? Actually independent auditor of the company only will be giving a report on interim financial information. So emphasis of matter paragraph is the para where you need to highlight this particular point. So that's the reason this is exceptional. Then there is another question. What is this another question? You know, she believes that necessary to make some adjustments to quarterly financial information. The auditor feels that some adjustments are required. She has communicated the matter to CFO and audit committee. Adjustments, what are all adjustments required in financial information? She communicated. No response was received even after waiting for reasonable time. So we communicated what are the modifications required in financial information, interim information, but they're not responding. What options are available to her? You see how the question was given. What options are available? 1. Modify the report. 2. Withdraw from the engagement. See the possibility of resigning from the appointment. It's possible to resigning. So withdraw from the engagement and also withdraw from annual audit requirement also. That's it. These are the options available as per SRU 2410. That's it. These are the 3 exceptional different questions in review. That's it. Now let's begin the actual discussion. We all know review and audit. Review is a limited assurance engagement, whereas so in a review it's a limited assurance, in audit it's a reasonable assurance. In audit, no, we perform extensive procedures, test of control, substantive, inquiry, analytical, inspection, external confirmation, physical verification, recalculation, reperformance, so many we will perform. Whereas in review we perform few procedures, either inquiry and analytical. Only 2 procedures we will perform in review, inquiry and analytical. So review involves few procedures. Few procedures means what? Inquiry, analytical. Whereas in audit we perform so many procedures. So many procedures means what? Apart from inquiry, analytical, what else is there? Inspection is there, observation is there, physical verification, recalculation, reperformance, ledger review, so many were there. Whereas in review we perform only few procedures, inquiry, analytical, that's it. And in an audit we give opinion, whereas in review the thing that we express is called as conclusion. In an audit we call it as unqualified opinion, qualified opinion, adverse opinion, disclaimer of opinion. Whereas in review, unqualified conclusion, qualified conclusion, adverse conclusion, disclaimer of conclusion. We use the word conclusion in a review. In an audit the opinion we give in a positive wording, whereas in review negative wording. In audit, no, in our opinion, to the best of our information, according to the explanation given to us, the aforesaid financial statements are showing true and fair view. Whereas in review, nothing has come to our attention that causes us to believe that the financial statements are not free from material misstatement. Like that we will give. Be careful. Now first one, 2410. Generally any organization can get their historical financial information be reviewed by a chartered accountant. So if at all you are appointed to review historical financial information, not interim. If it is interim, 2410 applicable. Normal annual historical financial information you are requested for review, then 2400 standard is applicable. So as per that, I am directly discussing the actual point. Compliance with ethical requirements. I am only discussing exam oriented stuff directly. Here, no, you must comply with relevant ethical requirements including independence. Remember, in related services I told independence is not a requirement in related services, whereas in assurance engagement 3000 series, 2000 series, 700 series, 800 series, independence is most important. And engagement partner is responsible for overall quality. Remember, standard on quality control is applicable even for review engagements as well. Standard on quality control is applicable for audit, special purpose financial statements audit, review, assurance engagements, and even for related services SQC is applicable. That's why you see SQC heading. Quality control for firms performing audit, review, assurance and related services, SQC heading. So SQC is applicable for everything. Then Most important, factors affecting acceptance and continuation of client relationship. Suppose if a client is approaching you for conducting a review, what points you will consider when you're accepting this client? Generally, you should not accept in the following cases, like there is no rationale. The client is asking financial statements to be reviewed. I asked him, sir, what is the purpose, sir? He don't know anything, sir, just casually, sir. There is no rationale behind the review. There is no user. Not satisfied, there is a rational purpose for the review. Getting it? Or if the law or regulation requires an audit, then review is not appropriate. For that client, no, he said, sir, I am a company, sir, registered under Companies Act, sir. As per Companies Act, no auditor signature is required, sir. That is the reason we are coming to you. Please review. Sir, no. As per the law, audit is required, not review. So there I will not accept. And or second scenario, there is no rationale for review, or review is not the right engagement there. Review engagement is not suitable for the given circumstance. In that case, no, I will tell the client, please sir, this is not suitable. Some other work is suitable, I will tell him. Then further, another scenario. So no rationale, I will not accept the review. Review is not appropriate, I will not accept the review engagement. Third one, non-compliance. The practitioner believes ethical requirements, in 2400, instead of using the word auditor, they use the word practitioner, whereas in 2410, auditor word is used. Be careful. See, even if you are using interchangeably, not an issue. I don't think examiner has that much ability. Okay, fine, it's okay. Next, non-availability. Suppose necessary information to perform review is not available with the client. So client is not giving you proper information. That time also you need to check integrity of the client. In SQC, you will be discussing acceptance and continuation of client relationship. You will be gathering some data. That time itself you got to know that client will not give you information. Don't accept it. Or doubts about integrity of the management. Don't accept the engagement. Limitation on the scope. If at all those charged with governance is imposing a limitation on the scope, do not accept the engagement. That's it. So indirectly, what are the preconditions for accepting a review? Determine whether financial reporting framework used for preparing financial statements is acceptable. Check out. Understand the purpose of the review. Who are the users? Understand. If there is no rationale or review is not appropriate, don't accept it. That's what we have seen. The same point is once again conveyed to you. Further, you will accept an audit preconditions for review. Before you start the review, first agree management responsibilities. What are the management responsibilities? They are responsible for preparing financial statements as per applicable framework. They have to establish internal controls to make sure financials are free from MMS. They have to provide me, the practitioner, information, additional information, unrestricted access to people inside that company. I can talk to anybody. Next, practitioner satisfaction. Suppose if I am not satisfied with preconditions, I will discuss the matter with the top management. I will tell them, sir, I need all that in data. Suppose if issues cannot be resolved, don't accept the engagement. Yes or no? If at all you are accepting because there is a compulsion in law, then don't mention about SRU 2400, because you are doing review as per the law, not as per SRU 2400. That's it. Suppose no, you accepted the review. After accepting, some issues arises. If preconditions do not present after accepting the review engagement, discuss the issue with the top management, see whether issue can be resolved, and determine whether you will continue or withdraw from the engagement. In exam, this itself can be asked as a 3 marks question, or preconditions itself can be asked as a 5 marks question. Factors affecting acceptance and client relationship itself can be asked as a 5 marks question. Remember, factors affecting rationale, not appropriate, non-compliance with ethical requirements, non-availability, integrity. These are the acceptance and continuation point. Whereas preconditions for accepting, see applicable financial reporting framework, management responsibilities, practitioner satisfaction, decision, post acceptance issue. This is something similar to CA Inter 210. Preconditions to audit in 210 standard you might have seen in CA Inter, right? Regarding that. Then, okay, preconditions, everything is done. Establish engagement letter, give engagement letter, agreeing to the terms of engagement. What is agreeing to terms of engagement? Prior to performance, no, must agree on the terms of engagement with management and top management before starting the engagement. The agreed terms must be in a written letter, like engagement letter. And for recurring audits, no, you should check whether engagement letter is required in case of a recurring review. Actually, it's not a recurring audit, recurring review. Further, in this book, no, at many places I have used the word SAAE, sufficient appropriate audit evidence. Actually, audit word is not required. Sufficient appropriate evidence is the right wording. Sufficient appropriate evidence. In MCQ, they might test this point also. So the reviewer shall obtain sufficient appropriate evidence. That's the right wording. Sufficient appropriate audit evidence is wrong. Be careful. Okay, next. Suppose after you accept the engagement, management is requesting to change certain terms. If there is a reasonable justification, the practitioner must not agree to a change unless there is a reasonable justification. Changes in engagement. Suppose if management is asking to change engagement to one with no assurance, like they're asking you to reduce less than limited assurance itself is a lower level of assurance. Anything below lower means no assurance. Practitioner evaluate whether it's justified or not. If at all you agreed and revise the terms and conditions of the management, then record the new engagement terms in a new engagement letter. Then now once you accepted the review, now you need to perform. While you are performing, determine materiality, yes or no. So determine materiality and apply that when you are designing and applying audit procedures. The judgment of materiality is generally same regardless of level of assurance, whether it's a reasonable assurance or limited assurance, that doesn't matter. You can happily apply SA 320 logic. Determining materiality, performance materiality, overall materiality, the logic is mostly same. And practitioner will revise the materiality whenever new information arises. Further, get an understanding. Practitioners gains an understanding of the entity and its environment and identify potential areas where material misstatement. So when you're performing the audit, first decide materiality, get an understanding, design and perform procedures. What procedures we will perform? We will perform inquiry analytical procedures. In a review, we perform limited procedures, fewer procedures, nothing but inquiry and analytical procedure. What are inquiry and analytical? First one, gather sufficient evidence for forming a conclusion. You need to give a conclusion. For that, you need a sufficient evidence. For that, you perform inquiry analytical, where you will cover all material items of financials. You focus on areas where misstatements likely to arise. What are the areas misstatements likely to arise? In risk assessment, you will understand. Then procedures should be designed to meet objectives of the engagement. Further, sir, inquiry analytical, only these two should be performed. No, he may also perform other procedures like inspection, observation, recalculation, if at all they are effective or necessary in the engagement. So now tell me, in a review, you perform primarily inquiry analytical. You generally don't perform other procedures. Sometimes you perform other procedures. Just because you are performing other procedures also, additional procedures also, does it change the objective of the engagement that which you have accepted? No. Performing other procedure does not change the objective. Still you need to get limited assurance only. You should give limited assurance only. Now practitioner may review accounting records also to identify unusual transaction. This is called inspection. Just because you are doing inspection, it is not again called as audit. It is still review only. Then what is inquiry? Inquiry means what? Asking information from management, accounting estimates, related parties, unusual transactions, frauds, subsequent events, going concern, all that. Yes or no? Sometimes we also inquire non-financial information like what are the decisions taken at the meeting, communications received by the company from regulatory bodies, matters arising during other audit procedures. And whenever you are getting response, look at the reasonableness and consistency of the response. Sometimes in exam they'll ask you, in a review, inquiries consist of only financial information. No, wrong. Inquiry can also non-financial information. This itself can be asked as a 3 marks question. Be careful. Not only this, auditor will also perform what? Analytical procedure. So get the data from the company accounting system and perform analytical procedure. Analytical, what happens? We logically see whether the numbers are logical or not. Is there a relationship between the numbers and cash flow? All that. Why inquiry? Why analytical is important? This is asked once in 4 marks question. Once they have asked regarding inquiry for 4 marks question. Only 2 attempts were happened after this standards were made applicable in CA final, May 24, November 24. Only 2 exam papers were there. Okay, so this was asked in one of the attempt. Why inquiry is important? Inquiry, generally through inquiry we will get evidence about management's intentions. For intentions, especially if you want to know intention of the company, intention of the management, inquiry is the principal source of evidence. Yes or no? Generally information on management intention is limited. In that case, past history I will see whether whatever intentions they told last time in the previous years, whether they fulfilled or not. What course of actions do they have ability to satisfy the intention they have? That's it. And skepticism is essential. Inquiry will help the practitioner's understanding to update. As a practitioner, I can update understanding of the company, all this only through inquiry. Inquiry is nothing but talking to the people here. Tell me, without talking to the client, without talking to management, can you do audit? Can you do review? It's impossible. So inquiry is the principal source of evidence. Then what is analytical? analytical procedures will help you to update understanding of the entity. It helps identify inconsistencies, risky areas and all you can identify only through analytical procedure. It will give you supporting evidence for inquiry and analytical. It serves as an additional procedure if you suspect any misstatement. Various methods can be used, like a simple analytical to complex statistical. Getting it? That's it. And there are some specific circumstances that you need to address in in a review. In this not all the specific circumstance, any 3 points: related party, going concern, like that. Related party, auditor has to alert for information that may indicate related party relation not identified by the management. Be careful, company would have not identified some related party relationships and transactions. Be careful about those transactions. If significant, also the auditor, if transactions are there outside normal course of business is identified, inquire with management about nature of this transaction and what is the rationale. If some transactions with related parties are not in ordinary course of business, why they were not in ordinary course, what is the rationale, inquire that. So this they may ask you specifically. In a review, the auditor has to focus on some specific circumstances. They are related parties and going concern. What are the points auditor has to look into? 2.5 mark, 2.5 mark, like 2.5 marks, 5 marks question they can ask, or 3 and 3, 6 marks question they can ask, like this. Okay, now going concern. During the review, assess ability of the company, ability of the entity to continue as a going concern. Inquire with management whether do they have any plans and are they feasible or not. Evaluate management response, whether see that the financials are prepared on going concern basis or not. Consider management response, all that. Further, fraud. If there is any indications of fraud or non-compliance, communicate this to appropriate level of management. And practitioner must consider how management assessment of fraud affect conclusions on the financials and need to report it externally. See, if any fraud and non-compliance is there, check, identify nuclear. Okay, check whether do you have any responsibility to report the fraud identified, non-compliance identified to any third party. Then that's it. Only these 3 points are important, only these 3 points are important in specific circumstances. Suppose financials are materially misstated, what extra you have to do? If practitioners believes that financial statements are materially misstated, conclude that matter is not likely to cause a material misstatement. Determine whether it is causing material. Suppose you are believing that financials may be material, you are suspecting a material misstatement, then what you have to do? Perform additional work. 2 conclusions you should arrive. Yes, financial statements are not materially misstated. 2, financial statements are materially misstated. Either conclude that matter is not likely to cause a MMS, or determine whether it is likely to cause an MMS. Either MMS is there or MMS is not there. Conclude it. What additional procedures? Do additional inquiry, do analytical procedure, gather more evidences, other procedures perform. Examples of additional procedures, for example, in a trade payables, additional procedures, for example, a review of trade payable shows large amount of overdue payment. When you are reviewing accounts receivable, debtors, some large amount of receivable is pending. This raises concerns that financial statements, you are getting a doubt that, oh, provision for bad and doubtful debt is materially misstated. You are getting a doubt. For that, what you need to do? Ask management regarding uncollectible. Possible outcomes is what? Perform additional work. After performing additional work, what could be the possible outcome? 1, no issues were there. Yeah, the debtors amount is correct. 2, financial statements are clearly misstated. Provision is not calculated correctly. 3, uncertainty. Means even after performing additional work, you are still unable to get evidence. In that case, what happens next? Again, if additional procedure resolve the issue, you can either conclude 1 or 2. What is 1 or 2? You can either conclude 1 or 2. Yes or no? Conclude that the matter is materially misstated, or not. Or conclude that it is not materially misstated. Issues found like this. Yes or no? If the issue is unclear, continue performing additional work. If a clear conclusion cannot be reached even after performing so much amount of work, you cannot provide an unmodified opinion. You can't give an unmodified opinion. At that time, what you will do, you will either give a disclaimer of conclusion or you withdraw from the engagement. Subsequent events. This itself can be asked as a 4 marks question. This itself can be asked as a 4 marks question. They'll ask you these 2 points put together. Under what circumstances a practitioner, when performing a review, will perform additional procedures, and give an example of additional procedure. Under what circumstances practitioner will perform additional procedure? What do you mean by additional procedure? Give with an example. 4 or 5 marks question. This 3rd and 4th point, 1, 3, 4, 1, 3, 4, these 3 put together, a question can be asked for a 4 or 5 marks question. Be careful. Next, subsequent event. This itself, you are appointed as a reviewer for performing review of interim financial historical financial information. If at all historical financial information word is used, annual financials, then 2400. Interim financial is used, then 2410. Then if at all practitioner get to know that any subsequent events between the date of financials and practitioner report date, they must ask management to correct it. Generally, you are not required to perform any procedure after you gave a review report. However, if you get to know something after the date of report, if at all you know this, you would have amended the audit report, then discuss with management, see whether financials require amendment. If needed, how management is going to address it. Management is not amending, they're refusing, then notify the top management not to issue financials to third parties, because according to you there is a material misstatement. If the financials are issued without amendments, you have to take an appropriate action. This is exactly copy paste from SA 560. Next, written representation. Just like in audit 580 standard, even in review also you must get written representation. Yes or no? Written representation is a crucial source of audit evidence. If management changes or does not provide, it indicates a significant issue. Suppose no management changes, like the management have changed and they are saying, sir, we are new to the company, we don't know anything, so I can't give representation, like that they're saying, or they're not providing, it's a significant issue. Communicate with top management. If they are also not responding, give a modified conclusion. Okay, requesting written rather than oral representation can prompt the management to consider the issue more rigorously. If at all I'm asking written, no, they will consider more severely and then give a proper data. Then responsibilities. What will be there in the written representation? Practitioner must request management to provide representation that they have fulfilled their responsibilities for preparing financials as per applicable framework, that they have fulfilled giving all information to auditor and ensuring that all transactions are recorded, and if required by law, I mean that's not required, only these three enough. Yeah. Representation. Sometimes we also ask representation on additional matters. What are the additional matters? Regarding related parties, regarding frauds, regarding non-compliances, regarding going concern, regarding subsequent event, regarding non-monetary transaction and transactions with no considerations, regarding material commitments and contingencies, all that. So they may ask you, they may give you a question, write about representation in a review, and what give few examples. Give few examples of additional matters where written representation can be obtained. Like this they can ask you, suppose no, if management is not providing requested written representation, discuss the matter with the next level management, reevaluate this integrity. All these days I thought they're cooperating, today suddenly they're not giving representation information. Representation means I'm asking information, they need to give me, now they're not giving me. Reevaluate whether they're really honest guys or not. Take appropriate action. Take appropriate action. If management does not provide, practitioner may disclaim the conclusion or even withdraw. If requested written representation is not provided, I can either give a disclaimer of conclusion or I can even withdraw from the engagement. That's it. See, when you're doing this revision, no, after finishing one standard, pause the video and read from your book. That is how you will really make use of this revision. That is how it will be very powerful to you. Next, finally, okay, you performed analytical, you performed inquiry, all that, you gathered so much of evidence, evaluate it. The practitioner must evaluate whether sufficient appropriate audit evidence, actually here audit word is not there, sufficient appropriate evidence has been obtained or not. If not, you felt sufficient appropriate evidence is not obtained, sufficient audit evidence you did not get, perform additional procedures until you get sufficient evidence so that you can form a conclusion. Suppose if evidence is insufficient, you have not obtained expected evidence, if evidence obtained is not sufficient to form a conclusion, consider other procedures so that you can gather the evidence, extend the work perform additional procedures. Sir, additional procedure is not possible, sir. Determine what is the effect on the report. Discuss the limitation. See whether there is a limitation on the auditor scope or not. Check out. Inability. Sir, if practitioner cannot perform specific procedure but obtains sufficient procedure through other procedure, it does not constitute. See, ultimately this is common sense. MCQ important. Through inquiry analytical you did not get evidence, through inspection you got the evidence. That's it, you got the evidence, right? Ultimately that means you got sufficient appropriate evidence. Somebody is asking CA inter tax, please go and watch tax marathon, already given. Next, limitations on the scope imposed by management may affect the review. So that's it. So here no, in this no, this particular second point can be asked as a question. In a review, practitioner may have not obtained expected evidence. What are the consequences? What should be the next step when practitioner is unable to obtain expected evidence? Like this, they can ask you as a 4 marks question. So 2, 3 and 4. That's it. So 2, 3, 4 points you need to write specifically. Okay, that's it. Then finally, you need to form a conclusion. Okay. So the practitioner must consider impact of uncorrected misstatements identified, qualitative aspects of accounting practices. Before you form a conclusion, this is there even in 700 also. Before you form an opinion, here before you form a conclusion, see what are all the mistakes that you identified and not yet corrected. What is its impact? 2. qualitative aspects check out. Further, if the financial statements are prepared using fair presentation framework, consider how financials are overall presented. What is the structure? What is the content? Whether related notes and all giving true and fair view. Whether they are exhibiting underlying transactions in a true and fair manner. Check out. Finally, conclusion. The practitioner, whether unmodified or modified, it depends upon the financial reporting framework. Now, unmodified conclusion in practitioner's report. This is not required from exam point of view. Modified conclusions. Yes, this is important. Modified conclusion. You will express a modified conclusion in two circumstances. Financials are clearly materially misstated. 2. You are unable to obtain sufficient evidence to form a conclusion. In these two cases, you will give modified conclusion. If financials are materially misstated, the practitioner shall give qualified conclusion. If the misstatement is material but not pervasive, suppose if it is both material and pervasive, you will give adverse conclusion. At that time, side headings will be given. A qualified conclusion, adverse conclusion, like that, side headings will be given. Then that is not required. Basis for conclusion para. Again, whenever you are giving a qualified or adverse conclusion, in the basis for conclusion para, you must clearly describe and quantify the impact of the specific amount, explain how the disclosure is misstated, describe the nature of omitted information. If at all misstatement is omitted information, describe that. If the misstatement is due to disclosure, how the disclosure is misstated. If the misstatement is on a specific amount, describe what amount is misstated, quantify it unless it is impracticable. This I even explained much more detailed in 705. I hope many of you would have watched my reporting chapter, audit reporting. Inside that, in 705, basis for modified opinion para, how it will be modified, there I clearly covered. The same thing here also. Then sometimes you will give modified conclusion because you are unable to obtain sufficient appropriate. This itself can be asked as a separate question. Write about conclusion on reporting in case of inability to obtain. If practitioner cannot form conclusion due to insufficient evidence, express a qualified conclusion. If possible effect of undetected misstatement is material but not pervasive, disclaim the conclusion if the possible effect is both material and pervasive. Just 1 minute. Just 1 minute. Yeah, so that's it. Further, management, if at all, imposing limitation so that you are prevented from obtaining sufficient evidence and the matter is going to be material and pervasive, withdraw from the engagement if withdrawal is permitted. So wordings of the qualified conclusion para, this is irrelevant, not required. Finally, elements of the practitioner report. First, title will be there, address will be there, intro para, management responsibility, practitioner responsibilities. They may ask you this question directly. What are practitioner responsibilities in a review engagement? A responsibility is to express a conclusion, describe the review of financials, describe that it's a limited assurance engagement, it involves inquiry and analytical procedure, describe that procedures are less than audit, and give a conclusion para, yes or no. And if the conclusion is modified, with a modified conclusion, describe the matter giving rise to modification in the basis for modified conclusion para, yes or no. And also give a reference to ethical requirements, all that. Date of practitioner report shall not be earlier than the date on which you obtain sufficient evidence and shall not be earlier than the date on which financial statements are approved by respective authority. That's it. Emphasis of matter. Can a practitioner give emphasis of matter para in a review report? Absolutely yes, no problem at all. Placement. In audit report, emphasis of matter paragraph will be placed. Opinion, basis for opinion, then emphasis of matter. Okay. Whereas here, emphasis of matter paragraph will be placed immediately after paragraph where conclusion paragraph will be there, right? Immediately after that, emphasis of matter paragraph will be given. Placement. This itself can be asked as an MCQ. Remember, in emphasis of matter, what matter you can highlight? Only that matter in the financials which is free from MMS, on which you already got sufficient appropriate evidence. That only you can highlight. Then, can practitioner use other matter paragraph? Absolutely, where he can talk about information not presented in the financials, something else. You want to talk about branch reviewer responsibility, you can talk about that. Then, documentation is important. Okay, what you have to document? What is the nature, timing, extent of procedures performed, who performed the work, when the work was completed, who reviewed the work, result of the work performed, and conclusions you reached, any significant matters that have been arisen. So all that. Further, discussions with top management of significant matters, that also has to be documented. If inconsistency is found, document how the inconsistency is addressed. That also you should document. That's it. 2400 is completed. Oh my god, very tough. In the sense, it's actually easy. The 2000 series is dead easy. Those of you who are very good at 700 series, 2000 series is nothing. Okay, just that in 2000 series old report format we will follow. Before 2017 there is a reporting format that only we are following, because these 2400 2410 standards were not updated in the past almost I can say 10 years. They were not updated, whereas auditing standards, no, 700 701, they were all updated in 2018. Fine. 2410, review of interim financial information performed by independent auditor of the entity. The company has an independent auditor. Generally this standard is very popular in listed companies. In listed companies, the stat auditors will give interim review report on interim financials, quarterly financials. They use this standard only. Yes or no? So this standard is applicable when independent auditor is reviewing interim financial information as a part of their overall audit of financial statements. Then objective of an engagement to review. Objective is also not required. That's not required. It's okay. Agreeing to the terms. This is most important. Okay, agreeing. The auditor, you see entire 2410, the word used is auditor. Why? Because independent auditor is performing this review. Therefore, the person who is doing this review is auditor. Whereas in 2400, he is not auditor. He is a practitioner. We call him as what? Simply practitioner. Auditor and client must agree on terms of engagement, which are usually recorded in an engagement letter. So what will be there in engagement letter? Nature of the engagement, objective and scope, management responsibility, audit responsibility, what is the level of assurance required, nature and form of the report. The same thing is there even in 210 standard also. Then obviously most important thing in a review of interim financial information is obviously understanding the entity and its environment. So the auditor has to obtain understanding of entity and environment, internal control as a part of annual audit as well as interim financial. So where when you're understanding the entity, you identify areas where potential misstatements will happen and likelihood of their occurrence, and you will do inquiry, analytical and other procedures so that interim financial statements, are they prepared as per applicable framework or not, you will see. Remember, in a review you will only do limited procedures, fewer procedures, inquiry, analytical. If required, other audit procedures you will perform. Sir, same auditor is doing audit. Last year also I only conducted audit. Should I once again understand the entity? No need. Just update. If same auditor, if the auditor has already audited annual financials before, then they have already have an understanding of the entity. That time you just have to update your understanding. Yes or no? The auditor also understand any difference between any differences in internal control between interim and annual financial. Procedure. Remember, there is a point called 143 subsection 3 clause I, where auditor has to give opinion on operating effectiveness of IFC. This opinion is not required in case of a review engagement. Remember. Next. So procedures to update understanding. Okay, suppose I'm already an auditor. What are the procedures I will perform to update my understanding? I will read documentation of the prior period audit. I will assess the risk. I will read the most recent financial statements. I will consider materiality. I will evaluate issues related to internal control. I will inquire with management. I will ask management about any changes in business activity. I will ask any significant changes in internal control. I will ask management how the interim financials were prepared and reliability of the underlying records. All this I will perform to update. This itself can be asked as a 4 marks question. Second and third point put together. You are already an auditor of the entity in the prior period. This year you were requested to do review of interim financial information. For that you need to obtain an understanding of the entity and environment. So since you are already an existing auditor of the entity, you just have to update the understanding. What are the points you will update? They will ask you in this third question. In this third point, there are so many points, right? A to L, approximately some 10 12 points, but they write any 5 points you have to write in exam. That's it. Sir, I'm a newly appointed auditor. Then you should understand the entity and environment, including internal control, for both annual audit purpose as well as interim financial information purpose. The understanding will help you to do review of interim financial information. This understanding will help you to do audit of annual financial statements. Next. Obviously, even in 2410, review of interim financial information, you do an inquiry, you do analytical procedure. A review usually does not require testing like inspection, observation, confirm, that and all not required. It just involves inquiry with responsible person and analytical procedures. Whether is there something wrong? Is there anything wrong? Is there anything something like illogical? That I will try to identify. The auditor understanding of the entity and internal control. Okay, this is okay, not required. Procedures to be performed. What are the review procedures? Read the minutes from the meeting. Identify matters that may affect interim financial information. Inquire with management about various matters, including, these are all actually subpoints, ma. These are all actually subpoints, ma. Whether Financial information is matching with financial reporting framework. Are there any changes in accounting principles? Are there any new transactions? Are there any uncorrected misstatements? Any unusual situations? What are the assumptions about fair value measurements, related party transactions, changes in commitments and contingencies, complaints with debt terms and conditions, any frauds or suspected frauds, allegations, non-compliance with laws and regulations, all that. Finally, you apply analytical processes to identify, these are all sub points actually. These are all sub points. I will tell my team to rectify this. Yes, E point onwards, yes, E point to S point. These are actually sub points. It's okay, no problem. Then, so read interim information to see whether the interim financial is not prepared in accordance with applicable framework. I think this is enough. Procedures to be performed, no? The sub points, enquiries include various matters. What are all the various matters that you inquire? Any 5 points you read, that's more than enough. Next, in a review of interim financial information, you will also inquire about subsequent event and going concern. Okay, subsequent events. See, ask management whether subsequent events are identified, whether do any adjustments or disclosures required. The auditor should also inquire whether management assessment of going concern, yes or no. The auditor should inquire if management assessment of going concern has changed, and if even suggest about doubts about it, the auditor should ask management plans to consider and what is the adequacy of the disclosure. If a material adjustment is questioned, the auditor should make additional inquiries and resolve the matter. Evaluation of misstatements identified, that's not a big deal, not required. Get management representation, written representation. Management must acknowledge responsibility for designing and implementing internal control. Management confirm that interim financial information is prepared as per framework. If at all uncorrected, some mistakes are identified which are not corrected, management says that they're immaterial. Get a representation that they're immaterial, yes or no. And a summary of those uncorrected misstatements which are immaterial, no, please get a list of that to the representation. And management has to give a representation that they disclose to the auditor any fraud or suspected fraud. Get a declaration from the management representation that management disclosure the result of their own risk assessment process to the auditor. Management should give a representation that they disclosed all the non-compliances, frauds, everything to the auditor. That's it. Any 5 points enough. Getting written representation, internal control point, risk assessment point, fraud point, non-compliances point, that's it. Subsequent, get a representation that management has disclosed all the subsequent events information to the auditor which require adjustment, which require disclosure. Next, what about other information? Interim financial information, when listed companies giving, when a listed company is publishing quarter results, they will be publishing in some document. That document might contain other information also. Same 720 standard will apply, yes or no. Auditor has to identify inconsistency between accompanying information. In SA 2410 it is called as accompanying information. That's nothing but other information as per 720 standard. Suppose MMS is there in interim financial information, ask the management to amend it. Suppose MMS is there in other information directly, yes or no, then additional paragraph in the review report, put an additional paragraph in review report, say that other information is materially misstated, or withdraw from the engagement if possible, yes or no. That's it. Suppose other information not related to, the auditor may identify some MMS in a fact in information not related to financial matter. So here other information not related to financial matters. Inside that's a mistake you identified. That time when discussing apparent misstatement, auditor considered whether there is any difference in judgment, all that. If management refuses, actually that's not relevant, maybe that's not that relevant. Okay, I don't think this is actually one of the advanced concept. Okay, so I don't think in exam they'll ask this level. So this 1 and 2 points are more than sufficient. Okay, other information which is financial, other information which is non-financial, not at all related, but inside that factual misstatement. So misstatements is 3 types: factual misstatement, normal misstatement, like that, some amount related misstatements like that. At 450 standard introduction they'll give, so related to that. Communication of matters to management. If a material adjustment is needed, means in the interim financial information, some adjustment is required, modification is required, communicate it to appropriate level of management. If at all they are not responding, the auditor should inform to top management. Manner of communication, depending upon the sensitivity of the matter, nature of the matter, timing, and documenting oral matters, all that. If top management also does not respond, modify the review report. If at all they are not responding, which is intentional, which is a limitation on the scope, withdraw from the engagement. Sir, you identified fraud and non-compliance with law. Communicate it to the appropriate level of management. See whether collusion is involved and consider reporting to top management and also implications in the review report. Review report on interim financials. I think this is not required. Okay. Same. I think same 2400. That is enough. Suppose no. Departure from applicable framework for preparation and presentation. If interim financial is prepared but not in accordance with framework, then you will give modified conclusion. The auditor should express a qualified or adverse conclusion if at all a material adjustment is needed in the interim financial so that it will be in accordance with applicable financial reporting framework. If at all, the modification should describe the nature of the departure. When you are giving a modified conclusion, you should describe in basis for modified conclusion para what is the nature of departure. If necessary, information is omitted. Suppose in the interim financials, some disclosures are not given. That time, auditor has to include the omitted information if possible. Generally, modification is done by adding explanatory paragraph to the review report, and qualifying the conclusion. Generally, we will give basis for qualified conclusion para or adverse conclusion para, like that. Limitation on the scope. So write about limitation of scope in case of a review. Like that also they will ask you. If limitation of scope is there, the auditor should not accept the review. If at all you are aware of any limitation of the scope. Sir, I accepted the engagement. Then the limitation of scope is there. Then you need to withdraw from the engagement. Request for removal. First, after accepting, there is a limitation. Request for removal. If management refuses and you cannot complete the review, communicate the reasons in writing. If auditor believes that material adjustment is needed, please communicate it. The auditor consider any legal requirements also, and if required, auditor will give a disclaimer of conclusion if at all if at all there is a limitation after accepting the review engagement. That's it. Then going concern and significant. This is important. Okay, if auditor identifies material uncertainty about entity's ability to contain the going concern and adequate disclosure is made in the interim financials, the auditor modify the report with emphasis of matter paragraph. Test your understanding. Exceptional question at the beginning I already told. Sir, uncertainty. The auditor may have added an EOMP in a prior audit or audit report review. Okay, in the last year, there is an MURGC paragraph. I mean, in the last year audit report, MURGC para is there, or in the last year review report, last quarter review report, some going concern issue is there. If uncertainty is persistent, persist in the current period also uncertainty is there, adequately disclosed in the current period, then in the current period you will give EOMP. Suppose if material uncertainty is not adequately disclosed in the current period review, current period interim financials, going concern uncertainty is there but not adequately disclosed, then I will give adverse conclusion or qualified conclusion depending upon the level of severity. Then other considerations, that is not required. Documentation, that's not required. That's it. With this 2410 standard is also completed. In this, the most important thing is going concern and significant uncertainties. 4 marks direct question is possible. Please read this carefully. That's it. With this 2400 and 2410 is also completed. That's it. Okay, I hope you thoroughly understood briefly. Now immediately after this, please read it thoroughly. Then CARO 2020. I just want to talk about CARO 2020. You go to my CA Inter Audit Marathon. You just go to my CA Inter Audit Marathon. You just go to my playlist. CA Harsha playlist is there, right? Here you will find something called GOAT revision sessions. Inside this, my audit marathon will be there. Or you can simply YouTube. Yeah, this one. Okay, you can simply type in the YouTube audit marathon. Mostly mine only will come. You will get on the first. Okay, yeah, audit marathon. You see inside this timestamp will be there. So here I have given CARO explanation approximately for some 40 minutes. I explained. You can put in 2x speed and watch it and then finish. Fantastic it will be. Okay, that's it. CARO 2020. That's it. Review 2400, 2410 both are complete. 2400 review of historical financial information. 2410 review of interim financial information conducted by independent auditor of the performed by independent auditor of the entity. That's it. Yes, perfect. Now the prospective information. Yes, perfect. So let's begin PFI, prospective financial information and other assurance engagement. In this, we all know that there are 3 standards. One is 3400, 3402, 3420. 3400 talks about prospective financial information examination of that. 3402 talks about control set service organization on that assurance report we are providing. 3420 talks about report on compilation of pro forma financial information which is included in prospectus. Most importantly, the headings has to be very, very careful when you're writing the headings. Sometimes in MCQ heading may be tested, we don't know. A heading itself could have been tested. For example, 3420, you see, heading is what? Assurance engagement to report on compilation of pro forma information, financial information, which is included in prospectus. And if you see, by the way, right now first I'm going to discuss two exceptional questions were there. So before that, I just want to give one small clarification on this. Now, 3402, where you are giving an assurance report on controls at service organization. 3420, where you are giving an issue, where it's an assurance engagement to report on compilation of pro forma financial information to be included in prospectus. Both these are reasonable assurance engagements, whereas prospective financial information is a moderate assurance, because PFI is generally future oriented other than historical. You know very well, right? 3000 series talks about assurance engagements other than historical. Therefore, this is not historical information, therefore moderate. Whereas this is on controls which is already implemented. This is on pro forma adjustments. Here in 3420, something that we are talking about is nothing but pro forma adjustments, unadjusted financial information, nothing but historical data only. In both the cases, the data used is historical. See, here it is non-financial information, here it is financial only, but it's a different side. So that's why we are giving added questions in ICA book. Only 2 questions were there, exceptional questions. Why I called it as exceptional, you see, those of you who have not read this question, if at all you are seeing this for the first time in the exam, you will forget to write this last point. This point many won't understand what exactly the question is talking about. There is an auditor approached by one company to examine prospective financial information. Okay, what factors an auditor considered before accepting? This is straight question. Technically, what are the factors while accepting the engagement? What factors you consider? Remember, this kind of questioning is there in 800 series, 2000 series, 3000 series, and even in 4000 series. In all these standards, questioning format, this kind, factors that the auditor has to consider, factors that the practitioner has to consider before accepting an engagement. This kind of questioning is there in every kind of standard. Now, under what conditions the auditor should decline? You see the part, you see how fantastic the question. 3 parts. What factors auditor should consider? Under what conditions the auditor should decline or withdraw from the engagement? Additionally, what steps? Means there are 3 questions asked in this. How the weightage will be distributed? This will have some 3 marks weightage, this will have some 1 mark weightage, or this will have 1 mark. Or factors question will have 2 marks, 1.5 mark for that, 1.5 mark for this. Like many students, what they do, they only write factors and come back. They forget to answer the second part of the question and third part of the question. Under what circumstances? What factors? Very simple. What is the use of the prospective? Why this PFI is prepared? Is it there for general distribution or is it for limited distribution? What assumptions are used? Are the best estimate hypothetical? What are the elements included in the prospective information? For what period it was covered? These are the factors basically we cover before we examine prospective. This answer everybody will write. I hope you have revised it already. You will write. Wait. After finishing this question, I will come back to the revision part and then I will revise that point. Okay. Then, under what circumstances you should not accept? That's the second part of the question. The auditor should not accept when assumptions are clearly unrealistic, or when the auditor believes that PFI will be inappropriate. The PFI, the intended purpose for which it is prepared, is not correct, or assumptions are clearly unrealistic. Then you should not accept. Yes or no? Then, third one. What additional steps should be taken to formalize the terms of engagement? What we need to do additionally to formalize the terms of engagement? To formalize terms of engagement, what we will do? We will issue engagement letter, agree on terms with the client by sending engagement letter, just like any other engagement. Even in audit, in review, we give engagement letter, right? Just like that, give an engagement letter. That is the step that we take to formalize the terms agreed. See how fantastic the question has been asked. Now, question number 8. Here, what they are asking, 3400 talks about prospective information which can be a forecast or projection, correct? In this context, how do you differentiate a forecast from projection? So how forecast is different from projection? Also provide an example. Forecast means PFI. It's a prospective information which is based on assumptions as to future events which management is expecting that will happen, and the actions which management expected to take place. Yes or no? That reflect anticipated experience with no provision of risk. Where the sentence is there, anticipated experience, assumptions that reflect experience of the management with no provision of adverse risk. So when they say no provision for adverse risk, that's actually called as best estimate assumption. Forecast is based on best estimate assumption. Example, in the present market condition, supply availability, the CFO, the Chief Financial Officer, is expecting sales will increase by 5% for the next quarter. See how short run it is? Very next quarter I'm talking about. Therefore, 5% increase in sales in the next quarter, that next quarter, very short duration, that's a forecast. Projection means what? Projection is also PFI, which is based on hypothetical assumption. You see here, they did not use the word hypothetical assumption in forecast. Here, assumption is which kind of assumption? Best estimate assumption. Whereas in a projection, the definition itself clearly includes the word hypothetical. Hypothetical means what? It may happen or it may not happen. Adverse possibility is high. Whereas in a best estimate, no provision for risk of adverse deviation. Adverse deviation risk is generally very, very, very low. Whereas in a projection, in a adverse deviation possibility is extreme high. Then, and that's it, which are not necessarily expected to take place, such as some entities are in startup phase, all that. Getting it? Generally, when we are preparing PFI, we may use a mix of best estimate assumption and hypothetical assumption. Either we use a best estimate or hypothetical or a combination whenever we are preparing PFI. So again, for projection, they gave some example. Okay, in projection, no, hypothetical assumptions will be there. Whenever hypothetical assumptions are there, sensitivity analysis has to be shown in the PFI. Whether sensitivity analysis is shown or not, as a assurance provider, we have to look into. Therefore, prospective information is relating to events that have not occurred or might not occur. Assumptions, it is purely based on assumptions, which is generally future oriented, speculative in nature. Therefore, whether the results shown in PFI, whether they will be achieved or not, can I give an opinion as such? I can't express any opinion. That is why the assurance that we give on prospective financial information is only a moderate level of assurance. That's it. If you understand these two questions, you are more than enough. Like this is more than enough. Next, now coming to, let's discuss PFI, and then all that. Only important points I'll cover, which is exactly important from exam point of view. I will discuss this now. So what is this? 3400 examination of prospective financial information. In this, what exactly important is, you see, forecast. Forecast means prospective information based on assumptions. You see, they did not use which type of assumption, they simply use the word assumption. Whereas projection, if you see, PFI is based on hypothetical assumptions. Assumptions are different from hypothetical assumptions. Here, assumptions means what? Assumptions are the one which reflect experience, anticipated experience with no provision for risk of adverse deviation. That's what I showed in the exceptional question. Yes or no? Generally, a mix of best estimate and hypothetical assumptions are used to prepare PFI. Now here, even in assurance engagement 3400, the word auditor is used. That doesn't mean historical statutory auditor. Here, the auditor who is giving report on assurance engagement, the auditor who is giving report on PFI, he can be a different auditor, not necessarily a statutory auditor. Then, by the way, this standard does not apply where you are examining PFI, which is expressed in general terms in annual reports. If you see any annual report, no, management discussion and analysis, company future outlook related information and all will be there. Even in under SS 720, we need to read other information. Other information means what? Other information included in annual report. And even in 720 standard, they say we are reading other information not to give opinion thereon. We are reading other information to find, inconsistency between other information and financial statements. So that's it. So just because we are reading something, prospective financial information, some PFI we are reading, some PFI we are examining, that doesn't mean 3400. 3400, when it apply, when you are specifically appointed to report on PFI, your duty is to give a report on PFI, then only 3400 will apply. Then what is the nature of assurance provided? This itself straight away 3 marks question possible in exam. So PFI relates to future events which are not occurred, may not occur. Evidence used is generally future oriented, therefore speculative in nature. It is different from evidence which is there in historical data. Therefore, the level of assurance is very moderate. That's what I told at the beginning. The level of assurance in prospective financial information examination is moderate level of assurance, whereas in controls on service organization, which is called as SOC audit, type 1, type 2 report we will give. Whereas in 3420 pro forma information, yes or no, there in both the cases, the level of assurance that we give is reasonable assurance. Next, So an opinion cannot be expressed whether the prospective information, results shown in the prospective financial information will be achieved or not. So next, now can a CA in practice, deal with prospective financial information? Absolutely yes, no problem. However, there is a clause. Which clause? Clause number 3, part number 1 of second schedule of CA Act. What it says, it is not, it will not, it does not allow CA in practice to associate with reports where earnings estimates and all will be there. It is prohibiting. However, if you are disclosing the source of information clearly, you are explaining the basis for forecast, and state that you did not vouch accuracy. If you mention clearly these 3 points in the report that you are giving, then you are not treated as guilty of professional misconduct. Further, the same rule applies to projections based on hypothetical assumptions, where you clearly have to mention that you do not vouch the accuracy. Therefore, what is the duty of the member who is examining PFI? What is the duty of the members examining prospective financial information? What exactly the duty of the chartered accountant to examine, who is examining? First, verify best estimate assumptions are reasonable, hypothetical assumptions they are consistent with purpose of the information. Why are you preparing prospective financial information? Okay, for that, what assumptions I can take, whether the assumptions are matching with that purpose or not, whether the assumptions are reasonable. Assumptions must be reasonable, assumptions must be matching the purpose for which the PFI is prepared, and ensure that PFI is properly prepared. See that the information is prepared based on these assumptions correctly. First, assumptions reasonable or not, check out. 2, whether these assumptions and the purpose are they aligning with each other or not. 3, whether the PFI is prepared based on this assumption, check out. Then see that the PFI is properly presented. Prospective information, the financial statements are there at prospective, whether they are clearly disclosing all the assumptions, material assumptions, best estimate assumption, hypothetical assumptions, are they clearly disclosing the assumptions or not? You should check. Most importantly, consistency. What is consistency here? Sir, PFI, suppose no, sir, historical financial statements, balance sheet, P&L, what is the format applicable for that? Schedule 3, part 1, part 2, schedule 3, part 1, part 2, part 3, depending upon the accounting standard applicable, depending upon the type of the entity, part 1, part 2, part 3, schedule 3 is applicable. This now PFI should also be prepared using the same format. The framework should be same. So the auditor should verify that PFI is prepared on a consistent basis with historical financial statements using appropriate accounting principles. In past, I'm using WDV method for depreciating machinery. Even in PFI, the method of depreciation should be WDV. Inventory valuation is FIFO. Even in PFI, inventory valuation should be FIFO. So the accounting policies that we follow, financial reporting framework that we follow should be consistent with historical financial information. And remember, all other auditing standards, whenever you are examining PFI, whatever exam, suppose you want to get external confirmation, you can get it. For that, 505 standard you can use happily, no problem at all. That's it. So these are the duties of the member who is examining prospective financial information. Easy or not? So what are the duties of the member examining PFI? Assumptions you need to verify. Whether they are prepared based on the assumptions or not, you need to check. Whether assumptions are clearly disclosed on, you need to check. Whether the PFI is prepared on a consistent basis with historical financial information or not, you can use other standards wherever relevant. Then acceptance of an engagement. This is very important. That's what just now we saw in exceptional questions. What are the points the auditor should consider before accepting examination of PFI? What is the purpose? To whom it is distributed? Limited or general? Whether best estimate assumptions used or hypothetical assumptions used, what information is included in PFI, what is the period for which they are covering, when to decline or withdraw. The auditor should reject or withdraw if assumptions are clearly unrealistic. Auditor must agree on terms with client through engagement letter. This is a formalized process, yes or no? And when you are reporting on PFI, the auditor should assess whether past financial data is reliable. First of all, if at all past financial statements are not reliable, and if any PFI is prepared based on the past data which is not at all reliable, generally we will not accept that PFI. Simple. So what are the points a practitioner shall consider before accepting an engagement? That's it, answer over. Then how should we conduct examination? How should we verify? What we should verify? Very simple. What you should verify? Key factors in examination. Here actually it is talking about factors. Okay, so when deciding nature, timing, extent of process, so when you are planning the audit, when deciding nature, timing, extent means what? Planning examination of PFI. When you are verifying, when you are examining PFI, when you are planning this examination, you need to plan the work, right? So when you are planning, you should consider what is the knowledge that you have in the previous engagements. Management is competent or not? What is the likelihood of MMS? Nothing but risk assessment you do. extent to which affected by judgment, what is the level of assumptions and judgments, sources of information, PFI is prepared based on some underlying in data, right, some data from where the data has been gathered, suitability, engagement team experience with the business. So not only all that, our team experience, our team ability, that also we should check. Then evaluate source and reliability of the data such as budgets and all. If hypothetical assumptions are used, significant implications must also be considered. Ensure hypothetical assumptions align with financial purpose and not unrealistic. The hypothetical assumptions must match with the financial purpose, nothing but the purpose for which PFI is prepared. And finally, presentation and disclosure of PFI. This itself can be asked as a 4 marks question directly. Remember, examination procedures, what factors the practitioner auditor must consider while examining PFI. This itself, this also can be asked as a 4 marks question. And what are the points PFI must present and disclose? First of all, when you are reviewing PFI, the auditor must ensure the following in the context of presentation and disclosure. In the context of presentation and disclosure in PFI, you need to be careful about the following elements. See that the presentation is clear, informative, not misleading. See that accounting policies are clearly disclosed in the notes to the PFI. If policies are changed from last year, reasons and impact must be disclosed. Assumptions must be clearly disclosed. If assumptions are highly uncertain, that fact must also be disclosed, and the date of preparation should be clearly disclosed, on which date the PFI is prepared and which date assumptions you have taken. No, assumptions are valid based on a particular date, based on the circumstance on a particular date. Subsequently, those assumptions may not be valid. If results are shown on a range, sometimes prospective financial information, we don't show amount, we show range bound, okay, basis for setting it, and it is not biased or misleading. See, remember, in a prospective financial information, we don't give report on the numbers, we give report on the assumptions. We talk about assumptions, we report on assumptions, whether assumptions are reasonable or not. If assumptions are reasonable, using this assumption, PFI is prepared or not, we will check. In PFI, sales figure is there. I am not verifying accuracy of that sale figure, whether that sale figure will be achieved or not. I am not saying that. I am talking about assumption. Yeah, PFI, the sales figure is prepared based on this assumption. Whether that assumption is matching or not alone, I will check. I am giving report on assumptions. Typically speaking, in a PFI audit, in a PFI assurance engagement, we are giving report on assumptions. We are not giving report on the ultimate financial information. Then report components. What are the points that we will mention in the report? Actually, in general, we generally see reports in our classroom. In our classroom discussion, we open the reports and then see. But since it's a revision time, that day before exam, so it's very difficult for me to show all the reports and all. So just like an audit report, I hope you have seen audit report, right? Reporting chapter of mine. So just like an audit report, here it's an assurance report on PFI. This will also have the same information. So title will be there, address will be there, identification of information, reference to SCA, and you see opinion will come somewhere at last, in between. Generally in audit report, opinion will come at first. Remember, in entire 3000 series, 4000 of course we don't give any opinion. 2000 series, in both these cases, opinion comes somewhere in the middle in the audit report. In the report of the practitioner, middle somewhere it will come. Why? Because 3000 and 2000 series standards were not yet updated. Getting it? These standards were released somewhere before 2016, and before that time they have released. Whereas if you see 800 series now, opinion comes at first, title, address, then directly opinion, which is in line with our 700 format. Whereas 3000 series and 2000 series, opinion section of the auditor, conclusion section of the auditor will come somewhere in between. Very soon, 3000 series and 2000 series will be amended. Probably May 26 attempt onwards, this will be amended. For May 26 September 26 and Jan 27, 3000 and standard through 2000 standard might be amended. That's what I'm expecting. Okay, fine. Anyhow, opinion as to what? Whether PFI is prepared based on the assumption. See, we are giving opinion whether PFI is prepared based on assumption. We are not talking about true and fairness of the PFI. Then appropriate caveats, nothing but some disclaimers you should give in the report, which is very important. So sometimes in exam they'll ask you, the auditor, the practitioner must insert appropriate caveats concerning results indicated by PFI. What are the disclaimers he must give? Nothing but this point they'll give. State whether anything suggests assumption do not provide reasonable basis. Here actually this point, this one, and yeah, of course this one, yeah, 3 4 5 6, this one. you must state in the PFI report you are giving, right? It may be a forecast report or projection based report, whatever it is. So state clearly that actual results may differ significantly from projection, and if a range is given, there is no guarantee that actual result will fall within the range. If a PFI is expressed in terms of lower bound, upper bound, like that range, clearly state that the actual result may not fall in this range bound, and you clearly mention that actual results may differ significantly from projections. For projections, clearly state that these are based on hypothetical assumptions, and caution readers against using them for any other purpose other than intended. See, the PFI is prepared for certain purpose. Alert to the users that they are not suitable for some other purpose. And if PFI is not adequately prepared or presented, a qualified or adverse opinion should be expressed or withdrawn. If at all prospective information is not prepared in accordance with the assumptions shown, adverse opinion. If assumptions are not at all reasonable, sorry, assumptions are unrealistic, completely straight away adverse opinion or withdraw from the engagement. Either give a modified opinion or withdraw. Remember, if prospective information is not adequately presented, if presentation and disclosure is not adequate in the PFI, assumptions are not clearly shown, accounting policies are not clearly shown, you must give a qualified opinion or adverse opinion. If assumption itself is unreasonable, you should give adverse opinion. MCQ might come very clear, be clear. And that's it. Finally, you need to document whatever the evidence is there to support report on examination. Whatever the evidence that you gathered for giving a report on examination of PFI, you must maintain documentation. And remember, you must maintain know your client means the client data, PAN number, all the details also you should maintain. That is important. That is KYC norms. In professional ethics you might have seen KYC norms. That's it. So this is 3400. Now 3402 I will not discuss in this session. I have a separate session for 402 and 3402 put together. That's why you need to discuss or read this topic immediately after 402, because 402 and 3402 are very closely connected. Okay, so 3402, here the report is done, here the report is given for the purpose of 402 audit. Getting it? So 3402, there is no validity if there is no 402. Simple logic. Okay, so 402 3402 I'm going to do a separate live on that. So inside that in that particular session you can see that. Next 3420. 3420, what is this 3420 is talking about? Just 1 minute. Just 1 minute. Yes, I'll continue. 3420, assurance engagement. Be careful when you're writing headings, it must be completely correct, and headings will sometimes carry marks. Assurance engagement, okay, for what? To report on compilation of pro forma financial information. Where are you giving it? Included in prospectus. This is included in prospectus. Fine. So what is this? Nothing but this is similar to audit of consolidated financial statements. What happens in consolidated financial statements audit? Holding company financial statements, subsidiary company financial statements will be there. You will apply some consolidation adjustments and the financial statements will be consolidated. Exactly this also. Pro forma financial information is nothing but a consolidation of two different company financial statements where we apply pro forma adjustments. Here in 3420, no, here 3420, there is something called unadjusted financial information and there is something called pro forma adjustments. There is something called pro forma. Unadjusted, this is pro forma financial statements or pro forma financial information. Actually the standard uses the word information. Pro forma financial information. Pro forma financial information. Whereas CFS, consolidated financials, what happens there? Holding company financial statements, subsidiary company financial statements, you will apply consolidation adjustments. So by applying consolidation adjustments on holding company subsidiary, you will prepare consolidated. Here by applying pro forma adjustments on unaudited financial information of acquirer company, unaudited financial information of acquiring company. There are two companies. One is buying company, another one is selling company. So generally the pro forma financial information is prepared by buying company, nothing but acquirer company. Selling company is acquiring company. Buying company to buy this other company. Suppose acquirer, if this company want to buy another company, further the company need funds, further the company want to go for public issue, they want to tell the public that if at all we acquire the other company, this is how our financial position will be, this is how our financial performance will be, like that they want to show. So pro forma financial information is nothing but financial information shown at a past date. If at all acquisition is already completed on the date, this is a very popular pro forma financial information. Getting it right now? Now, very simple. How this pro forma financial information shall be prepared? Is there any applicable financial reporting framework? Actually, it is called as applicable criteria. It's actually called as what? Applicable criteria. Is there any criteria for preparing pro forma financial information? There is no criteria for preparing pro forma financial information. SEBI in India has given some guidelines on pro forma financial information. Those guidelines can be followed by those who are preparing pro forma. We as an auditor has to check whether the pro forma financial information is prepared using the criteria which is suitable or not. This is what our duty here. What is our responsibility in this particular report, in this examination, when we are assurance engagement to report on pro forma financial information, what is our duty? Our duty is to report on whether pro forma financial information is prepared in all material respects in accordance with the applicable criteria or not. That's it. This is what our objective. Look at. So what is the objective? What is the objective? The entire objective: ensure that pro forma information is compiled by the responsible party. Who is the responsible party? Generally buying company. Buying company is called as acquiring company. Acquirer. Better. The word is acquirer. Acquirer. R-E-R. Acquirer. Other company is called acquiree. Okay. Acquirer company is the one generally who prepares the pro forma financial information. That is the responsible party. So what is the objective of the auditor? Ensure that pro forma information is compiled by acquirer company in all respects based on applicable criteria. So based on applicable criteria, did they prepare PFI correctly or not? Check out. What is applicable criteria? We will discuss that. What is applicable criteria? All that we will discuss that. Okay, we will come back to it. So applicable criteria, and finally provide a report based on the findings. Now compilation, this itself can be asked as a 3 marks. Write about compilation of pro forma information. They'll ask you directly. Write about compilation of pro forma financial information. Who will have to compile? Responsible party. So responsible party gathers and present financial information to show the impact of a significant event or transaction on unadjusted information as if it has occurred at a selected date. Suppose as on 31st March 2025, if at all, see, actually our company want to buy another company. This will happen somewhere in the December 2025. But if at all this particular acquisition happened at an earlier date, 31st March itself, if a significant event or transaction like my company acquiring another company, if this transaction happened at 31st March 2025 itself, how the financial position would be if I want to show that impact? That financial information is called as pro forma. Pro forma is not a real financial picture. It's an assumed financial picture. Remember, that is different from prospective. Prospective is future. Pro forma is based on past. Now, so what are the steps involved in compilation? Identify the source of unadjusted information. Source of unadjusted information is nothing but acquirer financial statements, acquiree financial statements. Now onwards I will use the word RER, acquirer, REE, acquiree. So acquirer financial statements, acquiree financial, nothing but buying company, selling company, both the financial statements. That is the source for information. Okay, and from that we will extract the information that we want. We will extract the information. Now once you extract the information, apply consolidation adjustments. Nothing but here we call it as pro forma adjustments to unadjusted information based on the purpose, and finally present the information, pro forma financial information with all necessary key disclosures. That's it. These are the steps involved in compilation of pro forma information. Now What is the practitioner responsibility? This itself can be asked as a straight 4 marks question. Okay, what is the responsibility? Very simple. I am not responsible for compiling. Hello, I am not here. Management will prepare it. This is the responsible party duty. Yes or no? The practitioner's sole responsibility is to report. My duty is what then? Report whether pro forma information is compiled in all respects based on applicable criteria. Here, we provide a reasonable basis. It is a reasonable assurance engagement whether applicable criteria used to compile pro forma information, is it reasonable or not? We need to check. What is applicable criteria? I already told applicable criteria is used. Applicable criteria is nothing but you prepared pro forma information, right? Based on what? How you prepared it? You presented in some format, right? Financial reporting framework, right? That is applicable criteria. The criteria which is used by responsible party to compile pro forma. For example, consolidated financials you are presenting. Some accounting standard 21, 27, 28, normal accounting standards, and some Ind AS is applicable. Yes or no? So, consolidated financials you are preparing based on some accounting standard. Pro forma financial information is prepared based on some criteria. Exactly. So, these criteria may be established by standard setting organization, some standard setting organization like accounting standard board, international accounting standard board, or this criteria would have been given under the law, or this criteria would have been given under regulation like SEBI, or the criteria is developed by responsible party itself if there is no established criteria. Suppose if established criteria is not at all there, then responsible party will design the criteria. In such a case, you have even more further responsibility. If there is no established criteria, whether the criteria developed by the responsible party, that criteria, is it proper or not, you need to check. Next, what are the steps involved in this engagement? What are the steps? Generally this question may not be asked, but if at all they ask 3 marks question, what are the steps? First, I need to accept the work. Then I need to plan and perform the work. I need to get written representation. I need to form the opinion. I need to give the report. Simple. Now, engagement acceptance. When will I accept a pro forma financial information related engagement? When will I accept an engagement to report on pro forma financial information which is to be included in prospectus? When will I accept that engagement? First one, see that I have necessary capability and competence. Remember, this is what they are in the SQC also. A similar requirement is there in SQC also. So I need to check whether necessary capability and competence is there. Whether can I do this? By the way, I will show you. This is one company which prepared. There is a company called SJS Enterprise. There is a company called Plastic. SJS Enterprise is acquirer company. This is acquiry company. Now this company is preparing. They are doing some pro forma adjustments and pro forma condensed financial statement they are showing. Okay, they are showing pro forma condensed financial statements, nothing but summary financial statements. So it's an 810 and 3420 put together. Getting it? Fine. So this is how generally consolidation processes happen. Two companies financial statements will be there, consolidation adjustments will be done, final figure will be there. So exactly. So this is one report. You can find it in the Google if at all you want to see that. So KPMG have given an assurance report on this. KPMG have given an assurance report on this. This report is in 2021. Okay. So I'm just showing you if at all you want to. Okay. Now when can I accept the engagement? See whether do I have capability, competence. Knowledge and discussion with third party, responsible party. See that criteria is suitable and pro forma information is not misleading. See that ultimately pro forma information is prepared in the manner which is required for the user. It is not misleading. And see that applicable criteria is correctly applied, suitable or not. And then this third point not required. Now if unadjusted information or acquiry or divest information has been audited, for example, acquirer financial statements, acquiry financial statements, they are already audited or either they were reviewed, and where there is a modified opinion or emphasis of matter paragraph. That SJS, acquirer company financial statements, acquiry company financial statements, we use those two financials. That is called as unadjusted financial information in this standard. In this standard, we call them as unadjusted information. On that, we apply pro forma. Now, on the unadjusted financial information, nothing but the financial statements of independent these companies. Some modified report is there. Modified opinion is given or emphasis of matter paragraph is given. So consider, think whether that reference has to be given in the report that you are giving on pro forma financial information. So you are giving a report on pro forma. Should I include emphasis of matter paragraph, modified opinion, which is included in acquirer company financial statements, acquiry company financial? So just check about it. Suppose no, our entity means what? selling buying company, responsible party. Suppose if the entity historical financials, so they were never audited, yes or no, determine whether practitioner can gain sufficient, the financial statements, unadjusted financial information is there, right, which is extracted from the financial statements of the acquirer company. That acquirer company financial statements were not audited. In such a case, see whether you can gain sufficient understanding of the financial reporting framework. See whether that whether that financial statements are reliable or not, whether that statement information is reliable or not. Same way, sir, acquiry is there, their financials were not audited. Same, see whether financial reporting practices, will you get an understanding or not, check out. And finally, enter into an agreement. So finally, once you concluded, what you need to conclude, whether you have a competence, whether criteria suitable or not, whether audited financial statements contains any modified report or modified opinion, whether they were not audited. So after considering all that, get an enter into an agreement. If applicable criteria is not publicly available, see that this is adequately disclosed, and confirm that responsible party is accountable. Responsible party is responsible for compiling pro forma based on criteria. And not only that, responsible party should give me access. They should give me access to what? Access to all the documents, additional information, access to the entity, nothing but acquirer company staff. Not only that, access to, if required, access to individuals within the selling company in a business opening combination. So these are the rights of the practitioner. Sometimes in exam they'll ask you the 7th point alone of a 4 marks question, when while accepting an engagement to report on pro forma financial information, the practitioner has to agree with the responsible party on few things. What are the various terms on which practitioner has to accept these points? That's it. Next, finally, once you accepted the audit, once you accepted the engagement to report on pro forma financial information, what is the work that you need to do? Planning and performing of an audit. The practitioner must assess whether applicable criteria is suitable, and see that pro forma information is compiled in all respects based on criteria or not. How responsible party compiled, check out. Sources, get an evidence about from where the unadjusted financial information is extracted. Suppose if there is no audit report is existing on the source, perform procedures to confirm the information is right or not, appropriateness. Ensure responsible party has properly extracted, get an evidence on appropriateness of pro forma adjustments. I told you, pro forma financial information is nothing but what? Pro forma financial information is nothing but what? Unadjusted financial information. Unadjusted financial information plus pro forma adjustment. Unadjusted financial information is what? Acquirer financial statements, acquiree financial statements. Yes or no? This is unadjusted. So now what are they saying? Get an evidence on the appropriateness of source, whether the source is reliable or not. Check. Appropriateness means what? Reliability and relevance. Appropriateness means what? Reliability and relevance. Meaning, if no report, for example, on this there is no audit report exist, see that, perform some audit procedures to confirm its appropriateness. See that information is correctly extracted, and see that adjustments are properly done. See that adjustments are properly done, then only pro forma financial information will be proper. That's it. I hope this particular formula will give you a clear clarity on understanding that. Next, pro forma adjustments. Pro forma adjustment means what? Sir, what is a pro forma adjustment? This is an adjustment to unadjusted financial information, which includes adjustments illustrating impact of event or transaction as if it occurred at an earlier date, ensuring consistency with applicable financial reporting framework and accounting policies. Presentation, evaluate presentation and review other information. Suppose pro forma financial information is included in prospectus. Prospectus contains some other information. 720 procedure you should apply. Yes or no? Practitioner must review other information in the prospectus to identify any material inconsistency. So in the prospectus, other information is there, right? That other information, is it inconsistent with the pro forma information? Identify that and then address 720 procedure. Do 720 procedure accordingly. Next, I hope you are clear, able to get clarity. Yes. Next. Yeah, I think perfect. Yeah. Finally, you must get a written representation. What representation? Generally, what representation we get? A responsible party. practitioner shall require representation from responsible party. Responsible party shall give representation that they identified all pro forma adjustments. They identified all adjustments and adjusted all whatever is required, and which will illustrate the impact of a significant event or transaction as if that event or transaction happened at an earlier date. Pro forma information, compliance with criteria, that too. Responsible party has to give one more. They need to mention that pro forma information is compiled based on applicable criteria. See that all adjustments are done, and see that pro forma information is compiled using these adjustments based on applicable criteria. That's it. Finally, you will give opinion. Generally, we give unmodified opinion. When do we give unmodified opinion? Pro forma information is compiled. Pro forma information is prepared in accordance with applicable criteria. Then we generally give unmodified opinion. Suppose if pro forma information does not meet applicable criteria, if pro forma information is not prepared based on applicable criteria, so issued pro forma information does not meet applicable criteria in all material respects. Suppose if at all it does not prepare, then you will give modified opinion. Generally, generally law or regulation, if at all they allow modified opinion, then you give modified opinion as per 705 framework you will follow. Then suppose you want to give modified opinion, but SEBI does not allow. SEBI clearly prohibits that a pro forma financial information report shall contain only unmodified opinion. Modified opinion is not permitted. But mistakes are there. In the pro forma information is not prepared as per applicable criteria, I can give modified opinion. In such a case, ask the party to make necessary changes. Ask the responsible party, responsible party, your pro forma information is misleading. Please make changes. They are not making changes. Withdraw from the engagement, because you are supposed to give modified opinion, and the lawyer is not allowing you to give a modified opinion. He is not amending it. So withdraw or take a legal advice. That's it. Now, can I give emphasis of matter paragraph? Yes. A practitioner can also include emphasis of matter para to highlight significant issue fundamental to the user's understanding of pro forma. The paragraph must only refer to matter clearly disclosed. The practitioner must obtain sufficient proper evidence that it does not affect the all that. Remember, emphasis of matter paragraph can be used to refer to any matter which is disclosed in pro forma information. In pro forma financials, some important points for that. I can highlight it in emphasis of matter paragraph. That is one. Two, when I can use emphasis of matter paragraph, condition provided the matter does not affect the nothing but the matter is not materially misstated. Very simple. The matter is not materially misstated. And finally, the report. So in the report, you need to mention a statement. You need to mention some statements. Statement that engagement was performed as per 3420. Statement that it's a reasonable assurance engagement and involves procedures to assess whether applicable criteria provide reasonable basis. Reasonable assurance engagement involves where we are performing some procedures to identify whether applicable criteria is reasonable or not, and the related pro forma adjustments are appropriate or not. Whatever the procedures, generally what procedures we perform to get this reasonable assurance? The procedures that we perform depends upon nature of the entity, type of event or transaction, engagement circumstances. So there is no specific procedure to be performed. It depends upon the circumstance of the engagement. And you need to, how the opinion, the pro forma information has been compiled on the basis of applicable criteria. The pro forma information has been compiled based on the compiled on the basis stated, and documentation. That's it. You see, opinion comes somewhere at the last. In entire 3000 series and 2000 series, opinion section will come somewhere at the last of the report, because these standards were not yet updated. They were all issued before 2016. Before 2017 they were issued. That's it. So with this 3420 is also completed. I think I have finished it within 40 minutes. Yeah, very good. That's it. So with this 3420 and 3000 both were completed. I hope you have thoroughly enjoyed this particular revision. Wait for the next revision. I'll come back with the next revision. Okay, 402 3402 will start. Thank you. Perfect. I hope you're all clear now. Yes. Yeah. So let's proceed discussion of two important standards, 402 and 3402. Even in the last November exam, every exam you see, many a times a question will come from this particular standards, any of these two standards. Okay. Sometimes both can also be tested if you're lucky enough. Now, 402 and 3402. First, pay attention to the heading carefully. 402, audit considerations. relating to an entity using service organization. We are conducting audit of an enterprise, an entity, and that entity is using service organization services. At that time, what we need to consider specifically, that is what 402 is talking about. Means 402 is talking about auditor of the user entity. 3402, assurance report on controls at service organization. So this is a different standard. Again, there is a service organization, inside that there are some controls on that assurance report, that is 3402. Now in this particular standard, there are the terms, these are the terms which are very confusing for many. I made it in a simplest way to give you a brief idea about what exactly the terms are talking about. Now, before I discuss about this, I want to give you one example here. Suppose my company is a manufacturing company. I am a manufacturing company. For example, we are manufacturing, best example which I have taken in class, HUL, Hindustan Unilever, which is manufacturing many cosmetics and all. Now, they had a tie-up with Amazon warehouse. Nothing but Amazon e-marketplace, e-commerce operator is there, right? So with them they have a tie-up. Now what is the tie-up? In the Amazon, this HUL will list all their products and all. This Amazon, HUL, Hindustan, this company, nothing but user entity we call. Amazon warehouse is nothing but service organization. Now Hindustan Unilever will maintain majority of their inventory which they manufacture in Amazon warehouse. This company inventory, some 70-80% of the company inventory is completely sold through online, directly through Amazon website. Now every time when Amazon receives an order, this company will send goods to Amazon will deliver to the customer. Why entire this process? Amazon told one option, we have a warehouse, you please keep all the goods manufactured in this warehouse, so the Hindustan Unilever can reduce warehouse cost. Fine. So Hindustan Unilever, whatever goods that they are manufacturing, they are storing it with Amazon. Inventory lying with third party, 501. That standard you can apply here. And not only that, 3402 also, 402 standard can also be applied here. What is 402 says about? Now Hindustan Unilever inventory is lying with Amazon. Now Amazon is maintaining inventory records completely, inflow, outflow, everything. And Amazon warehouse will periodically send Hindustan Unilever stock statements. They will periodically send stock statements. Based on these stock statement, Hindustan Unilever in the balance sheet valuation will be done. That's it. This is the entire the arrangement between Amazon warehouse and Hindustan Unilever. Suppose now I am doing audit of HUL. Getting it? I am doing audit of HUL. For me, 402 standard will apply. Now 3402. Now this Amazon warehouse is maintaining inventory records, inventory of various third parties. One of the third parties our client, Hindustan Unilever. Now we want to know, as an auditor, we want to know whether Amazon is maintaining proper inventory records, whether Amazon is maintaining proper internal controls on the inventory. We want to know. Now we want to visit the Amazon warehouse. Amazon warehouse is not permitting us. Sir, Amazon warehouse told, sir, like you, there are many other vendors, sir. Hindustan Unilever is there, some other companies there, X companies there, Y companies there. Their auditors also want to visit me. I cannot permit every one of you to visit and check. When will I do business? Amazon warehouse replied that. So, but we want to know, we as an auditors of Hindustan Unilever want to know whether Hindustan Unilever inventory is properly safe or not with the Amazon warehouse. We want to know. For that, what Amazon warehouse did, they appointed one special auditor called service auditor. They appointed an auditor called service auditor. He will give a report. He will give a report called SOC report, systems and organization control report, which is also called as type 1 report and type 2 report. The service auditor will give either type 1 or type 2. Okay, he will give some report, sir. So what report? He will give a report on controls maintained at Amazon. Controls maintained at Amazon warehouse, where these controls will affect various user entities, third parties. So controls maintained at Amazon warehouse, are they proper? Are they designed correctly or not? So whether user entity, financial items and all, whether Amazon is protecting correctly or not, this auditor will verify and then give a report to you. Now user auditor using these reports, Getting it? 402 standard will apply. Now service auditor is appointed, right? He should give type 1 report, type 2 report, right? How to give this type 1 report, type 2 report? What service auditor has to do? What is his responsibility? That is covered under 3402 standard. If any of you understand this example, that's it. Standard is done. Typically speaking, the standard is done. This example, if you don't understand and read blindly the standard without understanding the background, there is no point of reading that standard. Now that's about the standard. I hope you are able to understand clearly. Fine. Yeah. Now let's look at. Now there are some keywords which are involved in this particular topic. 402 and 3402. There are some keywords. Like, what are the keywords exactly? Just a minute. Yeah, what are the keywords exactly? Control set service organization, because SA 402, considerations relating to an entity using service organization, audit report on control set service organization. You see, control set service organization, what does it mean? Control set service organization means what? Control description. There is a word called control description, and control objectives and related controls. What is it? Another word, control objectives and related controls. Hindustan Unilever auditor want to know whether controls implemented at Amazon warehouse, are they proper or not? Now for that, what I want to know first, what controls they implemented? That is control description. Why is that control? That is control objective. What exactly they implemented? Related controls. These 2 points will be called as description of system. This is called as what? Description of system. You know, assurance report he will give, right? Service auditor will give assurance report, right? Assurance report on description of system. Just like description of system is like financial statements. In normal financial statement audit, we will give audit report on financial statements, right? But here we will give assurance report on description of system. Description of system means what? What control they implemented, what are the objectives, what processes exactly implemented. That is called related controls. Now in the standard, they will talk about 2 types of reports, type 1 report and type 2 report. What is type 1 report? Type 1 report is a report on both, by the way, there are 2 types of report, type 1 report and type 2. Both are regarding reasonable assurance only. In both the reports, we will provide reasonable assurance only. Who will provide? 3402. Service auditor will give type 1 report, type 2 report. Service auditor will give this report. Okay. What he will give? Service auditor will give reasonable assurance on whether on the description of system, as well as he will give a reasonable assurance on whether controls, like they have given objectives and controls, right? Whether these objectives and controls, are they suitable? What control we implemented, is it suitable for the objective or not? Yeah, so suitability of the controls to meet control objectives. Getting it? So we will give a report on description of the system, suitability of the controls to meet control objectives. If at all we are giving report on what description of the system, whether system is described correctly or not, and whether the controls are suitably implemented or not, if at all we are only talking about these 2, that at a particular date we are talking about, then that's a type 1 report. Suppose we are talking about description of system, we are talking about suitability of controls, we are also talking about operating effectiveness of the control. You see, here we are only talking about what system is described, whether it is suitable or not. Suppose we are also talking about operating effectiveness, and where in the report what controls they tested. How do we know whether a control is operating effectively? Service auditor will do testing. Under 3402, whether a control is operating correctly or not, whether a control is operating effectively or not, service auditor will do something called testing. So the testing related information, reporting on operating effectiveness, reporting on test of controls performed, if entire this is covered in a report, then that report is called as type 2 report. This is called SOC2 audit. We also call this as SOC2 audit, where when we are giving type 2 report, we don't give report on a specified date. We generally give the report throughout the specified period. Generally type 2 reports are given for throughout the period, whether controls are operating effectively throughout the period. Then you will also talk about test of controls throughout the period. Generally in our EO class and all, we discuss about real reports. We take some reports and then discuss all that. But now this is a revision class before exam, that too we don't have that much time. We have to revise quickly. Okay, that's it. I hope you are able to understand. Now let me directly first discuss 3402, then we'll go to 402. 3402, assurance report on controls at service organization. Okay, what is this assurance report? Here Amazon has appointed one separate auditor, service auditor. He may be the statutory auditor, he may not be statutory, that doesn't matter. Okay, Amazon has appointed one service auditor. Now that service auditor has to give a report on controls implemented at Amazon, nothing but controls implemented at service organization, which will affect user entity financial reporting. These controls will affect user entity financial reporting. Suppose if Amazon is not maintaining inventory records correctly, if the controls of inventory are not correctly done, then reporting of inventory details to the user entity will be wrong. If reporting of information is wrong, user entity financial statements might be materially misstated. So that's it. So here, so that's why Amazon appointed one service auditor. Dear service auditor, we implemented controls on inventory belonging to third parties. Whether these controls are operating effectively, whether the controls that we implemented, what controls we implemented, we developed a document. So on that, please give a report. That's what exactly Amazon is asking the service auditor. Now this SCA is applicable. Now this SCA is applies only if service organization is responsible, for making assertion about, okay, it's okay, I think that applicability is not a big deal. Non-applicability is most important. Non-applicability, what is it? Suppose Amazon appointed one auditor. Sir, we have so many controls in our organization. Please come and report on operating effectiveness of controls. You please come and check our controls and give a report. Where this report is used by Amazon only. Suppose if Amazon, Amazon appointed auditor and the auditor is giving a report on controls, the user is also Amazon only. This standard does not apply. When the standard is applicable, Amazon appointed service auditor, where he will give a report on controls. That report will be forwarded to third parties. We call them as user entities. Then only the standard is applicable. Where user auditor has to only report whether service organization controls are operated as described. Whatever controls Amazon described, whether are they operated as per the Amazon description or not. If at all, he just have to report on that. Where the report is not given to any user auditors, user entities and all, this standard does not apply. Or where this standard does not apply, where the user auditor has to report only on controls at service organization unrelated to financial reporting of user entities. Yes. No. Where you are giving a report on controls at Amazon, service auditor is appointed, where he is giving a report on Amazon. Okay, Amazon related some controls. These controls are unrelated to user entities. Then also this standard does not apply. Indirectly, when this standard is applicable, this standard is applicable when service organization appointed auditor, where he is reporting on controls, getting it, where that report is related to user entities, where that report is used by user entities and their auditors. 3402 will apply only when 402 point of view user entity auditor is asking this report. In that context only 3402 engagement will apply. Suppose if a company voluntarily appointed one auditor, service auditor, okay, one auditor. First of all, we will call him as service auditor only when 3402 standard applies. Suppose a company appointed an auditor voluntarily. Sir, please check all our controls in our organization, give a report. Compliance auditor they appointed, for example, where he has to check the controls and then give a report, compliance report. Where we are not giving this report to any third party and all, this standard does not apply. That's it. Very important applicability of the standard. MCQs they might be asking. Now, who is a service organization? Service organization is a third party organization which is providing services to user entity. Amazon warehouse is providing services to Hindustan Unilever. User entity is what? Who is using services of service organization? Hindustan Unilever is maintaining their entire inventory at Amazon warehouse. So Hindustan Unilever is a service organization. Now, why controls at service organization are important? Why controls at service organization? Now, Amazon is implementing so many controls relating to inventory. Why are they important to user entity? Very simple. The controls which are inventory related controls, if these controls are not functional, if they are not functioning properly, or if the controls are not correctly implemented, if the control design is inadequate, suitability is not proper, control is not proper, it will result into reporting of wrong inventory. Reporting of wrong inventory to user entity will affect their financial statements, material misstatement. Yeah. So, impact. Controls at service organization may be relevant to user entity financial reporting, as these controls sometimes may relate to presentation, disclosure and auditing evidence. So, that's it. Here we have given some example called payroll example. You can also see that payroll example. Okay, scope of the controls at service organization under 3402. What is the scope of the control? Controls includes controls over user entity information system maintained by service organization. Amazon is maintaining an information system, inventory records, which is relevant to user entity. Yes or no? So that is only included in the scope of control, and other internal control component at service organization related to this. Controls related to description of system of relevant. However, remember, controls of service organization for their own preparation and presentation of financial statements are not relevant in this standard. Even Amazon is preparing financial statements. For that reason, they have some financial controls and all. That is not relevant in the standard. In the standard, which controls are relevant? Service auditor. Which controls are relevant for the service auditor? Those controls which are influencing user entity information system, user entity financial reporting. If that is affected because of the controls of service organization, those controls are relevant for the service auditor. Now ultimately, remember, which control is relevant in the service organization? There are so many controls. Some controls are for their personal purpose, service organization. Some controls are user entity related. Now, which controls are relevant for the service auditor, which is not relevant, is a matter of professional judgment. That's it. User auditor means the auditor who audits and reports on the Hindustan Unilever user entity. Service auditor is a professional accountant. He is a professional accountant in public practice. He is a professional accountant in public practice who, at the request of service organization, provides an assurance report on its control. Service organization requested the auditor to give a report on controls at service organization, and that report is forwarded to user entity. For that reason, we are appointing that auditor is called a service auditor. What is his objective? Very simple. His objective: ensure that service organization system and controls, they are fairly presented. Like verify, you need to verify whether service organization description of its system, service organization prepared one description of system, that system is forwarded to Hindustan Unilever, whether the description of the system is it presenting design and implementation throughout the period or at specified date in a type 1 report. And you need to assess one more responsibility of service auditor. Service auditor has first responsibility whether description of system is fairly representing the actual system implemented. 2, whether the controls related to control objectives were they suitably designed throughout the specified period, whether control objectives and the actual controls implemented, are they suitable or not, we need to check. Further, in case of a type 2 report, most of the service organization, they will go for type 2 audit, type 2 report only. They don't go for type 1 report. In reality, you rarely find type 1 report, you only find type 2 generally. Okay, if included, determine whether controls operated effectively to achieve control objectives throughout the period. So every process will have some objective. See, Amazon has implemented so many processes. One process is, for example, only when the goods are actually received and goods are actually delivered, inventory record will be updated. Because of this particular process, inventory record quantity accuracy can be maintained. If quantity accurately is there, automatically financial reporting will be accurate. So this is the control objectives. Getting it? And where service auditor will provide a report based on service auditor's findings in accordance with these objectives. So objectives are 3: verify description of the system, verify whether control objectives are suitably designed, and third one, in case of type 2 report, whether they are operated effectively, and finally you need to provide a report. So accordingly, there are 2 types of reports, assurance reports. There are 2 types of assurance reports which a service auditor will provide: type 1 report, type 2 report. Type 1 report is what? First of all, service organization description. First of all, there is a description of system. There is a document which talks about what exactly the system implemented, and a written assertion by service organization. Service organization will give written representation in the description. What written representation? They will say that description is presenting the real system implemented and controls are suitably designed at a specified date. Service organization is giving one document inside that what controls they implemented, what controls they have designed, what controls they have implemented, whether they're suitable or not. They're giving all those descriptions. Getting it? And we, service auditor, now what service audit, what is type 1 report? Type 1 report is service auditor report. This is actually type 1 report, this is type 2 report. This is about the report. Okay, what is type 1 report? Type 1 report is a service auditor's assurance report about reasonable assurance about matters covered in. So I will read service organization management description letter document, all that. Whatever I read, no, is it real or not, I will verify, and then I will give a type 1 report. Now, whereas in a type 2 report, no, service organization management, no, they will also mention that they will in written they will assert that controls are operating effectively throughout the period. So service organization management is saying controls are operating effectively. I need to give a report on the description. So for that, what I will do, I will give reasonable assurance, and I will also do test of controls. in order to know whether controls are operating effectively or not. So accordingly, type 2 report will contain description. One more paragraph in the type 2 audit report. In type 2 we will give assurance report, right? Let's use the word assurance report. We will give a type 2 assurance report, right? In that report we will have one more para, the test of controls performed and results thereof. Like that, one more paragraph will be there. Okay, then how do I proceed with this engagement? But before I go into that, let me directly tell you about modified opinion. When service auditor will give a modified opinion, when service auditor will give modified opinion, directly they can ask you this as a 4 marks question. Okay, service auditor will give modified opinion if he concluded that description is not fairly, like what Amazon in reality, what controls they implemented and what they are showing in the description document, they're not matching. Controls were not suitably designed. They designed some controls, but they're not suitable for the objectives, or controls are not operating. If controls are not operating effectively and I'm supposed to give a type 2 report, then also I will give a modified opinion. Or I am unable to obtain sufficient appropriate audit evidence. If service auditor is unable to obtain evidence, then also we will give modified opinion. Then the service auditor opinion shall be modified and assurance report must clearly explain the reasons. Further, service auditor has to document. He must prepare documentation where an experienced auditor can understand how you planned the work, what is the result and significant matters. You know, experienced auditor should understand all these three. In such a way, service auditor should document. So straight away, this can be asked as a 4 marks question. Documentation can be asked as a 3 marks question. Next. And I told you, this itself can be asked as a straight question for 4 marks. Write about additional reporting requirements in case of type 2 report. Generally in a type 2 report, no, there will be another section, separate section on control testing. In type 2 report, title will be there, address will be there, you know, identification of controls, so much will be there. You know, opinion section will be there. Apart from that, there will be another separate side heading. Okay, that side heading will be test of controls performed and the results. Here you need to clearly state which controls tested, whether testing is on a sample basis 100%, what kind of testing you did, you know, and you should also report deviations. If deviations are identified, specify the sample size and what deviations exactly, describe that. Even if the control objectives are achieved, sometimes no deviations will be there. What control they implemented, that control might not be working effectively, some deviation might be there, but because of this there is no MMS, because of this there is no fraud, because of this there is no error. Even if there is no error or fraud, control is deviated, right? Control is not operating effectively, right? That has to be reported. That's it. So these are the additional reporting requirements, which itself can be asked as a straight question. Then this is regarding service auditors assurance report. This is not a big deal, so this is not required. It's okay. I think in this there is nothing important. By the way, date of service auditor report, it must not be earlier than the date when service auditor has obtained sufficient appropriate evidence. That's okay. That's a normal thing. It's okay, no issue. So that is not important. Further, representation point, most important, straight away 4 marks question. You know, when a service auditor is conducting, you know, when a service auditor is providing assurance on controls at service organization, in the process of that work, service auditor should obtain some written representations. What are they? Obtain written representations from a service organization stating, reaffirm the assertion regarding description of the system. The described system, no, get once again a representation that the system description is correct or not. Further, you should get a representation that all relevant information is given to you. Further, you need to get a representation that management has disclosed the service auditor. Service auditor is asking declaration from company. Dear company, give a declaration that you showed everything to me. What exactly? Non-compliances, frauds, deviations which will impact user entity, because my report is being used by user entity. So you have a responsibility to show me what are all non-compliances you did. You know, design deficiencies in controls which management is aware of. Instances where control fail, where and all control fail, when and all control fail. They will have a list of control failures, exceptions reports that they need to disclose. Subsequent events that could impact assurance report. For all of this, I must specifically obtain written representation from management of service organization. This is important question. Then, now, Acceptance and changes in terms of engagement. This is most important, another important question in this particular standard. So how can I proceed with this engagement? First, service auditor, no, whenever a company requested you, a service organization requested you to act as a service auditor, immediately you should not accept blindly. SQC says you should check competence and capability. That's what once again here they highlighted. The service auditor must ensure capability and competence before accepting. Verify criteria used to describe the system. Some COSO framework, COCO framework, COBIT framework, some framework company will use for controls related description preparation. Okay, so whether the criteria prepared for, whether the criteria followed by the management of service organization to prepare description of system, is it suitable and available for user entities and user auditors? Check out and see that the engagement scope and system description of useful, like service organization is appointing me to do audit of some controls, right? Whether these controls are relevant to user entities, check out. If service organization requests a scope change, suppose now after you were appointed, they are asking you to change the scope, see whether it is reasonably justification is there or not. So very important. So criteria, it's okay, I think that is enough. That's enough. Okay, so these 2 points are important. That's it. 3402 standard is completely done. That's it. Very simple. The standard is very simple. I don't know how many of you thought it's so complex, so much is there. No, it's very simple. Now having understood 3402, now we'll go back to 402 standard. Okay, 402. Now 402 is a little more complex compared to 3402. Now look at this 402. Just 1 minute. I hope you're now you got now little clarity on what exactly 3402 is about. Just comment, just give your comments. I'll be happy to see whether you are understanding properly or not. Whatever questions I'm touching, wherever I'm saying that this can be asked as a 4 marks question or 3 marks question, 2 marks question, if you're studying that confidently, if you're revising that confidently, sufficient. Very tough standards actually. 402, content is simple, but the terminology used is very tough in the standard. 402, audit considerations relating to an entity using service organization. Fine. So now I am the auditor of HUL. I want to ask, Amazon, dear Amazon, our HUL inventory so much is there with you. I want to come and physically verify. For that, Amazon told me, sir, you can't come physically, sir. We have so many third parties like you. If everybody comes physically, how Amazon will do business? Fine, that their concern is right. But I want to know, as a HUL auditor, my inventory is there with the Amazon, whether the inventory is maintained in a proper good condition, existence and condition proper or not, whether quantities maintained properly, because records are maintained by them. I want to know whether they're maintained properly. For that, what Amazon told, sir, don't worry, we will give you type 1 report, type 2 report. What is type 1 report, type 2 report? Sir, don't worry, you are the HUL auditor, right? You want to know whether our inventory records are maintained correctly, whether your inventory records are maintained correctly here or not, you want to know, right? For that, we appointed one auditor, sir. He already gave a report on whether we are maintaining reports correctly or not. I will forward that report to you. The service organization is forwarding me type 1 or type 2 report. Now in this context, what is my responsibility exactly? What are all I need to consider? That's what 402 standard is talking about. Now if you see in this diagram, description of system, you see description of system, it includes complementary user entity controls. There is something called complementary user entity controls. What is complementary user entity controls? See, whenever our company Hindustan Unilever, whenever we are outsourcing some work to them, we also have to maintain some records, right? Regarding whatever we are outsourcing there, some incidental records and all we need to maintain. So for that, we need to implement some controls, right? These controls are called as complementary user entity controls. Complementary user entity controls are controls implemented by user entity, which is assumed by service organizations things we implemented, and accordingly they will plan their services. Sometimes they are correct, but if user entity controls, complementary user entity controls, if they are not implemented effectively, misstatement will happen in financial statements because of our client only. Now you need to check, you need to know, I mean, sometimes 315 standard says we have to verify operating effectiveness of our controls as well as service organization controls. That time complementary user entity controls, are they operating effectively or not, also we have to know. Next, fine, I'll come back to it. Now tell me, services provided by service organization, are they relevant to user entity financials? Yes, they are relevant. When they're relevant, a service organization services affect user entity financial reporting if they impact any of the following. if at all service or Amazon is providing me services, right? Some services they are providing to HUL, right? If at all those services impact some transactions in the HUL, getting it, or if they're impacting procedures where accounting is affected, or if they are impacting accounting records, or if they're impacting events and conditions related to financial statements, or they're impacting financial reporting process, or they're impacting journal entries, non-recurring entries, unusual entries, in all these cases services are deemed to be relevant to user entity, user auditor. Straight away a 4 marks question. What are the factors the auditor has to consider to identify whether service organization services affect user entity financial reporting? Service organization services, they are affecting user entity financial reporting, then only those services I am bothered as a user auditor. That's it. So objectives of the user auditor here, types of service auditor report, exactly I already spoke. Type 2 report, type 1 report. Type 1 report is what? It's a report by service auditor where he is providing reasonable assurance including opinion on description of the system, objectives and related control, suitability on a specified date. Whereas in a type 2 report, it's a report by service auditor giving reasonable assurance on opinion on the description of system, control objectives, suitability, operating effectiveness. Not only that, in a type 2 report additionally operating effectiveness will be there as well as E point. Okay, description of service auditor's test of controls and results will also be there. So in a type 2 report, what test of controls he performed, that will also be mentioned. Then understanding of the services, this was asked in November 24 exam already, but don't think, many of you will think since November 24 it asked, it will not be asked once again. There is no guarantee like that. Okay, so understanding of the services provided by service organization. So as a user auditor, I must understand what kind of services they are providing to me. First, what is the nature of services? Are Hindustan Unilever inventory is maintained in the Amazon warehouse, that inventory physically they are maintaining, records also they are maintaining. So understand the nature of service, understand nature of services, and what is their significance to the user entity, what is their effect on the user entity controls. And this you can get an understanding from this information, you can get from user manuals, service organization and user entity will have some contract, all that. Okay, materiality also understand. Second thing that you should understand is materiality of the transactions processed. Our client Hindustan Unilever inventory balance sheet, 40% of the balance sheet asset total value is inventory. Inside this inventory 90% of the inventory is with the third party. So what is the materiality of the transaction processed by service organization? If the transactions are immaterial, yes or no, they might still be significant due to the nature. Okay, fine. This point is not required from exam point of view. This first point is enough. And then second factor, first understand the nature of services service organization is providing. 2, materiality of the transactions affected by services provided by service organization. 3, degree of interaction. Understand the degree of interaction between the user entity and service auditor. Generally, how this refers to how much control the user entity has over service organization processing, how far we are influencing, how far they are influencing. Relationship, also understand, is there any relationship between HUL and Amazon warehouse? Are they related parties? Identify. Understand the relationship between user entity and service organization, like look at the contractual terms and conditions, look at what services they are providing, see whether there is a huge dependence or not. Try to identify any related party relationship is there or not. If related parties, no, 550 standard also will apply. Next, then see, obtaining an understanding of internal control relevant to audit. Generally, whenever we are doing audit, no, whatever internal control relevant to audit, we must obtain understanding. This is what mentioned in 315 standard. Yes or no? So the user auditor evaluate, design and implementation of relevant controls at user entities. So that is our responsibility. But some transactions are processed by service organization. Related to that, controls are also maintained at service organization. Therefore, I need to understand controls at service organization. Since I want to understand controls at service organization, I am taking type 1 and type 2 report. Simple as such. Okay, so the user auditor get a sufficient understanding of nature and significance of services provided by service organization, what is their effect on the user entity internal control, what exactly the nature of service provided by them, what is their impact on the user entity internal control. Get an understanding. Sometimes we are unable to obtain understanding from the user entity. When I'm interacting with user entity, they are unable to explain me clearly what exactly they're doing. In such a case, I will directly ask type 1 type 2 report, obtain type 1 type 2 report. Suppose type 1 type 2 report service organization does not prepare, or they're not sending me, then I will contact organization through the user entity to obtain necessary information. If at all still I'm not getting information, then I will visit the service organization, and perform procedures to gather necessary, or I will send another auditor to provide necessary information. I will use another auditor and send him there, ask him to get the entire information and then send it back to me. So this itself can be asked as a 4 marks question. Wherever I'm telling marks can be asked, that only is important. This itself can be unable. If user auditor cannot obtain sufficient understanding from user entity regarding services provided by service organization, then user auditor can request type 1 type 2 report. If type 1 type 2 report is not there, contact the service organization. If they're not responding, visit the service organization. If you don't have time to visit, or if it is difficult for you to visit, it is there at a very remote location, arrange another auditor there to visit service organization. Any of this can be done. Then okay sir, type 1 type 2 report they gave, sir. Type 1 and type 2 reports by user auditor of user entity using type 1 report or type 2 report. So when you're getting type 1, no, first before start reading it, type 1 report, type 2 report is given by service auditor, right? Who is he? Is he a chartered accountant like you? Is he also competent professionally? The service auditor's competence check out. What is his independence check out? Is this guy independent from the service organization? Amazon appointed service auditor. What is the relation between them? If they are unrelated to each other, then that report I will trust. Adequacy of standards. Service auditor gave type 1 type 2 report, right? By following which standards he conducted that work, check out. He also followed 3402, then happy, you will trust it. And if auditor is decided, okay fine, I first decided service auditor's professional competence, independence, capability, competence, standards, all that. I felt he's very genuine. Now I decided to use his report. Then I will evaluate whether description and design of controls is as at a particular date or is it for a particular period. Is it relevant for the audit? Okay. So now service audit report is there. Amazon has given type 1 type 2 report. I am doing audit for 24-25 financial year. Amazon, he has given type 1 type 2 report of 21-22, 3 years back report. That is not relevant for me. So evaluate whether description and design of controls is for a date or period. Whatever the date, for whatever the period type 1 type 2 report is given, no, is it appropriate for our audit? Check out. Okay, there is a in 315 there is a requirement. Once in 3 years we have to do an ad hoc complete review of internal control system. It's already more than 3 years. Type 1 type 2 reports were older than 3 years, may not be useful for me. Next, assess sufficiency, appropriateness of evidence provided by the report, all that. Then complementary user entity controls. No, suppose I'm the auditor of HCL, no, I identified complementary user entity controls. If that is the case, you need to check whether user entity has designed and implemented complementary user entity controls. What is a complementary user entity controls? This itself can be asked as a 3 marks question. These are the controls which service organization assumes. Service organization assumes. What they assume? They assume that we implemented. Okay, that will be implemented by user entity to achieve control objectives, and they are identified by the service organization description of the system. Fine. Finally, responding to the assessed risk of MMS in relation to services provided by service. Whether check if sufficient appropriate evidence is available from the records held at user entity. If not, perform additional procedure to obtain necessary information. If user auditors risk assessment expect that controls a service organization is operating effectively, actually this is not that required. It's okay. This is bit tough. If at all those of you have not studied, leave it. It's okay. No problem. Using a type 2 report as auditors. This was also asked many times, a 4 marks question. When user auditor decided to use type 2 audit report, type 2 report as an auditor, what extra points you should consider? Assess whether description of the system, design of the system, operating effectiveness of, is it for a particular date or is it for a particular period appropriate for the audit. In type 1 also we have seen similar point. So type 2 report they have given, no, when the type 2 report is prepared, for what period it was addressing, is that period, is that date relevant for my audit? Suppose if the type 2 report is very old report, I may not use it. Next, complementary. The user auditor must determine whether complementary user entity controls are identified by service organization. Are they relevant? If so, understand whether user entity has designed and implemented the control. If required, test the operating effectiveness. So when you're using type 2 reports, these are the type 2 report talks about controls implemented by service organization at service organization. Now in the description document, no, complementary user entity controls also they spoke about. Oh, our client also has to implement some controls relating to this outsourcing activity. Whether these controls are operating effectively or or not also you should check. So when you're using a type 2 report, first to look at when that report is belonging to. Is that report appropriate for my audit, relevant for my audit? Two, if complementary user entity controls are also there, see whether they are operating effectively or not. And the user auditor must evaluate the time period covered by test of controls and time lapsed since the last testing. This type 2 report talks about some test of controls where when they tested long ago, see whether the test can be relied or not. And the user auditor must assess whether test of controls performed by service auditor and the results are they relevant to the assertions in the user entity financials. So by the way, I'm talking about inventory. So and the service auditor has also performed some test of controls on inventory. Are they relevant or not? Check out. Then suppose no, you identified, okay, so user auditor, no, I will ask our management, I will ask our client HUL, dear HUL, did service organization reported you any material misstatement in inventory records, any non-compliance with loss, any uncorrected misstatements, any frauds? Remember a similar thing, service auditor also will get a written representation from service organization that any frauds, non-compliances, MS, all that. Yes or no? Here user auditor will ask user organization, user auditor will ask user entity, dear user entity, did service organization intimated you any frauds, any non-compliances, any material misstatement? Please give me. And the user auditor must assess how such matters affect nature, timing of further audit procedure. Finally, this is very important. You know, regarding this, one exceptional question is there. In your ICI, test your knowledge question number 13 is added. Inside this, what happened, you know, the type 2 report was provided by service organization, which was based on carve-out method. That method and all irrelevant, okay? Akram, while reviewing unmodified report, or you see this one, unmodified report drafted by his assistant, found that a reference has been made to the work by service auditor. Oh, we are the user auditor, right? We are giving audit. We are giving opinion on Fab Limited. You know, we are the auditors of Fab Limited. On Fab Limited, our audit firm decided to give unmodified opinion. And assistant already prepared the audit report with unmodified opinion. Inside that, service auditor name is given. Not permitted. You see now, you know, suppose no, after doing all this, no, in which context, services of service organization our client is using, no, on inventory related thing, on inventory, we decided unmodified opinion is required, enough. We decided to give a positive opinion, unmodified opinion. In such a case, in audit report, can I talk about service auditor, service organization, all that? No, prohibited. The user auditor should not refer to the work of service auditor if audit report is unmodified unless mandatory in law. If required, the report must clarify. Suppose no, sir, law says it is mandatory, sir. That's why we are reporting, sir. If at all you are talking about service auditor, your report clearly state that reference will not reduce user auditor responsibility. Just because I'm talking about service auditor, that doesn't mean my responsibility is reduced. Ultimately, inventory related controls are operating effectively or not is my responsibility only. Next, suppose no, after using type 2 report, I got to know that inventory records are materially misstated. To that extent, financial statements are materially misstated on inventory. I requested management to rectify inventory valuation. They did not. So I decided to give modified opinion on inventory. Now I have to explain in basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Why I gave a modified opinion, I have to give reasons. No. To make the people understand the reason behind my modification, I can refer about type 1, type 2 report, service audit report, all that. Again, just because you are referring in basis for modified opinion section regarding service audit report, that does not reduce your responsibility. That fact you should mention. The user auditor must modify the opinion according to 705. If they cannot obtain sufficient appropriate evidence about services provided by service, or you are unable to obtain evidence, then you will modify. Two, if reference to service auditor work is relevant for modification, please clarify that reference does not reduce auditor's responsibility. One, when you are unable to obtain evidence, no, you give modified opinion, or you got an evidence and concluded material mistake, that time also you'll give modified opinion. If reference to service auditor work is relevant, see, you want to tell the people why you modified. I modified because service audit report I could not obtain, or service audit report I obtained, I found a material misstatement based on their report. I want to tell the reason. For explaining reason purpose, you can refer about the service auditor's name, and such a reference will not reduce the user auditor responsibility. Now in this case, you know, on Fab Limited, you know, the auditor is there. Who is the auditor here? Akrama something, yeah, CA Akram. while reviewing unmodified report which is drafted by the assistant found that a reference has been made. Are you are saying unmodified audit report, reference is given to service auditor, all that, that is not correct. Here you see, in the view of the above, contention of Akram in removing reference to work done by service auditor in order, because it's an unmodified, cannot refer to be, yeah, correct. So that is proper. Yes or no? Is in order. Is in order. In order means what? It's proper. That's what they mean to say. So the user auditor shall not refer to work of service auditor in the user auditor's report containing unmodified opinion unless required by law. If at all such a reference is required by law, user auditor shall indicate that reference will not reduce the responsibility of the user auditor. That's it. 402-3402 is completed. 45 minutes it took. It's okay. Fine. I covered decently at least. That's it. This is a newly added question. Here, no, carve out method and all that wordings and all used. Don't get tense. Leave it. Okay. This is regarding reference in the audit report only. This reference in audit report is exactly similar to SA 620 standard. In SA 620, using the work of auditor's expert, can an auditor refer about auditor's expert name in the auditor's report? No need in case of unmodified opinion. But if you are giving modified opinion based on his findings, to tell the people why you give a modified opinion, you can refer about his name. That's it. Are you clear? Ultimately, remember, you are only responsible to obtain, you are only responsible for obtaining evidence on controls at service organization, operating effectiveness, everything is your responsibility, primary responsibility. Okay. But since you are unable to verify that, you are taking type 1, type 2 report, you are using it and then concluding. That's it. Clear? Yeah. So with this, 402-3402 is completed. That's it. I hope you thoroughly enjoyed. Please give your comments if at all you thoroughly enjoy. I mean, you thoroughly understood. I understand. I finished very fast because exam here, getting it. So I tried my level best to bring you some clarity on 402-3402, such a very complex topic. That's it. Yeah. Thank you. So audit of banks. 14th chapter, we have two parts. One is bank audit and the other one is NBFC audit. I'll go with complication. What are all the complicated topics are there in this? That I will cover predominantly. Okay. Now, yes, audit of accounts and appointment of auditor. Most banks, especially nationalized banks and PSU banks, appoint 4 or more firms as statutory central auditors as per RBI guidelines. Okay. Appointment letter has to include the following. Okay. Appointment letter includes the following. What are all appointment letter, for what period you were appointed, details of other joint auditors, nothing but other central auditors, details of previous auditors so that the new auditors can communicate with the previous auditor, procedural requirement for accepting the engagement. So in bank audit, the procedure for acceptance is quite comprehensive. That will be a bit detailed, the procedure. They need to give, auditor has to give fidelity certificate, confidentiality certificate, so many certificates and all statutory audit has to give. So what is the process of accepting the appointment and how the work has to be divided among the joint auditor? All these points will be considered in appointment letter. A 3 marks or 4 marks question might come. Okay. So you were appointed as a bank, you were appointed as a statutory auditor for a bank, and you got an appointment letter. Typically, what are the contents of appointment letter will be included? So like that they may ask you. Next, and auditor will give obviously letter of acceptance. Letter of acceptance includes what and all? A confirmation from auditor that he is not disqualified and how the audit will be conducted, declaration of fidelity and secrecy, restriction on taking other assignments from the bank. These are all the points which statutory auditor will give in the acceptance letter. So this both put together, a 5 marks question can come. Next, what is the authority for appointment of branch auditor? Obviously, for all nationalized banks, board of directors will appoint with RBI approval. For remaining banks, annual general meeting shareholders will appoint. For all private sector banks, shareholders will appoint. Nationalized banks, directors directly can appoint where RBI approval is sufficient. Even in other banks also, RBI approval is mandatory. Okay, but the recommendation, the selection, for selection of auditor, RBI approval, then ultimately in AGM members will approve it. Clear? Then conducting an audit, this is completely irrelevant. Here this you have to, this is important again. Okay, risk assessment in a bank, not this, wait, risk management process in a bank will be there. Yeah, this one, this diagram only. Yes, in exam they'll ask you, once it was asked, write about risk management process. By risk management process, this is nothing but 5 components of internal control. This is nothing but 5 components of internal control: oversight by those charged with governance, identification, measurement and monitoring of risk, control activities, monitoring activities, information system. These are 5 components of internal control. So this is an effective risk management system in a bank. Okay, they'll ask you in exam, write about an effective risk management system. If you write at least headings, you might get 1 or 2 mark. Okay, and you need to write the management, you need to write the matter. For this it is better, I have given a better presentation in chart notes for this. Yeah, you see, understanding this, you see here 5 points. So these one. Okay, so what you need to understand, so board of directors CEO approve a broad risk management policy, and where they need to identify significant risks and they will be measured and monitored. Control activities, directors will implement appropriate control like segregation of duties, accurate reporting, transaction verification, reconciliation controls, limits on cash balances to be held, like that, physical security, contingency planning. All these activities they will be implementing, and they will monitor risk management models and all. They'll be monitoring methodologies and all. They'll be regularly assessed and update if any deficiencies identified. And of course this entire controls, everything will be done through information system. So banks need reliable information system for timely and consistent information. This matter, if you write in exam, that will be maximum sufficient. Understood? So that's it. This will be asked for a 4 marks question. They may ask you, every bank should have an effective risk management processes, risk management system. So what are the components of risk management system? Like that they will ask you 5 components: oversight by top management, control activities, risk assessment process, monitoring activities, reliable information systems. These are 5 components of an effective risk management system in a bank. Clear? Next. Then yeah, special considerations in the IT environment. Obviously bank is completely driven by technology, yes or no? So there is some information that has to be shared with auditor, especially central statutory auditor. A bank, upon appointing central statutory auditor, the bank has to share some crucial information. What information bank has to share? This was even asked in 2021 or 2022 for 4 marks question. Okay, this was asked already. So the bank management has to share with central statutory auditor certain information about IT environment. What? Like bank has to clearly explain overall IT policy and IT structure, what data processing softwares they use, interfaces that they use, data integrity and security policies of the bank, BCP plans and DCP plans. Okay, BCP and DCP plans. The bank has to communicate with auditors. Which auditors? That too, central statutory auditors, principal auditors. And bank must give information about accounting manual, critical accounting entries and their interaction with IT systems, controls over key aspects like account heads, expense booking, all that, controls over internet banking, MIS reports and their periodicity, exception reports and their generation process. This information the central statutory auditors has to be shared. Bank has to share to the central statutory auditors. This itself can be asked as a 4 marks question. Then and what are the key control aspects to be verified by stat auditor? This is again itself can be asked as a 4 marks question. This also asked in the previous exam. This was also asked in 21-20, that years, 2022 also, in 2021-22. In those attempts these questions were asked in old scheme. Okay, but the syllabus is same. Now, what are the key security control aspects to be verified by auditor? Auditor has to ensure that data is authorized, accurate and complete. So complete data, authorized data, accurate data is given for processing. System restarts without distorting when there is an interruption. The system prevents unauthorized amendments. Access controls must match staff responsibilities. Segregation of duties must be implemented. Ensure changes in system parameters are authorized. Verify manual changes are properly accounted for and authorized. Exception reports are verified daily. General ledger and subsidiary ledger balances must match. Ensure account master and balances cannot be altered without a proper authorization. Like how a question can come. You are appointed as a statutory central auditor. What are the key control aspects that you need to verify? 4 marks question. The above one is what? The bank has to share certain information which is crucial IT systems related data that has to be shared with auditor. What bank has to share with auditor? This information bank has to share with auditor. Upon appointment, what are the key control aspects that you should verify? This is something that you should verify. Understood? Next. Then finally, now write about internal controls in certain selected areas in case of a bank. Now, general internal controls in banks, commonly what internal controls? There will be a rotation, staff rotation. Independent checks will be there by another officer. Daily proofing will be there for arithmetical accuracy, like checks and all, bank statement, cash ledgers and all. The daily reconciliations will be done. Bank forms will be there, like DDs, checkbooks. They must be stored securely with a responsible officer. Mail must be opened by responsible officer with a signature verification. Any incoming mail, nothing but couriers which a bank receives, yes or no, it must be opened only by a responsible officer, because most of the banks receive confidential information, branches, regarding customers. Some customers will send some instructions to the banker that should only be opened by authorized person, generally the branch manager. Okay, signature book and telegraphic code shall be kept with responsible officer. There must be insurance against fire, theft and employee infidelity. Okay, defined financial powers for officers, surprise inspections of head office and branches by internal audit department. These are some common general internal controls. 4 marks question they may ask you. Write about general controls in a banking entities. What are common internal controls in a banking entity? You can write this answer. Then specifically for cash, there will be controls, like cash will always be in a joint custody of 2 officers. Okay, daily test checking of cash balance will be there. No access to cashiers to the customer ledger. Cashier should not have access to customer ledger. A practical case study is developed on this in MTPs or somewhere. Some practical case studies there. The cashier opened the customer ledger and all. Below MCQ will be there. Which of the above is wrong? Next, cash receipt vouchers signing must be by proper officer. Payment shall be made only after voucher has been authorized. High value cash transactions must be verified by higher authority. Excess cash must be remitted to currency chest. Treasury branch will be there. To that, the excess cash has to be, every branch will have a cash limit, how much cash they can store in the branch, 2 lakhs or 5 lakhs. Beyond that, if the cash is received, at the end of the day, it has to be transferred to treasury branch. Then check clearing. How checks clearing? There are 2 types of checks: inward check and inward clearing, outward clearing. Best example, if at all the amount, very simple, inward clearing, outward clearing, there's so many definitions, but well accepted simplest definition is what? Inward clearing. If at all the amount is coming into our customer bank account, the amount is coming into our customer bank account, whether it is coming from our own bank account or another bank related customer account, doesn't matter. The amount is coming into our bank books, our customer is being credited with that money, then that is inward clearing. Outward clearing means the amount is going out of our customer bank account. That is called as what? Outward clearing. Now, whether it is inward clearing or outward clearing, generally the checks are processed through something called CTS. This is like a scanner. Okay, so check will be scanned and sent for the clearing house. Okay, and they will take care of the rest of the process. Check clearing, check truncation system is implemented for quicker processing. This eliminates physical checks movement, and the branch has to make a call and confirm with the customer for any checks received. Inward clearing for an amount exceeding 5 lakh and above. Next, verification of signatures on checks. Unpaid checks under outward clearing shall be sent to customer. Next, unpaid checks in outward clearing means what? The check was like dishonored. Okay, all this insufficient balance, whatever. Bills for collection. All documents for bill must be entered in register and sent with the bills. Accounts will be credited only after collection. Then bills purchased. Verify documents of title are assigned to the bank. Bills purchased means obviously what? Bank has already discounted and gave money to the customer. Now the bill is bank right, so title has to be transferred to the bank. Adequate margin is maintained for bills purchase, because bills purchase is a loan given. Yes or no? Bills purchase is nothing but a loan given, so bank will maintain some margin. Immediate recovery steps if at all bills are not collected on due date. Irregular accounts must be reported to head office. Bill purchased and outstanding at year end. For example, I discounted a bill on 20th March, whereas bill maturity date in April month, which means as on 31st March, bill is discounted but outstanding, not because maturity is not yet there, which means the discount has to be apportioned between this financial year and next financial year. Understood? Remember, discount on bill is nothing but an interest. Interest is to be recognized on time basis. It is not based on point of recognition. It is based on time period. Yes or no? That's it. Next, loans and advances. What are common controls over loans? You bank shall make advance only after evaluating credit worthiness of the borrower. All the documents must be executed before disbursement. Correct? Without signing, without Aadhaar authentication, without e-mandate authentication, a bank cannot disburse the fund. Margins must be kept for securities to cover decline in market value. That's why you see there is a drawing power calculation. I think drawing power is also asked in CA final, right? Drawing power calculation is also being asked in CA final. How to calculate drawing power? See, this is mainly popular for working capital loan like cash credit and overdraft. There are two terms, sanction limit and drawing power. There are two terms. One is sanction limit and the other one is called as drawing power. Sanction limit is decided based on repayment capacity of the borrower. Drawing power is decided based upon the value of security given by the borrower. I know you have a capacity to repay 10 crore. I will sanction you 10 crore loan, but you can't withdraw 10 crore loan. Your withdrawal power is decided by drawing power. If I have to let you withdraw, give me security. Customer gave 15 crore worth of stock, 15 crore worth of debtors, and or else let us assume the customer gave 7 crore worth of inventory, okay, hypothecation, and another 8 crore worth of debtors under hypothecation. Both are hypothecated to the bank. So customer gave 15 crore worth of security totally, but as per my bank policy, the stock is subject to market value fluctuations. I have 30% margin. Debtor is subject to insolvency, threat of non-recoverability. I have 50% margin. So 4 crore, and this also let us assume 50 crore for computation purpose, okay. 3.5 crore, total 7.5 crore. I know the value of debtors and stock assigned to me was 15 crore, but considering decline in margin, non-recoverability risk, all that, I can only give you drawing power 7.5 crore. Understood? So drawing power will be calculated like, look at the stock value, look at the stock value. Sometimes in exam I'll tell you total stock value is 120 crore, and in the stock some 20 crore is damaged stock, so balance stock will be some 100 crore. Again there is a creditor outstanding of 50 crore, which means net stock owned by the customer. Net stock owned by the customer. Remember, we will only give loan on own asset. We will not give loan on outstanding oriented assets. Yes or no? Very simple. I have already housing loan. If I want to keep the same house as security, banker will give me a loan only additional amount. He will remove the total loan on the house. Whatever existing loan is that he'll remove, and balance extra how much can be given, that only they'll give. Here also the same logic. So if a customer has 100 crore stock in the godown, out of it 50 crore primary right creditor has on that inventory, yes or no? So remove that, balance 50 crore only own. In this margin has to be applied, 40 or 30 or 50 or whatever margin percentage will be given in the exam. The balance is only drawing power on stock. Are you getting it? Now debtors, 100 crore is there. Sometimes in exam the most common adjustment is debtors outstanding for more than 90 days. Okay, they will not be considered. In this case 10 crore is outstanding for more than 90 days. Then 90 crores only your real debtor minus 40% margin. Balance is the drawing power. The debtors drawing power plus stock drawing power, total it. Then total drawing power you will get. Now this drawing power, this is nothing but this much amount only you can withdraw. And remember, drawing power must be less than or equal to sanction limit. Outstanding amount in a loan account must be less than or equal to drawing power. It must be less than or equal to sanction limit. Clear? Next. And security must be kept in joint custody. Security is nothing but the pledged items, whatever. Securities must be registered in the name of the bank if applicable. Generally this is important. Registration and all will be there for mortgage, immovable property, registered mortgage. And all advances shall be kept within sanction limit and drawing power. Any outstanding balance in advance which is exceeding sanction limit, which is exceeding drawing power, shall be reported. And you know what? If there is an outstanding balance more than drawing power, outstanding balance more than sanction limit, that account is treated as out of order, which is a NPA. Are you clear? An account for an OD account and cash credit account, NPA norm is, if it is out of order, it's an NPA. Out of order means what? Out of order means, this point alone I'll clarify. See, NPA norm. What is NPA norm for loans and advances? Term loans, bills purchased and discounted, OD and cash credit. For both of them, 90 days NPA norm. I hope you know this. If at all there is a overdue for more than 90 days, it is straight away NPA. Whereas for overdraft and cash credit, they become NPA if they are out of order. What do you mean by out of order? Three circumstances out of order will be there. If outstanding amount is more than drawing power, more than sanction limit, then it is treated as out of order. Okay, or suppose outstanding amount is less than drawing power, less than sanction limit, but in the customer ledger there are no repayments for more than 90 days. You know how OD facility works? Customer withdraw money, every month bank will charge interest. Every month they will charge interest, and customer has to pay that interest immediately. For example, for 90 days in the customer account there are no credits. From bank point of view, debit means I have to receive. Credit means customer repaid. If more than 90 days continuously, if there are no credits in a OD account and cash credit account, then OD account and cash credit account is said to be out of order. Suppose credit is there but not sufficient to cover the debit. For example, interest we charged 5 lakhs, customer repaid only 10 lakhs in the 90 days period. Now, which means the customer underpaid the interest. For more than 90 days, there is a due. Yes or no? So, in the customer account, throughout the 90 days, some credits were there, but it is not sufficient to recover the debits. Then in such a case, that is also treated as out of order. And a cash credit account and overdraft account, which is treated as out of order, is an NPA. The moment it is treated as NPA, it has to be classified as a substandard asset. Okay, fine. We'll come to that later. You're all with me? Yes. Next. Then credit card operations. Credit card operations. So effective screening must be there before a bank is giving a credit card. Strict control must be maintained on storage and issuance of card. Once upon a time, all this. Today, credit card is getting manufactured itself after customer make an application. Manufacturing itself is after customer made an application. So, and obviously, merchant verification for available limit. Whenever you swipe, no, there is a limit check will happen. Then only transaction will be successful. Regular reporting from merchants for settlements accepted by them. At the end of the day, almost all the merchants will put a settlement button. Okay, so that the transactions will be settled. And reimbursement to merchant shall be made only after verification. Like a customer swiped the money with the POS machine, he will get the money on the next day. That money will be credited only after thorough verification whether bank has collected or not. Ensure statement are sent to customers regularly. Monitor overdue payments. If at all any credit card customer used but not paid, stop credit immediately. And if required, to avoid increased losses, periodic review of credit card holders accounts must be done, including limit revisions and provisioning for doubtful debts. This is credit card. This was also asked for 4 marks question. Already it was asked. Okay, I'm telling you, literally every topic in the bank audit chapter is tested, because bank audit chapter is there from past 15 years. When I am studying also, it is there. Same matter is there. Okay, next. Compliance with CRR and SLR. Okay, I'm covering the CRR, SLR also. Okay, 1 minute. Yes, next. Computation of SLR and CRR, cash reserve ratio and statutory liquidity ratio. SLR means it's a reserve maintained by the bank in the form of liquid assets like government securities and cash, all that. Cash reserve ratio is a liquidity maintained directly by the bank with RBI. Okay, now how to do the audit of SLR? RBI requires all central statutory auditors to verify SLR compliance on 12 non-Friday dates in each fiscal year. The goal of SLR is to maintain liquid assets to handle sudden increase in depositors request for withdrawal. Okay, so and auditors, they have to give, after verifying SLR, the statutory auditor has to give a report which has to be sent to top management, and the report shall also be forwarded to RBI. What auditor has to report on SLR? Regarding SLR is computed as a percentage of liabilities of the bank. Which liabilities? Customer liabilities. Customer liabilities means what? Demand and time liabilities. Yes or no? A bank will accept deposits from customer, right? These deposits are demand deposits and time deposits. All of us will have savings account, right? That's a demand deposit. Whenever we want, we can withdraw. Time deposit means what? Recurring deposit, fixed deposit. That's it. So as a percentage of demand and time deposit, SLR will be calculated. So in order to compute correct SLR, first DTL has to be correctly computed. So auditor has to give a report on correct computation of DTL. So the auditor has to give a report on correctness of computation of DTL position on 12 non-Friday dates. Then whether the bank is maintaining assets required. Okay, they computed DTL liability correctly, but they didn't invest in any asset, that money. Okay, so both you have to report whether DTL is computed correctly and bank is maintaining the liquid assets as per the SLR requirement. So 2 reports auditor has to give. Next, what is the audit procedure for SLR? First, understand RBI circular on composition of DTL items, because throughout the year DTL SLR percentage may not be same. See, DTL definition is constant. There won't be any change for DTL definition, and this DTL definition is defined long back. Just that in this DTL, liabilities, assets, new items might be included soon. I mean, because every time banks will be launching new products. Okay, so the liability towards customers will be every time new liabilities will be accruing. So DTL definition might be updated frequently. Okay, and moreover, SLR percentage will be changing every quarter, once in 2 months. Whenever RBI do a monetary policy review, they change SLR CRR rates in order and in light of economic scenario, all that. Now, DTL, examine DTL position consolidations prepared by bank, including valuation of securities, all that. Now, these are all the things, some of the items which are excluded from liability. Remember, demand and time liability means customer related liability. Paid up capital and reserves is not a customer related liability. Loans from RBI is not a customer related liability. Bills discounted by the bank is not a customer related liability. Bills discounted by bank is a loan given to customer. Yes or no? Net income tax provision is not a customer related liability. Amount received from DICG is not a customer liability. Amount received from export credit, that corporation, is not a customer liability. Amount received from insurance companies for ad hoc settlement of claims is not a customer liability. These are all not customer liabilities, but these items sometimes appear on the liability side of the balance sheet, but these liabilities are not customer liabilities, so you need not consider any 6 or 7 liabilities. They will ask you a theory question or they can ask you a practical question. Okay, practical question, for that purpose you need to understand all these points. You need to understand all these points. Sometimes examiner will give that. Okay, see, first of all, this is completely automated calculation in bank. Literally today we don't do anything in a bank audit. If at all it's a branch audit, we do bank audit, we do some procedures if at all we are a central statutory auditor. Okay, for a bank branch level, we do literally nothing. We go fill LFR form and then come back. 5 days work, yes or no? That's it. Actually it can be filled in 1 day only, but we drag it for 5 days. Okay. Fine. Otherwise bank manager will be feeling 5 lakhs visa for 5 days, for 1 day, so he'll be feeling bad. Fine. Yes or no? We pretend as if we understood LFAR. Honestly tell me, literally tough not to understand bank affairs, that too in 5 days. April first week or second week we will go 4 days or 3 days, actually 3 days only, but it will be more than 3 days sometimes, very rare cases. If you are ready to stay more than 5 days, bank manager is not ready to hold you. Sir, please finish and go off. Yes or no? Fine, all this. Then inclusion in liabilities. The following must be included in liabilities. Net credit balance in branch adjustment account, because this might be belonging to some customer. Interest accrued on deposits, it's a customer related liability. Cash collateral received under collateralized derivative transaction, collateral amount received from customer, that's a liability towards customer. Foreign borrowings, liability to a customer. Reconciliation of notes to accounts, provided the notes to account balance is having outstanding amount. These amounts has to be included in liabilities calculation for DTL computation. In exam they'll give you these names and numbers. Okay, so and they will give you total liability, in that these are all included, like that something they'll tell. So you need to reconcile it, you need to add back or you need to less, something you need to do, and then apply the percentage of SLR. That SLR percentage they only give you, you don't have to remember. Next. And the following liabilities are exempted for the purpose of DTL computation: minimum eligible credit and long-term bonds, affordable housing loans, verify incremental FCNR, all that, these are all exempted liabilities for the purpose of all this. Next. And branch data consolidation, ensure consolidation of data from all branches and even foreign branches to arrive net balances in branch adjustment account. And we do regional consolidation, verify regional consolidation of branch data with report signed by regional manager, all that. And in SLR compliance report, the auditor shall specify number of unaudited branches and state that reliance on the returns in forming the opinion. See, obviously State Bank, if you take for example, they have 25,000 branches approximately. 19,000 branches were not audited at all. Okay, even though they were not audited, we are giving opinion on the entire State Bank of India based on the returns submitted by those branches, because they are not significant. RBI has given certain guidelines for exemption on branch audit. The operations are negligible there. The operations are negligible. Approximately 40% of the assets were only owned by 80% of the branches. In State Bank of India, if you take out of 25,000 branches, 19,000, the number appears big, but the number of assets owned by them, the income owned by them is 30 or 40% only, not the major portion. These 6,000 branches collectively control 60% of the revenue of the bank, 60% of the assets of the bank. You can see that in SBI audit report. I would have shown that in this marathon, somewhere I would have shown. Next. So that's regarding SLR verification. Okay, what liabilities will be included, what liabilities will be excluded, exempted liabilities. They'll ask you any of these questions. Okay, they'll ask you what to write about exempted categories for DTL computation. They may ask you a theory question on that. Next. Now, verification of assets. And you see, first of all here, what are the assets that are there? Audit of, in the recent exam, in the recent May 25 exam, they asked about asset classification, which is not given in our book. You need to figure out asset classification based on an overview of the concepts. Okay, for example, verification of asset. What assets will be there? Cash and bank balances will be there, investments will be there, and third category of asset is advances will be there. And this is the same order in which Schedule 3 is there. Bank audit Schedule 3, if you see bank balance sheet Schedule 3, first one cash and bank balances, and then this one investment and and loans and advances. Then we have fixed assets. Within this fixed assets, we have again subcategories. Within this fixed assets will be there, Fixed asset premises will be there, fixed assets, other fixed assets will be there, and any other asset is called as other assets. Inside that, in the recent exam, they asked about non-banking assets acquired in satisfaction of claim. What is the asset classification for that? This has to be classified as an other asset. Who will read with the heading? Yes or no? They will read heading, they will read matter, but they won't observe this point that it is a classification. So in the recent exam, they asked about classification of so and so item. Understood? So let's understand that. Yes, verification of assets. So auditor has to verify cash balances, bank balances, money at call and short notice. Okay, the auditor's main objective in cash verification is verify existence and completeness of these items on balance sheet date, and audit procedures has to be tailor-made to meet that objective. Bank implements generally a strong internal controls for cash, like joint custody of cash, periodic checks, and balances with other banks will be reconciled regularly. These are all various controls a bank will implement. The auditor should assess effectiveness of these controls. That's it. Next, detailed audit procedure for cash. Physical verification of cash must be done, as near as practicable to balance sheet date. Now, when you're doing physical verification, foreign currency, ATM, cash deposit, at all the places you must do simultaneously. For ATM machines and all, you can get, automated slips. Okay, for physical cash. Then balances with RBI, not that important. Balances with other banks, not that important. Money at call and short notice. Okay. Now, verify system of authorization for lending, including compliance with head office guidelines. Money at call and short notice means these are all short-term advances between the banks. Okay, so if I want temporarily some funding, so I have tie up with HDFC Bank, have tie up with IDBI Bank, so that bank will send money whenever I call with just a short notice. Okay, they will give me, and whenever they call back, I will give them back. Verify call loans with borrower certificates and call loan receipts. Check the balances in relevant tally register and match controls. Verify subsequent repayments from borrowing banks. You see here the dealings is with banks. Remember, if I give a loan to customer, that comes under advances head. That comes under advances head. Money at call and short notice is a cash equivalent for a bank. Yes or no? That is not an advances to customer. That's an advance to bank. This is normal operations. Now, ensure call loans are not netted off against loans received. For example, I gave a cash loan to ICICI Bank and I took a cash loan from HDFC Bank. I should not net off and show net liability. I should show call loan given, call loan taken separately under liability and separately under asset. Are you clear? Next, these are all important for MCQs. Verify proper accrual of interest and see that it is accounted on year-end balances correctly. Then investments. Investment is not a big deal. It's an easy point, but read. See, just because I'm ignoring, that doesn't mean it's not important. Okay, it's something you can manage on your own. Now, physical verification of investment. This is important. 1 minute. Okay. So, physical verification of investments. So, when you're physically verifying the investment, verify investment scripts at year-end. Verify investments which are held with public debt office of RBI, custodians and depositories with statements of holding. Banks will hold investments for the purpose of SLR requirement. These investments will be held some physically in the bank's own demat, or they may be held with PDO offices. PDO office means what? Bank receipt means what? All that I made a video, scam 1992 Harsha you put. Okay, you'll find a video on the YouTube. You just watch that. You will understand the tender scam 1992 what happened. Next, in case of bank receipts, examine counterparty confirmation, get a written explanation for any long outstanding BR. Then BR shall not be issued in respect of government securities where SGL facility is available. So for government securities, banks should not accept GR. Directly they should only accept subsidiary general note. I mean SGL note. Subsidiary general ledger note we call it as. SGL note we call it as. Okay. Then valuation of investments. Look at the valuation method and see whether it is appropriate to follow RBI guidelines. Verify correct classification of investments at acquisition based on decisions from board, and ensure that non-performing investments are properly classified and provisioning is made correctly. And examine profit or loss on sale of investments are computed and accounted correctly. And see change in method of valuation of investments. All that. That's it. Enough. Now, classification of advance, most important in the entire bank audit. Classification of advance. Advances will be classified into multiple categories based on nature of advance. It's classified into cash credit, OD, term loan, bills purchased. Based on security, secured advance are covered by guarantee. Like based on place, advances given within India, advances given outside India. Based on sector, advances given for priority sector and others. So advances will be classified in different ways based on this. They can develop a case study scenario like on this and then ask you in a different way. Audit approach: the auditor must focus on obtaining evidence for amount outstanding at balance sheet date, amount due to the bank and their documentation. There should not be unrecorded advances. Valuation and recoverability you should check. Classification and disclosure you should check. Appropriate provision shall be made as per RBI norms for NPS. There is something called IRAC norms, income recognition asset classification. We call it as IRAC, income recognition asset classification. So these norms you need to comply, and you need to evaluate controls over advances. Verify credit appraisal process. The controls over advance means what? I need to look at the control aspects, how the customer screening is done. Okay, so verify credit appraisal procedure including loan application and borrower credit worthiness. Okay, in controls audit I will verify this. In controls over advances, ensure advances are sanctioned by proper authority, means control element I am checking. Ensure documents are executed before dispersal, control element I am checking. Verify compliance with the terms and end use of funds, controls I am checking. Check securities existence, enforceability, valuation including registration requirement, whether security is registered in the name of the bank, is it existing or not, controls checking. Ensure compliance with loan policy of the bank. Every loan given by the bank must comply with loan policy of the bank. Then I should also perform substantive procedure. Substantive means what? I will take a loan real account, a loan whatever given to customer, I will take the account, I will see the ledger movement, I will see how much amount is outstanding, details, test of details, we call it as nothing but substantive procedure. Like what are they? Verify master data in core banking for verifying how much is the installment a customer has to pay, what is the rate of interest we need to charge, what is the loan tenure. These are actual details verification. Yes or no? Here I am not checking loan is given as per the policy. Here customer proofing, customer screening is done properly or not. I am not talking about any control elements, I am talking about actual transaction details. Each customer is tagged with a single customer ID across all accounts. Examine all large advances, whereas other advances on a sample basis. What is a large advance? If the advance amount is having more than 10 crore outstanding amount, or if the advance is 10% of the outstanding of 10% of aggregate outstanding balance of the branch. So in a branch, total advances identified as on 31st March. In that 10%, if at all a customer is occupying, he's a large advance. That's a large advance. Or if it is 10 crore, whichever is lower. Okay, whichever is lower, yeah, you can take whichever is lower, getting it. So if at all a customer account is having 10%, if a single customer is having 10% of the total branch loans, then he's a large advance. Or if he's having more than 10 crore outstanding, that's a large advance. All large advances verify 100%, remaining advances verify on a sample basis. And review problem accounts, SMA2, special mention account 1, special mention account 2. What are they? Once a loan, once you cross due date for payment, after 90 days we classify it as NPA, but after 30 days it is classified as SMA1, after 60 days it is classified as SMA2. The moment it turns into SMA, bank will be following you up, because becoming NPA not only problem for the customer but also problem for the bank. Next, and restructured accounts, verify restructured accounts and RBI compliance for additional provisioning, and examine accounts that are adversely commented by concurrent auditors. Review accounts slipped into NPA within 12 months of the sanction. These accounts are called as quick mortality accounts, which are very dangerous for bank managers for getting promotions, all that. So once a loan is given, within 12 months customer defaulted, so that's called as quick mortality account. Okay, so verify all this. Verify completeness and accuracy of interest charged. Carry out analytical procedure. These are all substantive procedures. Correct? Apart from substantive, now check recoverability point of view. Okay, open borrower ledger account. See whether terms and conditions are compliant. Verify latest statements of the borrower. Why am I verifying statements of the borrower? I want to know whether he will be paying me back or not. I will review security inspection reports. So borrower security is given, right? Our inspection team or internal audit team or valuation team will be inspecting those securities, and they will give valuation reports. That value report I will verify to know whether customer recoverability is, is there any problem on recoverability. Check auditor's report for borrowers with credit facilities for multiple banks above a specified limit, fixed by RBI. This is what ASM reports. ASM reports or stock audit reports, whatever. And in the recent May 25 exam, how the question was asked, so and so team members are planned for bank audit. Okay, the team members planned. Mr. P is planning to do some two procedures. Mr. B is planning to do some two procedures. Mr. C is planning to do some two procedures. Okay, now question is actually drafted like this: which of the following comes under substantive procedures? Out of the above six, some 7 or 8 procedures they identified, they gave a list, which will come under substantive procedure, that they asked. Even the question is not straight asked like this: R want to perform so and so, yes or no? You need to sync that. There they have given 3 persons. One want to verify controls, one want to verify substantive, one want to verify recoverability. Below, R is planning to verify these, R is planning to perform these procedures. Whether is R correct? Like that they asked a question. No, which means if a student who only remember these points but did not remember this classification cannot write that answer. Understood? I showed that question in the YouTube also. I just uploaded that question. So complicated that is. Next, verification of asset classification, income recognition. As per prudential norms, auditor has to ensure that advances are classified based on RBI norms. How advances are classified? Standard asset and NPA. NPAs are classified into substandard, doubtful asset and loss asset. This is the prudential norm classification requirement. Now, income is recognized only based on recovery, actually recovered. See, general income is recognized on accrual basis, but once an advance slipped into NPA, income is recognized on cash basis only. Proper provisions must be made for doubtful recoverability. Auditor must familiarize with the latest RBI circular on provisioning and review subsequent circulars before the audit report is issued. Ensure that these norms are followed as a minimum provisioning requirement. Banks may also add higher provisioning required depending upon the recovery risk. Ensure that bank made adequate provision for bad debts before paying any dividend. And central stat auditors, branch auditors have to verify applicability of prudential norms on asset classification, income recognition and provisioning. Are you clear? Prudential norms means what? Income recognition norm, asset classification norm and provisioning norms. All these three were collectively called as what? Prudential norms, which is as per Basel III framework. Understood? Next, classification of provision. Automated system. In banks, no system is automated for identifying and classifying advances without any manual intervention. These advanced classification is appropriate or not, check out, especially where there is a recovery threat. Ensure secured and unsecured portion of advances are clearly separated and provision is calculated correctly. Secured, unsecured portion, that classification is important for doubtful category. For doubtful category, unsecured portion 100% provision we create. For secured portion we create D1, D2, D3, 20, 40, like that, some 30, 40, 100, like that, some limits will be there. Then compare date of NPA mentioned in the current year statement with the previous year statements. When the customer account became NPA as per last year bank statement, last year loan statement, current year loan statement also say, in that also date of NPA declaration you see if at all there is a change, why there is a change. Okay, next, accounts regularized near balance sheet date. What do you mean by accounts regularized near balance sheet? This is a very rare process. Okay, but still, banks are most concerned about NPA position on 31st March. So what bank managers do, sometimes what little higher level authority, what they do, they call customer, dear customer, I'll do one thing, I'll give you fresh loan. You repay you pay the loan amount first, or else you try to bring funds somewhere. Pay the money before 31st March. The account became regular. Then immediately on 5th April, I will give an approval where he can withdraw. Therefore, on 31st March, NPA will be removed. Yes or no? So, if at all, where any accounts regularized near the balance sheet date, yes or no, that indicates inherent threat. That indicates inherent weakness. Verify whether an advance is regularized before balance sheet date with genuine source or not, check out. Suppose if further funds were provided after regularization, like customer account became NPA originally, later it became a regular, later again bank gave back the fund. Yes or no? Now, that indicates inherent weakness in the account. Bank has to provide some evidence about regularization to eliminate doubts. So bank has to show me proof that throughout the year it was NPA, but on 31st March it became a regular account. How does it become a regular account on 31st March? Show me a proof that it is a genuine source. Customer paid money out of genuine source. And ensure accounts are classified as per position on the balance sheet date. NPA shall be recognized based on past due overdue concept, not just based on balance sheet date. The concept highlights that not only balance sheet date, based on past account to movement, NPA classification has to be made. Suppose if a customer account, even though regular, appearing regular on 31st March, if at all the customer account reflects inherent weakness, the auditor has to recommend the bank. The auditor has to make sure the bank classifies such loan account still as an NPA. Clear? Then drawing power calculation, I already told. Drawing power is calculated as per bank credit policy and is also based on sanction letter. Ensure proper reporting for creditors and stocks covered under letter of credit and guarantees, because any stock under letter of credit and guarantee means outstanding stock, and creditors, this must be eliminated from total stock value. And ensure net value of debtors is correctly calculated when book debts are also used as security. It should be ensured that drawing power is calculated net of margin. Yes or no? Review stock audit and book debt audit for advances exceeding stipulated limit. And that's it. Special focus must be given for comments made by statutory branch auditor. Statutory auditor. See, in the entire bank audit chapter, statutory auditor means branch auditor. Statutory central auditor means principal auditor. That's it. Next. Accounts with temporary deficiencies. What do you mean by accounts with temporary? Ensure temporary deficiencies does not classify as an NPA. Ensure stock statements used for calculating DP is not less than 3 months old. The outstanding in the account shall be treated as irregular. Irregular means NPA. If drawing power is calculated based on old stock statement, we need to file a quarterly stock statement with the bank. If at all for a particular quarter customer did not file a stock statement, that customer account might become NPA. Review of limits. Sometimes regular limit. Regular limit means regular OD cash credit limit. Some customers bank will give ad hoc limit. 20% extra margin I'll give. You can withdraw. For example, in COVID time, ad hoc limits were given for many big companies and all. Okay, and these limits, they must be reviewed within 180 days from due dates. Accounts with unreviewed limits for more than 180 days should be considered as NPA. For all working capital loans, every 6 months review will happen. Whether the customer security is still proper, whether recoverability is there in the customer account, whether proper movement is there in the customer ledger, is repaying interest everything correctly or not. There will be a manual review within for every 180 days. It should happen. If at all a customer account is not reviewed within 180 days, ad hoc limits were sanctioned repeatedly, limits were not reviewed within 180 days, that should be treated as irregular, which means it's an NPA. Clear? So ensure no repetitive or ad hoc or short reviews. Then further, remember, NPA classification is borrower wise, not just facility wise. For example, I gave a housing loan, car loan, credit card to a single customer. Credit card, he defaulted, it became NPA. Automatically car loan, housing loan also I will treat it as NPA even though the customer is paying EMI on time. Okay, because NPA classification is borrower wise but not customer wise. And ensure asset classification is borrower wise and not facility wise. Okay, ensure letter of credit development, invoked guarantees are treated as part of borrower principal account for prudential norm application. Invoked guarantee means what? Guarantees removed. Getting it? Invoked guarantee is removed, so you will consider it as a liability. Next, government guaranteed advances. These government guaranteed advances are two types: central government guaranteed advance, state government guaranteed advance. State government guarantee you simply ignore. If a customer did not pay for more than 90 days, it's an NPA. You will create a provision. Income on that asset will not be recognized on accrual, it will be recognized on cash basis. Suppose if the customer loan is guaranteed by central government and if the customer defaulted for more than 90 days, we will not classify that as NPA because central government guarantee is there. However, interest will be recognized only on cash basis. For income recognition purpose, it is NPA. For asset classification purpose, it is regular. This facility is given only when the loan is guaranteed by central government. That's it. Clear, all of you? Then agricultural advances. Agricultural advances are two types: long duration crop loan, short duration crop loan. Long duration crop or short duration crop, it is decided by crop season, and the crop season is decided by state level bankers committee. If the crop season is more than 12 months, it's a long duration crop. If the crop season is less than 12 months, it's a short duration crop. That's it. And that's it. And for long duration crop, if at all the loan is outstanding for more than one season, one crop season, then it's an NPA. A short duration crop loan is treated as NPA if the loan is outstanding for more than 2 crop seasons. That it is there in CA Interbook. Even in the CA final bank audit, they advise to refer once to CA Inter bank audit chapter. Next. Then provisioning for standard assets. Ensure provisioning for standard assets are in line with RBI circulars. Different sectors will have different provisioning rate. Check standard advances bifurcation for correct provisioning calculation. Restructure. Restructure means what? Customer came for renewal, extension of the credit period, all that. Restructuring, that's it. Okay. Audit steps. Verify compliance with RBI for restructuring. Banks cannot restructure with retrospective effect. Restructuring is only prospective. For example, a customer became NPA, it already came into doubtful. Now the customer came for restructuring, still it is classified as doubtful. Because no, suppose if a customer came for restructuring before default itself, default is not yet made, before default itself he made, sir, next 6 months my cash position is very tight, right now itself I came for restructuring. Now bank will straight away classify that loan as a substandard asset. Okay, once a loan is restructured, it is immediately classified as a substandard asset for 1 year. For 1 year, for 1 year we will see as per restructured terms customer is paying correctly or not. I will see if at all customer is honoring restructured terms and conditions correctly for 1 year, we will again upgrade it to a regular asset. Are you clear? Next, upgradation of accounts. Any of this can be asked as a 3 or 4 marks question. Upgradation. See, upgradation means what? It is an NPA. Now it is becoming a regular asset. See that RBI guidelines are followed for upgradation from NPA to standard. Ensure that overdue portion is fully cleared before upgrading. This is most important condition. If a customer did not clear the pending outstanding amount, okay, we will not upgrade it. By the way, pending amount means what? Pending EMIs plus additional interest charged by the bank. That entire amount customer has to pay. Then only the remaining loan will be upgraded into a standard asset. Understood? Also check that there is no possibility of incorrect upgradation based on partial recoveries. You should not upgrade a customer account just based on partial recovery. Whatever full recovery liability is there, you need to recover. There is a possibility of recoveries may be made after cutoff date, but account still be upgraded on balance sheet date. So check out when the recovery date is and when the upgradation date. Upgradation can only be on or after recovery date. It should not be before recovery. Are you clear? Next, sale and purchase of NPA. Banks will purchase NPA. The purchasing bank is called as a bad bank. Okay, bad banks. Have you heard of ARC companies, asset reconstruction companies? There are many bad banks. Okay, like a bank is there, they have an NPA whose outstanding amount is, let us assume 10 crore with interest all that, and the borrower is not at all paying. This bank has an option. They can sell that amount to me. They can sell that entire right. That's nothing but sale of actionable claim. What is it called as? Sale of actionable claim. So a bank can sell their actionable claim to me. I will buy this actionable claim by paying 5 crores. And whatever amount I recover from the customer beyond 5 crores is a profit to me. Are you clear? So ensure that NPA sale or purchase policy is well defined and followed, including valuation procedure and delegation of powers. Ensure sale or purchase of NPA must be made without any recourse. Recourse means what? You cannot return it. You purchased NPA, I can't return it to the other person again. So when a bank is purchasing or selling NPA, it must be sold with ultimate obligation transfer. No recourse option. Further, bank should not purchase the same NPA which originally it sold. When I'm purchasing an NPA, it should be something new loan which I have not sanctioned it. Suppose an ICICI bank want to purchase NPA, okay, that NPA should not be ICICI loan related. Are you getting it? That must be HDFC bank loan related or IDBI bank loan related. Now, in case of sale of NPA, this was also asked many times in exam. How to audit sale of NPA. So in case of sale of NPA, the moment a loan is sold, NPA is sold, that entire customer account must be removed from the bank books of accounts. Further, remember, you can sell an NPA only if the customer amount is there in the books of accounts of a bank for 2 years as NPA. It is not 2 years customer relationship, 2 years as NPA relationship. Understood? A customer account which became NPA and stayed in the books of accounts of the bank for at least 2 years, then only it can be it can be transferred as, then only it can be sold. Indirectly, what are they saying? Only a doubtful asset can be sold. Substandard asset cannot be sold. Simple. Yes or no? Verify sale consideration is paid upfront on cash basis and not on a contingent price. The person who is purchasing this NPA should pay fixed amount at the beginning itself. It should not be linked with collection amount. No, not permitted. And check if at all NPA is sold. Below book value if at all NPA is sold. Like for example, in my books 10 crore outstanding amount is there, I received only 5 crore. The balance amount is transferred to P&L account, it's a loss. Suppose if I sold above net book value, excess provisioning should not be reversed. It should be used to cover any other NPAs, okay? And the profit will be taken to P&L. Verify bank does not have any legal, operational and any risk related to sold NPA. Once it is sold, all risks are gone to the other person. I will have to straight away recognize my profit or loss in the P&L account. Clear? Purchase of NPA. Ensure provisioning requirements based on classification of purchased NPA. For example, the other bank which has NPA, in their books it is D3 asset. When I purchase, in my books also it will appear as a D3 asset only, doubtful category 3. Suppose in the other bank it is recorded already as a loss asset. In my books also, when I purchase that NPA, I should also record it as loss asset. Verify recoveries from purchased NPAs are accounted correctly. So once I purchase an NPA, I will start recovery from my recovery agents, all that. So whatever I am recovering, I should record it. Suppose I purchased NPA for 5 crore, I recovered 1 crore. That I will adjust it with the purchase amount. First acquisition amount I will adjust. If at all I get more than acquisition amount, I will transfer to P&L as a profit. So first adjustment against acquisition cost, recovered amount in excess of acquisition recognized as profit. And when you're calculating risk weight, for the purpose of capital requirement adequacy ratio, 100% risk weight will be given for purchased NPA. Understood? Verify capital adequacy is adjusted with 100% risk weight for purchased NPAs from other banks. Clear? See, I'm discussing so intensely because MCQs can come from anywhere. Understood? That's it. Fine. Shall we continue the next session? So fixed assets and all easy. Fixed asset is easy, very easy. Other assets only bit tough. Then other assets and liabilities we have. Once we discuss this, contingent liability discussion is there, concurrent audit discussion is there over this chapter. Okay, so that's it. Okay, in the next session we'll be covering this remaining topic. Comfortable with bank audit? Only 52 minutes. Major concepts we covered. So we started discussion of audit of bank. Inside that we already completed various introduction and formalities, as well as we completed audit of assets. Inside that, up to loans and advances we completed. Now we need to discuss about fixed assets. So cash and bank balances, investments, advances, all the three asset type audits we have completed. Now we need to cover about fixed assets. Now, obviously fixed assets are broadly categorized into two categories. One is premises and other fixed assets. So how to do audit of premises? Premises means what meaning they give, other fixed assets means what meaning they give, which is very simple. And evaluation of controls, only controls point they can ask as a 4 marks question. So first look at the expenditure, controls over expenditure on fixed assets, and verify accountability and utilization control. Examine information controls for availability of information about fixed assets, nothing but records maintained regarding fixed assets. Location of documents of title regarding fixed asset documents, ownership documents, where are they kept? Are they kept in a bank, or are they kept in the in a company's head office? Where? Whether fixed asset register is maintained centrally or at branches. Check whether acquisitions and disposals are communicated to head office, and are they as per authorization manuals. Premises, this is something that you can understand on your own. Okay, now before I go further, let's look at once the structure of balance sheet. If you see, we'll directly open bank balance sheet. Suppose annual report SBI 2025. This observation is very important because recently they've asked regarding classification, which we don't have in our syllabus. First of all, minute, loading. Yeah, so this is SBI annual report. You see, almost it is 520 pages, close to. So this is the balance sheet, standalone balance sheet, and balance sheet. You see the how it was given in the same order in our book also it is discussed. Yes or no? First cash and cash equivalent, cash and cash balances with banks, then investments, then advances. Then we have two more types of assets, that is fixed assets and other assets. In the same order only it is given. Even in the ICA book it is given in the same order. Then liabilities, if you see, first capital discussion, reserves and surplus, then deposits, then borrowings, then other liabilities and provisions. Now if you observe cash and cash balances, okay fine, I think they have given. Okay fine, we'll come to that respective category and then discuss. Just what are we discussing now? Yes, cash and cash balances, cash in hand, balances with RBI. Then balances with banks, how it is classified? Balances with bank in current accounts and other deposit account, money at call and short notice with banks and with other institutions, and how much is outside India. Then investments is again classified into government security, other securities, and shares, debentures and bonds, subsidiaries and investments in subsidiaries and joint ventures, and any other investments. Investments outside India, again government securities, subsidiaries, and then others. Again investments in India, investments in outside India, gross value, net value, breakup. Advances, you see, totally we categorize into three parts. See, the same amount, the same total advances we present it in multiple ways. Okay, one way is regarding the type of advance: bill purchased and discount, cash credit, OD, loans repayable on demand, all these all, second category, and term loans. So based on the nature of the loan, based on the nature of advance, three classifications. Based on security or guarantee, three classifications: secured or covered by bank or government guarantee, unsecured. So next, based on like a location where the advances are: advances in India, advances outside India. And if you see in India and outside both, total it 416 again, here also 416. It is just a multiple ways of presentation. And advances in India: priority sector, public sector, banks, others. How much? Priority sector means nothing but agriculture loan, housing loan, MSME loan, or education loan. All this comes under priority sector. Then now coming to fixed assets, in our book it is clearly told fixed asset is broadly divided into premises and other fixed assets. Yes or no? So the same is given here exactly. Then coming to other assets, what are all there? Inter-office adjustments, interest accrued will be there, tax paid in advance is there, non-banking assets acquired in satisfaction of claim. This one asked in May 25 exam. Understood? See, in our book, no, they presented clearly. Even in the ICA book also, they presented in the same order, but we don't observe that it's a classification. So in exam they are asking how, debts acquired in satisfaction of claims, amounts acquired in, assets acquired in satisfaction of claim, how to present that, where to classify. We don't observe that, but it is given clearly. But they didn't explicitly give any format. They didn't give, so we generally don't pay any observation. Yeah, next up. So audit of other assets, inter-office adjustments. So ensure inter-branch accounts are reconciled at central level. Report on year-end status, indicating dates up to which accounts have been reconciled. Mention number and amount of outstanding entries in debit and credit. Check whether discrepancies are properly dealt in the books. Interest accrued, verify interest is accrued on entire loan, mainly on overdue bills and purchased or discounted. Ensure that only realizable interest is recognized on accounting standard 9 basis. Next up, tax paid in advance, TDS, that's normal. Stationery and stamp, ensure that it only includes exceptional items of expenditure like bulk purchases. Normal routine stationery purchase, printing and stationery, that expenditure we will debit to P&L. Evaluate existence, effectiveness, continuity of controls over these items. Generally banks, big all institutions, they purchase stationery in bulk quantities and they recognize it as an other fixed asset, other assets. And evaluate controls over stationery and stamps and report it in LFAR. Physically verify these stationery and stamp and see whether any shortages are noticed, and ensure that cost of stationery consumed is properly charged to P&L. Then non-banking assets acquired in satisfaction of claim. And regarding this, one important observation is, bank shall not hold immovable property for more than 7 years unless it is for its own use. As an investment, a bank cannot hold for more than 7 years. Or if any asset is acquired, out of satisfaction of debt. For example, I gave a loan to a customer, housing loan, he's not repaying, I acquired back that house. Okay, that I cannot hold, I cannot carry for more than 7 years in my books of account. I have to sell it off. So if I have a building in my books of accounts, it can only be owned by me for 7 years, if at all I'm not using it for my own business. If at all you're using it for your own business, corporate office or branches, some purpose, then you can have it permanently, no problem at all. Next. So non-banking asset. Non-banking asset means what? That's not my asset. Yes or no? It's a customer house I acquired in satisfaction of claim. Like I have a claim on him, like he has to pay me the loan. So I settled with that and acquired the house. I took over the house. Okay. Ensure that non-banking assets are acquired in satisfaction of debt or and intended for disposal. Verify the assets with documentary proofs like settlement term, court order, all that. Check ownership is completely transferred to the bank or not. Ensure that assets are recorded at lower of net book value or net realizable value, because you're holding it for sell. When you're holding it to sell, obviously NRV is most important. Yes or no? Next up. Yes, assess if dispute require liability or provision, whatever, and check compliance with section 9 of the Banking Regulation Act. That's it. The non-interest bearing advances, not an important one. Loans and advances to officials and relatives, not important. Security deposit, not an important one. Prepaid expenses, suspense account, nothing is important. Miscellaneous debit balance in government account. Why I feel important? Because there are more than 4 points. Simple logic. Okay, because in a question in exam they'll ask at least 4 marks or 5 marks question. That is the logic. Okay, so now miscellaneous debit balances on government account. Review aging statements for these statements, because for all government accounts, most of the times banks, not only banks, every person will receive very late from government. So that's why aging analysis is important. Examine recoverability of old outstanding items. Ensure claims for reimbursements that have been made by the branch as per the terms and conditions. To various officers for various purposes, government will have a tie-up with the bank, and the banks will reimburse all the expenses for various purposes. Okay, and bank will debit to the government, concerned government, local authority, or state government or central government. They'll debit, and bank has to collect from them. Ensure that net balance of recoverable at head office should also be taken as per aging analysis. Verify provisions are needed due to a lack of confirmation or lack of justification for old outstanding balances. See that provision is made correctly or not. Ensure reasons are recorded correctly and reviewed for major variances compared to previous year. This is also important. Next, then coming to liabilities side of the balance sheet. Now capital and liabilities, I hope you are aware of, bank has to maintain a minimum capital adequacy ratio of 9%, NBFCs has to maintain a 15%. Okay, for NBFCs we have tier 1 minimum 10. Okay, in case of gold lending NBFC, tier 1 is minimum 12. That and all were there in NBFC. For a bank, the capital requirement ratio is 9%. That's it. There is a simple logic. Why for bank is it lower than NBFC? For banks, they already have to maintain statutory liquidity ratios, all that. So since liquidity requirements is very heavy for a bank, so they don't have to worry. Yes or no? See, capital requirement norm is what for all banks and NBFCs. Why minimum capital is required? That is also like a cushion. Okay, that's like a safety margin. Then Basel III framework, 99% they won't ask, but if at all. Okay, purpose of Basel III Accord, to absorb shocks from financial economic stress, improve risk management and governance, enhance transparency and disclosure. You see, entire prudential norms were there, right? Income recognition, asset classification, provisioning norm, all these are because of Basel III framework only. Then what are capital adequacy measures in India? It is governed by statutes with minimum capital requirement. So almost there are laws where they say every entity, especially financial institutions, must maintain minimum capital. So RBI prescribes a uniform approach for all the scheduled banks. Banks must have enough capital to absorb losses, and this capital is divided into two types: tier 1 capital and tier 2 capital. Tier 1 capital is highest quality capital, tier 2 capital is low quality capital. It is less effective in absorbing losses compared to tier 1 capital. Subordinate debt, all that comes under tier 2 capital. Indian banks and foreign banks operating in India have separate guidelines with respect to tier 1 composition, tier 2 composition. Detailed guidelines are provided by RBI on how to calculate risk weighted assets and off balance sheet items for capital requirement adequacy ratio. CRAR means capital requirement adequacy ratio. An audit process. Verify RBI guidelines are followed for capital adequacy with minimum requirements. Ensure bank maintains required CRAR, that is at least 9% on ongoing basis for banks. Review classification of capital into tiers as per characteristics and quality of the instrument. How to calculate capital requirement ratio? Eligible capital funds divided by risk weighted assets into 100. Simple. How much is the risk weighted asset? How much is the eligible capital maintained by the bank? Multiplied by 100. So for example, capital maintained by the bank is 100 crore, risk weighted asset is 1000 crore, into 100 is equal to 10% they are maintaining. Eligible capital funds means what? Tier 1 plus tier 2. This is the same formula which we apply in NBFC also. Understood? Then reserves and surplus. Sometimes they can ask you disclosure requirements also, the descriptive question or an MCQ. So how reserves and surplus has to be disclosed? 5 parts: statutory reserve, capital reserve, share premium, revenue and other reserves including investment fluctuation reserve, balances in profit and loss account. These are the 5 components of the reserves and surplus. So what is a brief audit procedure for reserves and surplus? Verify opening balance of reserves by comparing with previous year balance sheet. Check what is the movement in the reserves and surplus account, additions and deletions, and are they properly documented. Verify legal compliance for statutory reserves utilization and share premium. Verify that prescribed percentage of profit is transferred to reserve fund as per the norms. Check for exemption from transfers. Review documents granting such exemption. If at all there is a compulsory transfer requirement, but there is an exemption from RBI for that, check exemption guidelines. Ensure appropriation from share premium account comply with Companies Act requirement. Share premium can be used only for certain purposes. Verify compliance with foreign laws with respect to overseas branches regarding any reserves maintained by the foreign branch in overseas countries. Understood? Then deposits. Deposits, we know time deposits and demand deposits. 2 types of deposits. Now current and savings deposit. Verify that accounts opened during the year, and check KYC compliance on a sample basis, whether KYC requirements are complied or not. This is very important. KYC requirement is very important. Ensure savings accounts are open for individuals, HUF and approved institutions only. Savings account is not permitted for company. Savings account is not permitted for a partnership firm, LLPs, all this. Okay, only for individual and HUF, which are personal in nature. Only for them the savings account concept is permitted. Verify balances and check interest calculation and see that there is no interest paid on current accounts. and ensure balance confirmation procedure followed consistently on a sample basis, and ensure debit balances in current account are shown under advances, not netted out as liability. Most important. Suppose there is one question in CA Interbook in the recent case study. What is, like, a bank accidentally paid extra amount, okay, accidentally gave money to a customer, where the customer account balance turned debit. Generally customer account balance shows credit balance, means the bank has to pay. Deposit account shows generally credit balance. By mistake, bank has debited huge amount of interest, which is more than his outstanding amount, his eligible amount, and he withdrawn also. For example, that's treated as a loan. Excess balance in a customer deposit account, by mistake, if at all bank has transferred any extra amount, and if customer already withdrawn it, okay, the debit balance will be treated as what? Loan, advance. It should be shown under advance. MCQ, it is important. Next, and remember, once it is shown as an advance, automatically NPA norm is applicable. If at all it is overdue for more than 90 days, it is treated as substandard asset, and all provisioning norms and all will be equally applicable. Recently, just 2 days ago, Kotak Mahindra Bank, some issue happened. So some big amount has been debited, and of course the bank immediately freezed it. Ensure compliance with RBI guidelines on treatment of accounts which are inoperative, non-operative, dormant accounts. Check inoperative accounts for revival authorization, especially in case where significant reduction in balance compared to previous year. Suddenly there is a huge operations in the last year, and this year the account become non-operative. So whether the bank has restored correctly by following RBI guidelines or not, these non-operative accounts and all indicates money laundering activities, all that. Next up. Term deposits. Ensure deposit receipts and cash certificate, TD not required, not that much. General deposits compliance. Ensure deposit are not inflated for balance sheet presentation. Most of the banks, I don't know, they'll ask customers, sir, please keep balance on the month end, because for them, for a better reporting, if deposits are high, their loan lending capacity will be high. Understood? So for that reason, qualify in the main report in case indication of window dressing. Verify that interest accrued but not due is shown under other liabilities and provisions, not under deposits. Correct, obviously. Interest accrued but not due, so that should be shown under other liabilities and provisions. Ensure framework on KYC and anti-money laundering are formulated and put in place. Next, borrowings. Banks also borrow money. So no, one of the borrowing is money at call and short notice. I will lend it money at call and short notice. I will also borrow on money at call and short notice. So audit of borrowings. Borrowings are broadly classified like borrowings in India from RBI, from others, and from other institutions and agencies, and borrowings outside India. Now generally what I verify for borrowings, I will verify confirmation certificates. I will verify supporting documents like borrowing agreements, correspondence, all that. Use external confirmation received directly for reliable audit evidence. Ensure a clear distinction is made between rediscount and refinancing for proper disclosure. Verify that borrowings at call and short notice are properly authorized, and we know loan given on money at call and short notice, loan taken on money at call and short notice should not be netted off. It should be shown separately, because the parties are different, their parties are different. And ensure that branch has head office authorization for borrowings, and the terms of borrowings are as per the head office authorization. Verify that amounts shown under branch accounts are properly classified based on security. Then other liabilities and provision. Bills payable. Evaluate controls over bills payable. Ensure draft, mail transfer, traveler checks on standard form. Unused forms are kept under responsible parties custody. Verify reliable private code for coding or decoding. Ensure signatures on DDs are checked with signature book. Nothing but only authorized person should sign the DD. Confirm immediately telegraphic transfer DDs issued by the branch by an advice to concerning branches. Sample of outstanding bills payables you take. Check relevant register. Investigate old outstanding debits paid without advice. Ascertain the reasons for the same. That's it. Then contingent liabilities. In one of the exam in 22, this main question. How do you ensure all contingent liabilities are identified and properly valued? How do you ensure that? This question was asked. Okay. Obtain representation. They'll ask you, they'll design a case study like the auditor is verifying contingent liabilities, is concerned about bank's contingent liabilities because bank's contingent liabilities will be multiple, and he want to ensure that whether all contingent liabilities are present or not. In this regard, what procedure you will suggest him? Very simple. Auditor has to obtain management representation. What procedure? Auditor has to obtain management representation. Whether all, you need to get a representation from management that they need to represent all off-balance sheet transactions have been properly accounted as and when they occurred. Off-balance sheet transactions are supported by underlying documents. Year-end contingent liabilities have been correctly disclosed. No crystallized liabilities requiring provision are included in contingent. Real liability should not be included in contingent liability. Estimate amount of financial impact of contingent liability, which is based on best estimates as per AS 29. Review guarantees issued on behalf of bank directors for legal compliance. Ensure management justifies non-disclosure of remote contingent liabilities. If at all any contingent liability classified as a remote, no need to disclose. Look at the reasons and are they justified or not. And in case of letter of credit for import of goods, verify payment to overseas suppliers is based on shipping documents only and are in conformity with the terms of letter of credit. This was asked in MCQ. So a payment to importer and a payment to the exporter based on letter of credit we do, right? We only one shipping is done. So we don't just pay based on any bill raised by him, bill of lading, like that. One question is there in MCQ. Okay, the bank made a payment based on bill of lading. No, shipping document is the proof. Bill of lading means nothing but when goods are loaded onto the ship, that bill will be given. No, that is called bill of lading. That is not. Shipping document is important for us. Okay, so in case of letter of credit for import of goods, verify payment to overseas supplier who is an exporter is purely based on shipping documents and they must be in conformity with the terms in the letter of credit. And verify internal controls to ensure that contingent liabilities are properly identified. Review year-end contingent liabilities for accuracy based on prior period. Examine comfort letters issued by banks. Comfort letter is also nothing but similar to LOC. Similar to LOC. Comfort letters, no, some companies, no, they want to give a some companies, no, when they want to get some big contract, the other person will have a doubts on the financial capability of this company. So the other person want not a guarantee, but I want a proof that you are financially fit. Bank will give a letter of comfort. Letter of comfort shows, okay, that for the other party, letter of comfort given by the bank shows, don't worry, you can deal with this person, he is financially stable. That's it. It's not a guarantee. Letter of comfort is not a guarantee. And verify whether bank has extended non-funded facility, ad hoc facility to other than its regular constituents. Nothing but other than regular customer. If at all bank is given ad hoc credit or non-funded guarantees to somebody, check out. In such a case, ensure concurrence from existing bankers on customer's financial position. And this is what we need to get representation. Now these contingent liabilities are broadly classified into claims against bank not acknowledged as debt, outstanding forward exchange contracts, guarantees given on behalf of constituents, nothing but our customers, acceptance of endorsements and other obligation, other items that is contingently liable, bills for collection. These are all various classification of contingent liabilities. All these are contingents only. Understood? In exam they may ask you, write about classification of contingent liability. You need to write only headings. Okay, that's it. This matter you read later. Okay, then audit report. The auditor should state the following in the report to the central government. So auditor has to give opinion on these matters, especially this is applicable for all nationalized banks. Whether in his opinion, balance sheet is full and fair, containing all necessary particulars and properly drawn up to exhibit true and fair view of the affairs of the entity. Then in case the auditor has called for any explanation, whether it has been given, whether or not transactions of the bank have been within the powers of the bank, then whether or not the returns received from offices and branches of the bank have been found adequate, whether the profit and loss account shows a true balance of P&L, nothing but balance sheet P&L are the true and fair, whether transactions of the banks are within the powers of the bank, like that. Then whether returns received from offices and branches have been adequate, nothing but summary. Returns from branches means generally certain branches we don't visit, so regarding those branches we will get a summary, that's called return. So whether those returns are adequate. Then format of audit report, the same 700 series we follow, and we must include a disclosure on unaudited branches such as advances, deposits, interest income, all that we should clearly disclose unaudited branches. For example, you see State Bank of India, I think audit report is given here itself. No, so it will be given somewhere at the last they'll give. So lengthy, financial statements. All these are financial reporting disclosures only. You study financial reporting, that only. After you learned financial reporting, you must be able to read a company and entire notes to account, and you should be able to understand that, not the meaning, the context. Yeah, this is the auditor's report, And you see here, the auditor has given clearly here an indication. What he has given indication, 19,400 Indian branches were not subject to audit, and these unaudited branches account for 23% of advances, 42% of deposits, 18% of interest income, 34% of interest expenditure on the total income of the bank. Okay, so we need to give such a kind of disclosure. Include disclosure on unaudited branches for advances, deposits, interest income, interest expenditure. Gave or not? Next, the auditor must report matters covered by 143. CARO is not applicable for a bank. And rule number 11 of Companies Act, disclosures for their right, pending litigations, accounting standard, funding party, intermediary, and dividend declaration, audit trail, that are commonly applicable even for banks. Then, and RBI has given a circular on fraud. So if the internal auditor or external auditor, anybody, concurrent auditor, if at all they come across any fraud or suspecting any fraud, they must immediately report to RBI. So this is a requirement in RBI. And apart from audit report, the statutory auditor shall also give various certificates and reports. What are various certificates and reports? First one, report on IFC. Yes or no? Operating effectiveness, adequacy and operating effectiveness of internal financial controls over financial reporting. So auditor has to give a certificate on this. And of course, LFAR. And you need to give a report on compliance with SLR, DTL computation as well as SLR maintenance. You need to give a report on treasury operations, and you need to give a report on adverse credit deposit ratio. In one of the MCQ, what they mentioned, credit lending ratio they mentioned. Credit lending, credit itself means lending. Lending ratio, that's wrong. Credit means lending, deposit means this one. So credit deposit ratio, that is most important. Credit deposit ratio shall be always less than 1. Yes or no? Deposit, you have 100 rupees, you can lend only less than 100. You can't lend equal. Yes or no? So credit deposit, if at all lending is more than credit, that's a liquidity issue for the bank. Tomorrow the liquidity issue comes. Next, your auditor has to give a separate report on IRAC compliances, income recognition, asset classification and provisioning norms. Auditor has to give a report on compliance with recommendations of Ghosh committee, Jilani committee for frauds, internal audits, internal controls. Asset liability management, auditor has to give a report on corporate governance, and auditor has to give a certificate on reconciliation of securities and investment accounts and PMS account. PMS means portfolio management services. And auditor has to report serious irregularities which are identified by him under 143.12 fraud. That's it. So then finally the last topic, concurrent audit. Concurrent audit is not concurrent audit is not mandatory. First of all, it is only optional for the banks, and today only nationalized banks have concurrent audit system. Okay, there are many proposals on removal of concurrent audit also very soon, but we don't know when they will do that. So like who can be the concurrent auditor? Who can be the concurrent auditor? First of all, what is the scope of concurrent auditor? It is completely decided by Central Inspection and Audit Department after consulting with Audit Committee of Board of Directors. So the bank's audit committee and internal audit department together will decide whether concurrent audit is mandatory or not. Concurrent audit is different, internal audit is different. Internal audit is another level of audit where they predominantly focus on control. Concurrent audit is predominantly focused on transactions. Concurrent audit's approach is more of substantive. Internal audit's approach is more of compliance. Understood? In a bank. Then high risk transactions has to be compulsorily verified. Random transaction testing for high value transactions wherever required. Detailed scope of concurrent audit will be approved by Audit Committee of Board of Directors. Banks have an audit manual which includes detailed instructions for conducting companies or this concurrent audit. What is the purpose of concurrent audit? Why? What benefits concurrent audit will give? It's an early warning detection system and timely detection of irregularities, prevents frauds. Banks should review once in a year effectiveness of systems and take steps to rectify any deficiencies. And coverage of coverage in concurrent audit, what areas will be covered? Cash, investments, deposits and advances, similar points only will come. And foreign exchange and housekeeping. Housekeeping means in bank, in concurrent audit, internal affairs of a bank. Internal affairs of a bank is called as housekeeping. Whether they are maintaining properly the forms, whether they are doing daily reconciliations of cash balances, whether are they doing daily reconciliations of registers, are they maintaining registers and all correctly. Internal affairs of a bank, all internal control systems of a bank. So that is housekeeping. Okay, next, appointment of concurrent auditor. Bank's discretion, anybody can appoint. Internal staff, banks can appoint internal staff or external auditor, anybody. That's absolutely bank's choice. If at all internal staff is appointed, they must be experienced, well trained and sufficiency involvement. And most important, these concurrent audit staff must be independent of the branch being auditor. Suppose I have to audit so and so Nungamakam branch of Chennai, concurrent audit, I can send some other branch people there. Within the same branch employee, I cannot appoint him as a concurrent auditor. Next, terms and tenure. Audit committee will decide the terms of appointment of external chartered accountant firms, what is the coverage of area, what is required skill set, number of staff, time, everything the audit committee will decide. Remuneration is also decided by audit committee. Audit committee decides the maximum tenure of the external auditor. Maximum tenure is 5 years for a particular bank itself, and that too for a branch it is 3 years only. A single branch you cannot do more than 3 years concurrent audit, and for a single bank as a whole you cannot do concurrent audit for more than 5 years. Mandatory rotation is required. Next, then reporting system, reporting findings, zone wise reporting. These are all reporting systems in concurrent audit. And before you report, obviously you discuss with branch manager. You need to check whether action is taken on irregularity, and you need to see whether any fraudulent transaction, and concurrent auditor has to do follow up, because every month he'll be doing. Then finally, what is an audit committee? That's it. Bank audit is over. Okay, predominant tough topics I told. Wherever you generally don't understand, all those topics I covered. Okay, whatever I left is easy topics. Clear? With this, bank audit is over. We spent 1.5 hours on bank audit. Okay, good. So audit of NBFCs, non-banking financial companies. See, here there is a principal business criteria. You know, when an entity is called as an NBFC, if they satisfy principal business criteria, one is asset criteria, two income criteria, both has to be satisfied. If bank's financial assets are more than 50% of the total assets, and if the company's financial assets are more than 50% of the total assets, and financial income from financial assets, nothing but, is more than 50% of the total income of such entity, then that entity is deemed to be complying with principal business criteria, and it must register with RBI as an NBFC. So NBFC, their activities, they can't accept demand deposits. That's it. What is the difference between NBFC and a bank? NBFC cannot accept demand deposits. That's the main requirement. And NBFCs are not protected by deposit credit guarantee institution. That deposit, there's no insurance on for the deposit holders. NBFC can accept public deposits, and NBFCs are broadly two types: deposit taking NBFCs, non-deposit taking NBFCs. Again, recently, they have given something called scale based regulations. In 2021 they came actually, 21-22, that year they came actually, and later it was structurally improvised. Okay, as per these scale based regulations, NBFCs are broadly classified into 4 types: base layer, middle layer, upper layer, top layer. There are 4 classifications of NBFCs: base layer, middle layer, upper layer, and top layer. Now, in order to incorporate an NBFC, see, the moment you fulfill the principal business criteria, you cannot run that activity without a registration. And in order to register, you must have a minimum net owned funds of 10 crore. Now the latest rule is, if at all you want to newly incorporate an NBFC, 10 crore. The minimum required capital, net owned funds. The minimum net owned funds required is 10 crore. Further, there are certain NBFCs like peer-to-peer NBFC, account aggregator, or NBFCs where they do not have access to public funds, or where they do not have a customer interface. In all these NBFCs, 2 crore net owned fund requirement is sufficient. Whereas NBFCs, infrastructure NBFCs, okay, IDF, infrastructure debt fund, infrastructure finance, nothing but infrastructure lending related NBFCs, they must have a minimum net owned funds of 300 crore. And existing NBFCs were there. Remember, this 10 crore guidelines were given in the recent past, very just 1.5 years back, 2023-24, that time only it came. Now what about existing NBFCs who cannot comply with the 10 crore? For them, gliding path is given. Okay, by 31st March 2025, increase it to 5 crore. By 31st March 2027, increase it to 7 crore. Like that, something is there. Okay, 2025 it is some 7 crore. By 2025 31st March they need to increase it to 7 crore. Then by 31st March 2027 they need to increase it to 10 crore. Here it is given, you see. Here we have given. So for ICC investment and credit company, microfinance institution, and factor, current NOF requirement is 2 crore. By 31st March 2025, they need to increase it to 5 crore. Investment credit company, microfinancial, they need to increase it to 7 crore. Factors also they need to increase it to 7 crore. Whereas for Northeast regions, it is still 5 crore for microfinance institution. By March 2027, for all NBFCs, they must have to increase the net owned funds to 10 crore. So RBI has given a timeline for them to rectify their net owned fund requirement. For right now, any new NBFCs coming and incorporating 10 crore, except base layer NBFCs which are peer-to-peer, account aggregator, NBFC which do not have access to public funds or customer interface. Clear? So that's regarding main NBFC thing. This this capital net owned fund requirement related one. And again, NBFCs are again deposit taking NBFCs, non-deposit taking NBFCs, and So what NBFC can engage in, like what are various types of NBFCs depending upon activities they do? ICC, investment credit company, infrastructure finance company, core investment company, non-operative financial loaning company, infrastructure debt company, and microfinance institution, factors, asset finance company, loan company, mortgage guarantee company, asset reconstruction companies, so many. Then exempted, these NBFCs are exempted from registration with RBI because they already been governed by some other regulator, like housing financial institutions, merchant banking companies, stock exchanges, stock stock brokers and all, because these are all covered, these are all controlled by SEBI, all that. Now remember, many housing financial institutions now are coming under RBI purview. This is not yet updated list, this is there in our book. So from book point of view, this only you cover. Then venture capital funds, who are all covered by SEBI, Nidhi, MCA, insurance companies, IRDA, chit fund, MCA, specified microfinance companies, probably delegation would have been given to MCA, and securitization and reconstruction companies, SEBI will control. Mutual benefit companies, core investment companies, alternative investment fund. And remember, core investment company, what is a core investment company? We know, to call an entity as an NBFC, minimum 50% of it must be financial assets, minimum 50% will be financial income. If at all, an NBFCs whose 90% of the assets are represented by investments, whose 90% of the assets are represented by investments, we call it as what? Core investment company. Now there is a difference between core investment company and non-operating financial holding company. Like where is it? Now here you see there is a core investment company, non-operative financial holding company. Non-operative financial holding company, this company also invest in other companies only, but as a holding company they will invest. Core investment companies can invest, they may be holding company, they may not be holding company. Understood? Tata Sons is a core investment company, that's not a non-operative financial holding company. Earlier we used to have Aditya Birla head group holding one company is there, that's a non-operative financial holding company. Next up, now regarding core investment company is a type of NBFC. It must register with RBI as an NBFC, but there are two core investment companies which are exempted completely. One, a core investment company whose asset size is less than 100 crore, straight away exempted. A core investment company whose asset size is less than 100 crore, it's straight away exempt. And a core investment company whose asset size is more than 100 crore and not accessing public funds, then they are exempted from registration. Suppose if you are a big core investment company, more than 100 crore you have asset size, but you don't have any public funds at all, it's a private sector, completely private limited moreover. Understood? For example, if it is not having any access to public funds, then that is also exempted. So which means a core investment company which is having access to which do not have access to public funds is straight away exempted, or a core investment company which has access to public funds but less than asset size 100 crore, that is also exempted. Next, and remember, this is called as less than 100 crore, no, this is called as non-systematically important NBFCs. Core investment companies less than 100 crore is called as non-systematically important core investment company. A core investment company which is having asset size more than 100 crore is called as systematically important. For remaining all other NBFCs, systematically important criteria is 500 crore. For remaining all other NBFCs, systematically important, the criteria is 500 crore. So NBFC non-systematically important means the asset size is less than 500 crore. NBFC systematically important means the asset size is more than 500 crore. I'll tell you why this point has a relevance later. Okay, now layers. Now recently, based on scale based regulation, based on scale of activity, the RBI divided NBFCs into multiple parts: base layer, middle layer, top layer, upper layer. Upper layer is empty right now, nothing is there. Okay, top layer, top 10 NBFCs will come by default in the top layer. Top 10 NBFCs by asset size. Okay, top 10 NBFCs by asset size. You can find a big list of NBFCs that are registered with RBI. Some approximately less than, some we have seen that number 1000 or less than, some less than 10,000, some number is there. Okay, a very huge number of NBFCs were there in India. Okay, so top 10 NBFCs, we used to see that list in our class. Okay, fine. So base layer, middle layer, upper layer, top layer, upper layer and top layer. Sorry, base, middle, upper, top layer. Top layer is ideally empty. RBI will populate from upper layer to top layer based upon the risk. Upper layer, by default, top 10 NBFCs will come in the upper layer. Then middle layer, base layer is the question ultimately. And remember, government owned NBFCs are by default either base layer or middle layer. Until notified, they will never form part of upper layer. Even though a government owned NBFC comes in the top 10 in the asset size, they still be classified as middle layer or base layer. Clear? Now this NBFC base layer. So NBFCs which are having asset size below 1000 crore, they will be straight away classified as what? Base layer. Now further, NBFCs engaged in these activities, they will always come under base layer. See, one is monetary requirement. If the NBFC amount is less than 1000 crore, it automatically comes under base layer. Sir, I am an NBFC, I have an asset size more than 1000 crore, but I am involving in peer-to-peer lending, account aggregator, non-operative financial loaning company, or I am an NBFC which do not have access to public funds and customer interface. What about me? You will also come under base layer. For them, asset size is not required. Asset size is irrelevant. These 4 NBFCs straight away fall under base layer category. Clear? Then coming to middle layer, these 5 NBFCs will always come under middle layer. What are they? SPDs, standalone primary dealers, IDFs, core investment company, housing finance companies, infrastructure finance companies. This is where the conflict will come. In one of the exempted category, HFIs are exempted, right? Housing finance insurance is exempted, right? But then why housing finance companies are covered under middle layer? One common doubt. Understood? That's why I told that exemption list is not updated clearly. Okay, so housing finance companies are regulated by RBI now. Okay, so fine. So SPDs, these all 5 NBFCs always come under middle layer, irrespective of asset size. They may have an asset size less than 1000 crore, doesn't matter. They will come under middle layer. And what all other NBFCs come in middle layer? Deposit taking NBFCs will come under middle layer, and non-deposit taking NBFCs with asset size 1000 crore and above will also come under middle layer. So 3 categories of NBFCs come under middle layer. Deposit taking, straight away middle layer. Asset size doesn't matter. Non-deposit taking, then asset size matters. More than 1000 crore come under middle layer. These 5 NBFCs automatically come under middle layer. So SPDs, infrastructure debt for non-operative financial holding company, housing finance company, infrastructure finance company. All infrastructure companies were there. Non-operative financial holding company is there. Standalone primary dealers were there. Then peer-to-peer account aggregator. Peer-to-peer account aggregator, non-operative financial holding company, and NBFC is not having access to public funds. That will come under base layer. Here, IDF, core investment company. You see, I told non-operative financial holding company, core investment company, both of them, they do investing only. But non-operative comes under base layer, core investment comes under middle layer. Be careful. Next, upper layer. Top 10 NBFCs by asset size will always be in this layer, regardless of any other factor. And top layer, ideally empty, will be populated by RBI. If there is a substantial increase in systematic risk, RBI will categorize and some NBFCs into top layer. Top layer means direct monitoring by RBI every day. Next, categorization of NBFCs carrying out specific activity. The same thing is repeated here. Then what about other NBFCs? The following NBFCs, like ICC, MFI, Factor, mortgage guarantee companies, all these companies will be classified according to the base layer, upper layer, base layer, middle layer, according to the conditions which they satisfy. They may come under yet any layer. If these NBFCs asset size is less than 1000 crore, they come in base layer. If these NBFCs asset size is more than 1000 crore, then they come in middle layer. That's it. Now, government owned NBFCs always in base layer or middle layer. Okay, this will never be coming in upper layer until further notice is given by RBI. Now, NBFCs deposit taking, non-deposit systematically important. Earlier, NBFCs we used to classify them as NBFC deposit taking, non-deposit taking. Non-deposit taking is again classified as systematically important, non-systematically important. Now, how they are referring, NBFC non-deposit taking will be referred to as base layer. NBFC deposit taking and systematically important, they will be referred as either middle layer or upper layer depending upon the applicable classification. Now you see here, this create a confusion. NBFC non-deposit systematically important, you are straight away saying it as middle layer or upper layer. Systematically important means if more than 500 crore is that is sufficient. NBFCs which is having more than 500 crore, that is sufficient to call it as a systematically important. Now if you are saying systematically important under middle layer says 1000 crore. Systematically important criteria 500 crore. That's why they give a clarification. Existing NBFCs which are non-deposit and systematically important, where asset size is between 500 crore and 1000 crore, yes or no, they will still come under base layer. So they gave a clarification like this. Clear? All of you? Next, and difference between NBFC and bank you can understand. Prudential norms. Capital ratio for NBFCs. NBFCs must maintain a minimum capital ratio of 15% of the aggregate of risk-weighted assets, which we call it as RWA, risk-weighted assets. And in this risk-weighted assets, 10% of RWA must be Tier 1 capital. Whereas NBFCs, which are lending predominantly against gold jewelry, minimum Tier 1 capital must be 12% of RWA. Are you clear? Now, what Tier 1 capital can include? Own funds will be included, perpetual debt instruments will be included. Okay. Now, again, NBFC base layer, perpetual debt we will not at all consider in Tier 1. For remaining NBFCs, perpetual debt can be included. If at all perpetual debt is included for remaining NBFC, that perpetual debt portion cannot exceed, 15% of the aggregate of the tier 1 capital. Suppose if at all perpetual debt is beyond 15%, up to 15% of tier 1 capital, we will up to 15% of last year's tier 1 capital. In the current year, we will add it to tier 1. If I have excess amount, I will classify into tier 2 capital. Understood? Now, own funds means what? Own funds means total own funds reduced by investment in other NBFCs and related group companies in excess of 10% of the own funds. In the recent May 25 also, a problematic question is given on this. Even in the number 24, a problem question is there. Almost in the past 2 attempts, there is a question on this. Then tier 2 capital, preference shares which are non-convertible, revaluation reserve, discounted at 55%. Discounted means what? For example, 100 is there. Discounted at 55 means only 45 you should consider. Only 45 you should consider. Originally, in the number, in the ICA book or somewhere, there is a mistake in the problem. Okay. Later, in the MTP, there was a mistake. Later, it was rectified. Okay. Next up. General provision and loss reserves. Maximum 1.25% of risk-weighted assets. Hybrid capital instrument, subordinate debt, excess perpetual debt instrument. Excess perpetual debt means what? Up to 15% of tier 1 of the last year closing. Yes or no? That will come under tier 1. Excess perpetual debt will come under tier 2. Then, and remember, total tier 2 capital cannot exceed tier 1. Forget about it. Tier 2 capital is substantially lesser than tier 1. Yes or no? Tier 1 will be 10, 2/3 of total 15. Yes or no? In case of gold lending, it is 12 out of 15, almost 80%. NBFC's base layer cannot include perpetual debt in tier 2. Very simple. If at all you are a base layer NBFC, perpetual debt is not at all considered as part of capital. Are you clear? Now, total capital, tier 1 plus tier 2 computed. Then you will get total capital divided by risk weighted assets multiplied by 100. You will get ratio. And that ratio must be 15% as a whole. Clear? Next. Risk weighted assets, that's not important. In exam, they'll give you directly. Asset categorization. Standard assets are those assets where there is no default in repayment of principal, nothing, no default at all. Substandard means what? An asset classified as NPA. I will discuss non-performing asset definition, then I'll go for asset classification. NPA. When an NBFC related asset will be treated as an NPA, if there is an overdue for more than 180 days, there are various types of advances, various types of incomes which will be treated as NPA because they were overdue for more than 180 days. And the period of more than 180 days shall be adjusted as per the gliding path. Now, for your exams, March 31, 2025, this is important. Okay, very simple. Whenever you're writing an exam, what is the latest completed year you should check. Right now, what is the latest completed year? 31st March 2025. So that limit only is applicable for you. Okay, if you're writing May 2025 exam, March 2026 is relevant. Very simple. If you're writing Jan 2026, March 25 is relevant. Last 31st March is when? Before your exam date, last 31st March. That is only applicable for audit, for income tax, everything you see. Yes or no? If for May 2025 income tax paper or DT paper is based on assessment year 25-26, which is previous year 24-25, same logic. Now, so for us right now, if at all an MCQ comes, what is the capital? What is the NPA norm? What is the NPA norm? You can directly say that it is 120 days. Whereas by next year, it must be reduced to 90 days. Like there are existing some NBFCs which are already following 90 days. Earlier, no. All systematically important NBFCs, deposit taking NBFCs, 90 days is only norm. Only for non-systematically important NBFCs, 180 days norm is there. Right now, base layer, middle layer, upper layer. Simply speaking, middle layer NBFC, upper layer NBFC by default 90 days norm. Base layer NBFC is only 180 days norm is applicable. Are you clear? And any NBFC which is already following 90 days because systematically important criteria. Yes or no? For them, they should not again go back with this gliding path. They just have to continue using 90 days norm. And if you see here, capital gliding path, if you see 23, 25, 27. The years 31st March 2023, 31st March 2025, 31st March 2027. Whereas here you see 24, 25, 26. 1 year gap exactly. Okay. For net owned funds, gliding path is 2 years gap. Whereas for NPA norm, gliding path is 1 year because NPA norm is more severe than capital. Okay, next, provisioning requirement. Now, NPA you understood. I hope now you understood regarding NPA classification. Once you classify as an NPA, straight away, the moment it became an NPA, it goes into substandard category. It goes into substandard category. How long in a substandard category an asset can continue? In case of base layer, up to 18 months it can continue in substandard category. Up to 18 months it can continue in substandard category. And in case of middle layer NBFCs and above, up to 12 months. An asset whose terms have been renegotiated, rescheduled, or restructured until 1 year of satisfactory performance, they all come under again substandard category. And remember, if at all you are doing restructuring of a doubtful advance, then it's doubtful only. If at all an asset is already classified as doubtful, that time a customer came for restructuring, then we restructure it, then it's a doubtful. Suppose a customer where NPA not yet came, it has not yet become NPA, now itself customer came for restructuring, then I will classify into substandard. Doubtful means what? Suppose if an asset is remaining in substandard for more than 18 months, up to 18 months substandard, the moment it crossed 18 months after it became NPA, doubtful category. And loss asset, once in doubtful category, D1, D2, D3 levels will be there. After that, banker may classify based on internal auditor's recommendation, concurrent audit recommendation, stat audit recommendation, or RBI recommendation. Based on something, they will classify the loan into a loss asset. Loss asset means either they will provide 100% provision or they will write it off the customer account. Next. And that's it. So with this NPA, classification is completed. Now provision for loss assets, 100% of the outstanding amount must be provided for, if at all asset is allowed to remain in the book. You don't want to keep the asset in the balance sheet, straight away write off. Then doubtful asset, 100% provision on the unsecured portion. If at all there is a security and secured portion is there of some advance, then up to 1 year 20% provision, D1 category. Once it comes under doubtful category, after 18 months or after 12 months in case of middle layer, okay, and first 1 year 20% provision, then we need to increase it to 30%, then we need to add 30%, then we need to add 50%. Are you clear? Yeah, it's add only, actually it's add only. Yeah, totally no, it's totally 100. It will become 100. So by the time of D3 comes, it will become 100. Next, substandard asset, 10% provision of the total outstanding amount must be made. Standard asset provisioning, NBFC base layer must provide 0.25%. For base layer NBFCs, the provision requirement is 0.25. Even standard asset also, there is no NPA. Still we create a provision prudence concept, 0.25. For middle layer NBFC, 0.4%. What about upper layer? Differential rates. For upper layer we don't have in the syllabus, but in RBI guidelines for upper layer differential rates. Housing loan NBFCs housing loan standard asset different rate. Car loan standard asset different rate. Education loan standard asset different rate. For upper layer NBFCs, differential rate of provisioning is required for standard assets. Since differential rates are there, they didn't put in our syllabus. That's it. Next. Now what is the audit procedure? First you should ascertain the business of the company, which is a simple matter. You need to evaluate internal control system, which is also a simple thing. Verify registration with RBI and see that the NBFC has a minimum net owned funds of 10 crore. And verify NBFC acceptance of public deposit directions, very important. In this chapter you will be getting so many directions: acceptance of public deposit directions, audit report directions, and scale based regulation compliance directions. Like that set of directions will be there in this particular chapter. Earlier we have non-deposit taking systematically important deposit taking directions, non-deposit taking non-systematically important directions, okay, and RBI NBFC acceptance of public deposit directions, RBI separate reporting directions. Like that various set of directions were there. Okay, now this is regarding acceptance of public deposit directions, that one. Now if at all an NBFC is accepting public deposits, the auditor has to check the following, most important: sealing on public deposit and credit rating. So NBFCs, I think this point is common even in company law also. In company law you might have seen in deposit chapter, where a company want to raise money in public deposit, first they need to get a credit rating. Yes or no? Only after getting credit rating, the deposit amount, how much they can raise, will be decided. So sealing on public deposit based on credit rating, and check public deposits accepted or as per the agreed credit rating. And interest and brokerage calculation must be calculated. Written application must be there. Maintenance of deposit registers must be there, and deposits are paid on time. In case of delay, reasons has to be checked. Investment in approved liquid asset. The moment you are accepting public money, you need to maintain liquid assets. That's what even is there in Nidhi company. 10% liquidity then to maintain, 10% in unencumbered term deposit. Timely filing of returns with RBI for deposits accepted by you. If NBFC does not accept deposit, check whether board resolution is stating so. Suppose if the NBFC is a non-deposit taking NBFC, they need to pass an explicit resolution that we decided not to accept deposits. and ensure board resolution, confirming investment in group company shares, and in case of credit rating downgrade, this is most important. This was asked even in exam for 4 marks. Okay, in case of credit rating downgrade or upgrade, ensure that deposits are adjusted within the specified time frame. So whenever there is an upgrade in credit rating, you can accept more deposits. Whenever there is a downgrade, you need to follow certain compliance. Moreover, you see here the format, if downgraded below minimum investment grade. What is below minimum investment grade? You know, that's the lowest rate. That's the entry level credit rating which is required to accept a deposit. Your credit rating falls below the entry level. Then what NBFC has to do? Stop accepting the deposits, stop renewing the deposits. Whatever deposits right now is already there, no, up to maturity, hold it and report to RBI within 15 days what action you are going to take. And no, don't renew without explicit consent of the borrower. Clear? Actually, here we will not at all review. RBI will not permit you to renew. If at all an NBFC credit rating falls below minimum downgrade, minimum credit rating, yes or no, they should not accept deposit. Whatever the accepted deposits they have, they need to repay. Clear? Next, and obviously prudential norms verification. Prudential norms verification means nothing but asset classification, income recognition, and prudential norms. Then classification of frauds. You know, there will be so many frauds that will be happening in many banks, financial institutions, all that. RBI has given a framework for fraud classification. Every NBFC, because no, in NBFC any fraud happen, they need to report to RBI. Now when they're reporting to RBI, you know, what is the type of the fraud they need to select? What is the type of the fraud? So accordingly, RBI classified types of frauds in NBFC into following categories. What are they? You know, fraudulent encashment, unauthorized credit facility, negligence and cash shortage, cheating and forgery, irregularities in foreign exchange, other types of frauds. And this requirement is applicable even for foreign branches. And now, negligence and cash shortage. You know, negligence and cash shortage is treated as fraud only if intention is proved. However, in the following two cases, even if intention is not proved, it doesn't matter. Since the amount involved is more than 10,000 rupees, it is always a fraud. So if there is a cash shortage more than 10,000, straight away fraud. Further, if cash shortage is not more than 10,000, it's just beyond 5,000, but cashier has not reported regarding this, then also it is treated as fraud. Are you clear? Then for NBFC, ICC means what? Investment and credit company, which means this company will do investing, this company will give loans. Investment credit company means their activities, they invest and they give loans. They raise capital, they raise deposits, or they raise some funds and then they invest or they give loans. That's why you see initially for until certain points investment related audit, and afterwards, you know, here all deposits, I mean advances, loans and advances related points you will find. Understood? Now here one observation, unquoted debentures and bonds. Ensure that unquoted debentures and bonds are not treated as investment but treated as term loans. Suppose if an ICC, if an NBFC ICC purchased unquoted debentures, unquoted bonds of another entity, that is not treated as investment, that is shown as a loan. Are you clear? That's why you see in NPA norm, interest on securities point is covered. Yes or no? Because it is treated as loan. It is treated as loan. Next, just 1 minute. Yeah, next one. So auditor's duty with what? Compliance with RBI auditor's report direction. RBI has reposed something called audit report directions, so auditor has to comply with that. In that, the one of the important direction is auditor has to file something called exception report to RBI. Auditor has to file something called exception report. This was asked for 4 marks once. Okay, now like what is an exception report? Exception means what? Unusual things, non-compliances, that's it. Exception means non-compliances. If auditor finds that the company has not complied with provisions of chapter 3B of RBI Act, provisions of chapter 3B is nothing but 45 series, section 45 series. 45 series in RBI Act is nothing but dealing with NBFCs. Okay, or NBFC acceptance of public deposit directions. If auditor find a non-compliance with RBI Act, if auditor finds a non-compliance with acceptance of public deposit directions, if auditor finds a non-compliances with directions, scale-based regulation directions, in all these 3 directions, in all these 3 laws and regulations, nothing but if auditor identified any non-compliances, the auditor must report the details of those non-compliances to RBI regional officer under whose jurisdiction the company is incorporated. Okay, then the audit report should only cover contraventions, and the report need not include regarding compliances. You don't have to talk about compliances, you only have to report exception, not only non-compliances. There will be some form, all that will be there, we don't have to know it. Next, then now there are some specific issues that you need to report in case of an NBFC which is not accepting public deposit. That too, this is a report to board of directors. Here reporting requirement is there, right? RBI reporting directions were there, right? First you should give audit report. That is one common thing. Apart from audit report, you must give a special report to board of directors. Apart from report to directors, you must file a report to RBI. Just now we saw what you need to file with RBI. Now we should give a report to directors, right? Now this report is again subdivided into multiple types. Suppose if an NBFC is not accepting public deposit, if at all they don't have a public deposit, you as an auditor has to give a special report to directors of the NBFC. What you need to report in that? First, whether board resolution is passed or not. An NBFC which is not accepting public deposits, they must have an explicit board resolution every year that they will not accept public deposits, and ensure that the company has not accepted any deposits during the year. An auditor shall also give a report to directors that whether they complied with the prudential norms or not. And further, the auditor has to give a report to director that whether this particular NBFC, whether your NBFC is maintaining capital requirement adequacy ratio correctly or not. Ensure that CRAR disclosed in the return submitted to RBI is correctly calculated and compliant with CRAR norms. And verify that the company has submitted annual statements of capital fund, risk assets exposure, risk ratio, all that within specified time frame. And further, see that whether the NBFC has been correctly classified as a microfinance institution as per master directions of RBI. That's it. These are the specific points which auditor has to check and then report to board of directors. And apart from this, suppose if at all the NBFC that you are auditing is accepting deposits, then the auditor has to make a special report to directors on these matters. First one, whether the public deposits and borrowings like unsecured debentures, all this are within the limits prescribed by NBFC public deposit directions. Check whether excess deposits beyond permitted limits have been regularized. Regularized means what? Beyond my credit rating, I accepted, I need to rebate. Next up, public deposits without credit rating. Verify that NBFC is not accepting deposit without a minimum investment grade. Remember, investment credit rating is there, right? Grading is there, right? That is there for the NBFC, and not only that will be there even for multiple deposit schemes. Suppose if a state bank is there, you go fixed deposits, multiple schemes will be there. For each scheme, credit rating will be there. Understood? Then confirm whether capital adequacy ratio disclosed in the return which is submitted to RBI, is it correct or not? And for NBFCs without minimum investment grade, check whether credit rating for each FD is valid and assigned by approved credit rating agency, whether aggregate deposits have exceeded specified limit of the credit rating at any point of time during the year. This point we need to check for which NBFCs who do not have even minimum investment grade, who actually failed. Technically they are downgraded, technically they need to repay. Yes or no? But they will get credit rating for FDs. Whatever the FD they accepted, rating they will get. Then RBI, auditor has to report to board of directors regarding compliance with prudential norm. Auditor has to report to board of directors regarding NBFC's compliance with liquid asset requirement. Liquid asset requirement will come wherever deposits are there, remember. And auditor has to give a report to directors whether the NBFC is submitting return of deposits on time correctly or not. Auditor has to report to board of directors whether the NBFC is filing quarter returns correctly or not. All that. See, all this information directors are already aware of it, but we need to check and then report to board of directors whether everything is okay or not. Are you clear? Then commonly for all NBFCs, what you need to report? Whether certificate of registration is valid, whether certificate of registration, suppose if at all the NBFC is exempted to hold certificate of registration, whether the exemption criteria is fulfilling or not. And certificate from statutory auditor, this itself can be asked as a 4 marks question or 3 marks question. SASE, certificate from statutory auditor. What is this certificate? NBFC must submit a statutory auditor certificate confirming. Remember, this certificate NBFC has to obtain from auditor, and this certificate has to be filed with RBI. So every NBFC should obtain a certificate from stat auditor and file with RBI. What certificate? That the company is engaged in NBFC and the company is eligible to hold certificate of registration, and this certificate must be filed with RBI office within 5 working days of signing of the audit report, but not later than December 31st of the same year. Within 5 days of audit report being signed by the auditor, ask him SAC certificate and file with RBI. Then the format of SAC is prescribed in master directions. So write about statutory audit certificate in the context of NBFC. 3 marks question might come. Clear? That's it. NBFC is over, typically speaking. Then we have CARO related, which we already covered. Okay, I already covered in CARO. Then Ind AS. So NBFCs must comply with Ind AS. Now there is a difference between division 2 and division 3 reporting. What are the differences? You better understand that than me. Okay, that's it. Clear? NBFC is over. Confident? Got entire that overview? Any confusing point in NBFC? All dots connected? Yeah. Yes, let's begin group audit. And in this, the most important one is the first one, the last topic. The last topic in the group audit topic. Now, so reporting in case of group audit. Group audit is nothing but audit of consolidated financial statements, nothing but, okay. Now, in consolidated financial statements audit, the reporting is most important, where there are 5 circumstances. There are totally five different scenarios over there. Okay, when you're reporting on group audit, there are 5 scenarios you should consider. Like the parent auditor himself will be auditor for all the components also. In the consolidated financial, subsidiaries, associates were there, right? I'm the same auditor is for parent, same auditor for subsidiary. Now what is the reporting requirement? In that case, audit report shall include whether principles and procedures, are they following relevant accounting standards. You need to give an opinion on the consolidated financials, whether they are giving true and fair view. And if CFS also includes a cash flow statement, you must give an opinion on that, which is very simple. In this circumstance one, scenario 1 is nothing, not a big deal. Scenario 5, you see, suppose if at all some components are not at all audited, okay, if you know, ideally all components will be audited either by the parent auditor or component auditor. If at all any of the component is not audited, parent auditor must evaluate what modifications to the CFS audit report is required, because not audited means what, evidence is not available for that. Whether the component is true and fair or not, I don't know. Yes or no? Because it leads to non-availability of sufficient appropriate evidence. And not only that, you must also assess qualitative and quantitative impact of unaudited balances and decide about possible modified opinion. If any component is not audited in a consolidated financials, there is a possibility that we might give a modified opinion. That's it. This is general rule. But for banks and all, if many components are not audited, we accept them as true because RBI itself said it is exempted. Since in the law itself, since it is exempted, we still give unmodified opinion even though the components were not audited. Clear? Now suppose, if component auditor is using a different auditing framework, like what is auditing? Like for example, if I have a foreign component where they are doing audit as per foreign GAAP, and our Indian head office or our holding company is doing, like, yeah, foreign component means here subsidiary companies. In this entire chapter, component means subsidiary companies, associate companies, not branches here. Okay, so if at all a company has a foreign subsidiaries which are preparing financials as per the foreign GAAP, and where the audit is also being performed as per foreign GAAP, we need to request the foreign company auditor to do audit as per Indian GAAP and submit a separate report on the same. That's it. So components audit should be conducted audit under Indian GAS, nothing but Indian General Accepted Auditing Standards, for consistency purpose. If component auditor follow different framework, then it should be aligned with Indian GAAP so that the parent auditor can rely upon it. Sometimes, obviously, if there is a foreign component, okay, foreign component auditor uses a different accounting framework. It's not about auditor using framework, subsidiary is using the framework. Suppose if there is a foreign subsidiary and they are using an accounting framework which is different, okay, generally in all these multinational companies, what they will be having is group accounting policies, group manuals will be there. Okay, so group accounting manuals will be there. So whenever this company acquire another company in foreign country, or whenever they incorporate another company, they will give this group manuals to them, and they will have to follow they will have to prepare financials, a method of accounting, everything will be as per the group manual. So some foreign components prepare financials as per the local GAAP, and their auditors may not be familiar with parent's GAAP, because parent GAAP is Indian company. Now parent management, what they will do, they will convert the foreign component financials into parent GAAP before consolidation, and parent auditor verify conversion adjustments. If at all foreign subsidiary financials are converted into Indian GAAP, then we need to verify whether conversion is properly made or not. Then sometimes some components may prepare financials directly under parent's GAAP using group accounting manual. Then now what is parent auditor's role in this case? You need to ensure whether group accounting policies comply with parent GAAP, and you need to ensure whether you can rely on component auditor's report and make a reference in the auditor report accordingly. Are you clear? Then the final scenario, you are not the auditor for all the components, means you are auditor for parent and few components, and for some components somebody else is the auditor. Then if somebody else is the auditor, in other matter paragraph, if at all you're relying on other auditors, the auditor has to disclose the magnitude of portion of financial information audited by other auditors. That's why you see SBI other matter paragraph report, you see they will mention 6,000 branches were audited by other auditors, 300 subsidiaries were audited by other auditors. Like that in Reliance other matter paragraph they will mention. Such a disclosure is made under other matter paragraph. And quantification, specify the rupee amount or percentage of total assets, not only mentioning that other auditors audited, what is the percentage audited by them, or mention the monetary amount at least. Okay, then unaudited, disclose total assets, revenue, cash before applying consolidated adjustments. And mentioning other auditors work is not a qualification, it just shows a divided responsibility. That's why even in other matter paragraph also at the end we mention that our opinion is not modified on the above. That reporting is common for even other matter paragraph. That's it. One of the key concepts is completed. Clear? Next, with respect to consolidated financials, we need to get some representations. Right question can come 4 marks. Okay, what are the examples of written representations that we get in the context of consolidated financials? We get written representation from the management where they need to give a declaration. What declaration? They need to give a declaration that all the components are identified and included in consolidated financials. They need to identify reportable segments for disclosure. They need to identify related party transactions, all that for the purpose of consolidation. They need to verify appropriateness and completeness of current period adjustments, permanent adjustments, including eliminating intra-group transactions, all that. These are all management responsibility for preparing consolidated financial statements, and whether they fulfilled all this responsibility or not, they need to give a specific written representation. Clear? Next, by the way, from whom you will get the representation? Parents management. Yes or no? Because who is responsible for preparing consolidated financials? Parent company management. That's it. So the auditor of CFS must ensure that parent management acknowledges their responsibility for CFS and approves the CFS in compliance with financial reporting framework. Written representation under group audit, they'll ask this question, right answer. Clear? Next. Now here this is regarding temporary consolidated audit process for CFS. Okay, yeah, audit process. What is the audit process for CFS? In this only important point I'll try to cover. There are some disclosures which are there only in standalone financials. These disclosures will not be required in consolidated financials. Example, bonus shares, sources for bonus shares, unutilized funds which is raised from public issue, MSME related disclosures for trade payables, all that. Details of investments in other corporates, carriage insurance freight, CIF value of the imported goods, what is the expenditure incurred in foreign currency, value of imported goods and indigenous raw material, foreign remittances, foreign exchange earning. You see, these are all specific to a particular company. That's why they will only appear in specific company financial statements. These are not specific something to a group as a whole. So in the group financial statements, company related specific information is not required. Company related specific information will be given in the standalone financial statement. So these points will appear in standalone financials but not in consolidated financials. Are you clear? No, this was asked already. 4 marks question was asked in previously. Then there are some disclosures which are exclusively made in CFS. Like what are they? In CFS, we must separately disclose in respect of each subsidiary, each associate, what is the net assets amount and what is the percentage of the consolidated net asset. In respect of each component wise we need to disclose. This data will decide what is a significant component, other component. Okay, profit or loss amount and what is its percentage on the consolidated profit, and other comprehensive income of various components and what is their percentage on the total consolidated. Consolidation adjustment should be separately disclosed. These points are something which will appear in CFS but not in SFS. That's it. Remaining all not required. This current period consolidation adjustments are not required. Permanent consolidation adjustments are also not required. Then what is the audit process for audit of consolidated financial statements? In this somewhere materiality related discussion will be there. Okay, first I will cover that and then come here. Yeah. What are the audit considerations while conducting audit of CFS? What are various considerations? You don't have to worry about the main headings because subtopics only will be asked in exam. Materiality determination. This also was asked in 23 attempt. So somewhere, okay, materiality. For standalone audits, materiality is decided based on the subsidiary company financial statements. When you're for consolidated financials, materiality will be decided based on group financials. Yes or no? So in consolidated financials, auditor computes materiality at group level to assess consolidation adjustments, whether are they correctly done or not, whether a component financials significantly impact the group financials or not, whether additional components should be included in audit or not. The principal auditor may communicate materiality to component auditor for a consistent approach. Are you clear? Next, that's it. In that, this is only important aspect. Then coming to audit process. What is the audit? I mean, auditor has to plan before starting the audit of consolidated financials. What? Understand the group structure. What are the group wide controls? What are the IT systems used for consolidation purpose? Because there will be something called consolidation tool. Okay. Next, review accounting policies of parent and components along with the translation of foreign components. Determine nature, timing, extent of audit procedures based on risk of MMS in consolidation process. You need to see what consolidation tool they are using, what consolidation method they are following, and identify risk of MMS and evaluate need of other auditors and coordinating the work accordingly. So these are the points which auditor has to plan, yes or no, in order to efficiently and timely conduct the audit of consolidated financials. 4 marks question. Next, audit process. Get a list of all the components. Like what you will do in first, get a list of all the components and see whether they are included in CFS unless they are exempted. And verify completeness of information, whether all the components are included correctly. Compare with last year working papers. Check the investment register and review joint venture statute records and shareholding changes. You will understand whether are there any changes in subsidiaries and associates, are new subsidiaries added, existing subsidiaries were removed, yes or no, or there is any change of status from associate to subsidiary or subsidiary to associate. Document audit procedure for completeness and verify various means of control, joint control, significant influence, all that. So where and all we have a control, joint control, or where and all we have influence, you will get the data from board meeting minutes, shareholder agreements, and post year-end transaction after 31st subsequent events data. Clear? So this is the audit process for consolidation. 4 marks question. Understood? So one of the important consideration in preparing consolidated financials or in auditing consolidation financials is audit process. What do you mean by audit process here? So obtain list of all components and see that they were included. Verify completeness of information. This itself can be asked as a 3 marks question. When auditor is auditing consolidated financial statements, the auditor is concerned about completeness of inclusion of the components. Regarding completeness, what specific procedures auditor will perform? Auditor has to review prior period working papers of known components, check investment details of the parent and component, review joint venture statute records and shareholder changes. By looking at these information, you can understand, you can get evidence on the completeness. And of course, regarding completeness, at the end, management representation also we will get. Clear? Now, excluded components we have already at the above we will show you. Then that's normal. What are the objectives of auditor in audit of consolidated financials? So objective, very simple. Objective is to ensure that consolidated financials are in line with applicable financial reporting framework. And objective is to express opinion on the consolidated financials. And auditor should also inquire into all the 6 matters for consolidation financials. And auditor has to report on 143 subsection 3, all A to J, 16 matters were there, right? They are all applicable. And validate whether the company is required to prepare consolidated financials as per financial. First of all, is it required or not? And remember, CARO does not apply for consolidated financials except clause number 21. Clear? Then, there are certain instructions which a parent company will give to components management regarding consolidation. What instructions? Components must follow parent accounting policy. They must comply with disclosure requirements of the parent. Segment reporting. Components has to identify segments. Components has to identify related party. Components have to follow a specific timeline for submission of their standalone financials, all that. And remember, for all these cases only written representation is also given. Next, management responsibility. What is management responsibility for CFS? They are the one who should identify the component. They have to identify reportable segments. They have to identify related parties. They have to ensure that for a financial data is correct, complete, accurate, and they need to make necessary adjustments, and they need to ensure harmonization of accounting policies, and all gap conversions they only has to do. Yes or no? And next, preparation of consolidation. It is obviously mandatory under Companies Act 129 subsection 3. If a company has a subsidiary, consolidation is mandatory. Under 129 subsection 3, subsidiary definition includes associate. Normally under Companies Act, we have under section 2, associate company separately defined, holding company subsidiary separately defined. But under 129 subsection 3, only subsidiary word will be used, and there is an explanation. Subsidiary for the purpose of 129.3 includes associate and joint venture. Understood? That's it. Now, so Now, the following components are exempted from consolidation, or the following companies are exempted from consolidation. When suppose the company is a wholly owned subsidiary, and all other members agree in writing to not present consolidated financials, or it can be partially owned subsidiary, anybody, both of them can claim. Okay, see, very simple, it must be an intermediary holding company. It's an intermediary subsidiary or intermediary holding. Now, and that too, the company securities are not listed and not in the process of any listing also. And the ultimate holding company, they are filing consolidated financials, which is as per accounting standard. And any other company, central government can exempt. And remember here, it's actually, I mentioned any, it's actually all. Okay, yeah, consent of all members, unlisted company it must be, and holding company must prepare consolidated if three conditions are satisfied, like consent is obtained, and intermediary, it's an intermediary company, and the unlisted company, moreover, it must not be a listed company, and ultimate holding company is already preparing consolidated. If these three conditions are satisfied, that company which is intermediary, yes or no, is exempted from preparing consolidated financials. And any other company which central government by notification says, that is also exempted. Further, investment entity as per Ind AS 110 is also exempted. Now remember, if the parent, if it is a parent entity, yes or no, then it is liable for preparing consolidated. So investment entity need not present CFS if at all it is measuring all subsidiaries at fair values through P&L. For example, in MCQ how it will come, investment entity need not present consolidated financials, option A. Investment entity need not prepare consolidated financials if at all it is measuring all subsidiaries at fair values, option C. If at all it is measuring all subsidiaries through fair values in P&L, like that they'll give options, understood, through P&L. So like that they'll be giving. So you need to be very careful. A parent shall determine whether it is an investment entity or not. What about parent investment entity? A parent of an investment entity must consolidate all entities unless the parent itself is investment. If at all you are an intermediary subsidiary company and you are an investment entity, then you are exempted. Your parent is not exempted. For your parent, you are just a subsidiary, normal. But if a parent itself is also an investment entity, they are exempted. Definition of investment entity: it is an entity, this investment entity question also asked once already, an entity which raises funds from investor for investment management services. They invest purely for returns for capital appreciation or investment income, and evaluates investments on a fair value basis. What are all investment entity means? What? Core investment company, non-operative financial holding company, these are all nothing but investment entities. Clear? That's it, remaining nothing. Group audit over. Clear? Main theme I covered. Whatever is important from exam point of view, I have covered. Clear? That's it. So let's begin internal audit. And in internal audit, who can be appointed as an internal auditor? Anybody, CA, CMA, or any other professional. Okay, anybody can be appointed by board of directors. And internal audit is compulsory for listed companies. For public companies, unlisted, if paid up capital is more than or equal to 50 crore, turnover more than or equal to 200 crore, loans and borrowings more than or equal to 100 crore, and deposits more than or equal to 25 crore in preceding financial year. So that is the criteria. And private companies, only two criteria: turnover and loans criteria, borrowings criteria, 200 crore and 100 crore. Whereas for public limited companies, capital and deposits criteria is also there, and only a public limited company can accept public deposits. So on that logic, deposits criteria is given for public company. Then what exactly internal auditor will do? What is an internal audit function? Definition: internal auditors is an independent assurance function. Internal audit is an independent assurance function on what and all? Controls, risk management, governance, to enhance organizational objectives. And these internal auditors, they generally perform advisory role or consulting role. For management, whatever consultation they need, internal auditors will be there to assist. And the role is not just limited to financial transaction. Internal auditors will cover operations, they cover laws and regulations, everything. Then objective and scope of internal auditor: monitoring controls, examining financial and operating information, reviewing operations, reviewing compliance, risk management, governance. The scope is decided by management, those charged with the governance. More importantly, audit committee will decide. Audit committee is the one which will involve in every efforts related to audit, internal audit, all that. Next, indicative objectives. What are the objectives of internal auditor? Like already we have seen here, right? What are the objectives? Now detailed explanation. So monitoring of controls, like monitoring through exception reports, all that. and examination of financial and operating information. They will identify reasons for deviations in profit and loss, and review of operating. They review stores management practices, all that. Operating means inventory, production, all that. Then they review compliance with laws and regulations, especially when there is any new tax laws, new accounting standards, all that. Then they also apply risk management. They evaluate management's risk exposure for complex financial transactions and governance. They assess governance process and accomplishment of the objectives. There is something called management audit. There is something called management audit. So internal audits will be given, some set of internal audits will be given, management audit also. Through management audit, they assess governance processes. That's it. Governance means questioning management's judgments, whether a board of director is taking some decision at some point of time in a year, whether the decision making is correct or not in light of the facts and circumstances. That we need to check. That is called governance audit. Then responsibilities of internal auditor. They need to maintain internal control system and safeguard the asset. By the way, they need to ensure effective maintenance of internal control. It's not that they directly maintain it. Okay, management will maintain it, internal auditor will review it predominantly. Then they operate independently from accounting staff. They identify issues and draw attention to deficiencies. They always be informed about business events, policy changes, all that, and they have to be independent. Suppose if at all internal auditors were also assigned with operational activities, sometimes because of cost reasons, companies will also get certain operational responsibilities also. Remember, internal audit responsibilities only reviews. Basically, auditor means review, examination. You should not have any operating responsibilities. If at all internal auditors were given operation roles like risk, compliance, re-engineering, they must communicate limitations to the management, and they cannot assume ownership for those operations which is allocated, and they cannot take decisions. They will assist the management in operational activities, but they won't take any decision. Again, at the end of the day, it is predominantly decided by management. And scope, methodology, periodicity, everything is decided by audit committee or board of directors. Clear? After consultation with internal auditor. This is responsibilities of internal auditor. 3 marks question or 4 marks question. Next, what are various functions and scope of internal auditing? They review internal controls and procedure. Like what they review? They review design of the control, effectiveness of the control, in order to strengthen environment and reduce the risk of fraud, risk of error, all that. Control should be inbuilt and cost effective. Internal auditors will mainly focus on whether the controls are inbuilt, are they cost effective or not. Review limitations, and they ensure consistent use of internal controls, whether the entity designed, implemented. Not only that, they have to consistently apply the control. Next, they have to review custodian and safeguarding of assets. Main, they need to verify physically the assets. They need to review segregation of duties regarding the people who are managing assets, inventory, all that, and they should review controls against losses, theft and negligence, and review control system like credit, data storage, security. You see, all these points are regarding custodianship and safeguarding of assets. And next, review of compliance with policies, plans and procedures. Ensure compliance with relevant policies, plans and procedures. Examine system of periodic policy reviews. Combine results from reviews and test effectiveness. Point out weaknesses and suggest remedial measures. This is nothing but review of compliances with policies and procedures. Nothing but this is code of conduct, the company code of conduct, bylaws, internal bylaws, manuals, MIS, EAS. All these things internal auditors will review and recommend recommendations. Then review relevance and reliability of information, which may be financial statements, which may be non-financial information, all that. Review information systems for reliability and integrity, systems, data, and examine accuracy of the accounting records, other records. Evaluate usefulness of various reports that are being circulated within the organization, MIS reports, EAS reports, all that. Ensure reporting by exception. So internal auditors, after reviewing all these reports, they will give a report to the management where and all they identified exceptions. Then they need to review organizational structure to ensure that, see, alignment with objectives. Review grouping of activities for managerial control and see that there is a balanced authority. See that there is no particular department dominance and there is no overlapping controls. And check span of the control, unity of command. Specify primary responsibilities in case if a particular activity is given for dual people. Evaluate managerial development process and utilization of resources. See operating standards and norms, like how much is the normal loss percentage fixed by the entity, how much is the scrap percentage maximum can be generated. So like for everything some norms will be decided. Okay, if at all this much unit of material is given, this much output should come. Employees, if these many days they work on a particular thing, this much of output has to come. Like that, some norms will be there, standards will be there. See that these standards are set for efficient and economic use of resources. Standards should be identifiable and actionable. Review methods for establishing operating standards. So how are they setting operating standards? What methods they are following? Are they using industry data? Are they using statistical data? All that. Investigate large deviations between actual and standards and identify underutilized resources. Remember, internal audit primary objective is to create value addition to the organization. That's the only reason why internal audits were there. They need to identify lapses, they need to add value addition to the organization. Next, and finally, they need to review how organization is accomplishing goals and objectives. Review whether enterprise goals are clear, achievable, and ensure goals are quantifiable. That's why many companies will have management discussion and analysis. Their targets they will mention. And budgeting is key to such a planning. Okay. Then what are the fundamental principles? Just like stat auditor, these people are also subject to all fundamental principles like independence, integrity, objectivity, confidentiality. Everything is common. So this I'm not covering, okay, which is a simple matter. Then qualities of an internal auditor: he must have a specialized expertise in management controls and solid understanding of accounting financial data, capable of evaluating operational performance and non-monetary controls. They must have a decent knowledge of law, taxation, cost accounting, all that, and they must understand management principle, capable of effective interaction, human behavior, all that, and ensure confidentiality. These are the qualities of an internal auditor. Then finally, performing the internal audit engagement. There are steps in internal audit. First, get the knowledge of the environment, perform the planning, like first design the plan, gather the required information, perform the audit checks, nothing but perform the audit procedures, and reporting of internal auditor issues. Final, there's a totally 5 steps involved. Okay, understand the entity, plan, procedure, gather the information, perform the procedure, and report it. Okay, any of this step can be asked as an direct question, which is actually easy point. Okay, you can read that later. It is easy. Internal audit report and follow up. Internal audit report. What are the elements of internal audit report? In the recent May 25, this question was asked. In the May 25 exam, this question was asked. Okay, internal audit report, and this as well as what are the stages. These two put together, a 5 marks question came. What are the stages of reporting in internal audit, and what are the elements of report? These are the two things which are asked. Stages of reporting: internal auditor can report specific report, assignment wise, or comprehensive report. Now, after each assignment, report summarizes key findings and share with client and management. This is again part of overall report for top management purpose. Comprehensive: periodically we will cover all the activities and give a comprehensive. Initially we will give purchases related observations, sales related observation, inventory observation, fixed asset observation. Like that we give assignment wise reports. Then periodically once in a quarter, like that, comprehensive internal audit report will be given. So 2 stages of reporting: assignment wise reporting, comprehensive reporting. There are 2 stages. Then what are the reporting internal audit report elements? There will be an overview, objective and scope will be mentioned, statement that they followed standards on internal audit. They mention a factor that they followed internal audit, standard on internal audit, and they will mention executive summary of key findings and relevance. So for all internal audit report, there will be thousands of pages. In big companies, internal audit report will be thousands of pages. So the top management may not have time to read all that. So summary will be prepared, executive summary we call it as, and summary of corrective actions required and whatever management agreed, corresponding management, functional heads, what they agreed, and nature of assurance derived. All this you need to report. And not only reporting, you should also follow up. Okay, and remember, you cannot finalize the report without discussing with the auditee. Auditee means what? That functional head. For example, you're doing audit of purchases, and you cannot report directly purchases matter to those charged with governance directly. First discuss with purchase functions head. Next, final report will be issued within reasonable time frame. Now, principles for issuing internal audit report. Important question, 4 marks. Basis of the report: the based on audit procedures. So what is the basis for the internal audit report? Audit procedures performed, acknowledging controls and risks. And the basis for internal audit report is report must conform with standards on internal audit, and the content and freedom. There is no specific format for the internal auditor, so there is a freedom for the auditor, and based on judgment and based on client preferences, auditee preferences, and documentation. Maintain draft copy and final copy. What management plans they agreed, all that you document. Then finally, chief internal auditor has to monitor. Chief internal auditor monitors closure by tracking action plan implementation. Management is responsible for implementation. Follow-up is usually by a action taken report. Report if no action is taken in reasonable time. Review implementation, highlight unimplementable actions. This in the November or May 24, somewhere this question was asked, how to follow up on internal audit report. Okay, in the past 3-4 attempts only once it was asked. Next, Difference between internal stat audit, which is a very simple concept, okay, audit trial, in May 24 exam or number 23 exam, that time it was asked once, okay, either number 23 or May 24 or number 20 May 23 also. In one of this attempt it was asked audit trial question, okay. Audit trail means what? It's a visible record of changes made to the accounting data, which is traceable to original source. It includes date and time at which the transaction is recorded, user ID who recorded, what data changed, yes or no, and transaction reference, whether the data has been successfully changed or failed because of the control issues. All that will be recorded in an audit trail, yes or no. This is enabled at software level or captured in underlying database. Application level control. This is an audit trail is an application level control. And further, internal controls for audit trail, this is what they asked for 4 marks. This is what they asked for 4 marks in 23 year or 24 years, somewhere it was asked. IT related controls for in audit trail. In order to make sure audit trail is effective, there must be some controls. What controls? The key controls in audit trail is see that this is enabled and not disabled, and unique user IDs are assigned for all the employees, authorized configuration changes and log records, restrict access to audit trail access, and maintain backup access logs. These are all various controls related to audit trail which an entity has to implement. That's it. Internal audit topic is over. Clear? Yeah. Yes, let's discuss digital audit. Now you see there are two topics inside this. One is digital audit and another one is auditing digitally. Both are completely different. Digital audit means auditing the systems. Auditing systems. Auditing digitally means using the systems for the audit of financial statements. Both are different. Nothing but digital audit is nothing but systems audit. Digital audit is nothing but systems audit. Now, so how digital audit will benefit? What are the key features of digital audit? So when you're doing system audits, no, you will identify automatically all technological lapses, all that. Therefore, latest technological advancement and all management will be aware. It improves quality of opinion, leading to more reliable audit report. It saves time, cost, human effort, allowing more productive tasks. Digital processes can operate autonomously and standardized processes and controls to mitigate risks. Digital audit provides a comprehensive overview of end-to-end process. In systems audit only we get all this. And digital audit helps to create a future digital strategy where the companies can adopt AI, robotics, all that, and the auditee can make a proper informed decisions if at all systems audit is correctly done and identified all the vulnerabilities and all. Understood? So systems audit, another name is digital audit. In fact, this kind of explanation I didn't give even in my EO class also. Okay, so this simplification I didn't give that time. It didn't strike me. Next, advantages of digital audit: enhanced and enhanced effectiveness and efficiency. Automation and tools increase efficiency, better audit quality, and lower cost. Automation will reduce the lot of cost. Better analytics, improved data analytics, all that, improved risk management. Now, considerations for using digital techniques and automation. So when a company is planning to use digital techniques and automation, what they need to consider? All that. First, people. Yes or no? First, you must understand what benefits an organization will get through automation. Then they need to first look at the people. Are the people ready? Because change is difficult. And target the right processes. You have to automate. You have to implement automation, all that in the right processes where less judgment is involved. Where it is repetitive task like that. And automation is not a standalone solution. It should be part of as a broad digitization strategy. Ensure process is working and standardized before automating. Boards don't easily adapt to process changes. So governance and data security are also critical when you're adopting automation, because this introduces new challenges like cyber risks, all that. So what are the considerations for using digital techniques and automation? 4 marks question. Understood? Next. Then auditors focus, and obviously auditor also has to focus on new technologies like new activities, changes in system development, impact of new technology, and how organization is generating and using information for internal control. So auditor has to understand this new technology, all that. Then auditing digitally. Auditing digitally means what? Using technology for efficient and effective audit. Okay, so in a rapidly growing environment, adapting technology is crucial. And using the technology, you can select sample size based on materiality, all that. So digitizing audits through automation and innovation is key. the real risks of the client and all you can understand, and understanding how technology can help all that. Expectations from the auditor. Audit team should involve experts in software applications and technologies like robotic process, AI, blockchain. This expertise ensures highest quality of audits. And investment, auditor has to invest in training their people digitally so that technology oriented audits can be done. Technology investment has focused on developing tools for data analytics. Auditor has to invest in developing tools also. Okay, all big four entities, all these big firms and all, they have lots of softwares, their own softwares, customized softwares. The auditor reviews the final result file to identify any exception, and boards reduce manual intervention, provide accurate results. Today, extracting data, everything is automatically happening through boards. Periodically, the data will be captured and then kept in the auditor servers itself most of the time. Next, what are the key features or advantages of auditing digitally? Improved quality of audit, and auditor, data analytics helps moving from sample auditing to full transactions review. Today, auditors are reviewing 100% verification again instead of going for sample. 100% verification means control aspects. Okay, test of controls and test of details we have, right? So typically, test of controls, test of details is both are same only. When you see, it will be same only, that it looks like it's same. Where if at all I'm seeing the voucher, who authorized it? Is there an authorization? If I see is there an authorization and I compare who has to authorize, who authorized it. Okay, and when the voucher was generated, when the order was generated, if I am looking at all these control elements, that's test of control. For substantive procedure, same voucher I'll check, but there I will check amount, quantity, matching with GRN, matching with stock record. If I'm matching quantity, amounts, all this accounting data, then that is substantive procedure. Technically, control testing, substantive testing, both will be through vouchers and transactions only. Transactions testing only, this is nothing but if you are testing process, then that's a control testing. If you are checking actual what happened, that's a test of details. Are you clear? Next. So decreased human dependency. Because of auditing digitally, human dependency, technology reduces manual interventions, lowering manual errors. It also streamlines testing process and reduce errors. And technology audits will increase transparency, where the auditor can trace a transaction end to end. They can review details like date of changes, who made them, what was changed through audit trail, because audit trail feature is there. Next, automation and ease, like data extraction, recording the work, sampling, everything is automated. And dashboards can be used like Power BI, which will help the auditor to form an opinion or to form a conclusion or to analyze the data with ease. Then improved efficiency, technology and digital upskilling helps the auditor to become more efficient, and as a whole you can do a better risk assessment. So the auditor can focus on real challenges and assess potential risks precisely. See, real challenge means what? Instead of sitting and wasting your time on getting the data, all these challenges, you can directly focus on the real challenge like subject matter audit, risks assessment, all that. Now, what are the considerations in auditing digitally? What are the considerations? You see, similar word consideration is used here also. So no, you see, considerations for using digital techniques and automation. That answer is different. What are the considerations in auditing digitally? This answer is different. What are the considerations in auditing digitally? You must have a clarity on what problems you're trying to solve. Which technology can help you? How will you upskill your people to use the upcoming latest technology? What are the range of solutions that are available in the market? Okay, so what are there are various technologies like macros and skips, business process automation, or robotic process automation, so intelligent process automation. IPA is nothing but a combination of RP and AI. Intelligent process automation is a combination of robotic process plus artificial intelligence. Next, so considerations in auditing digitally. So continuously evaluate emerging technology and latest tools. What will make your audit easier? Identify that. And many vendors and startups use data acquisition, manipulation, visualization tools. How these will integrate into your current processes, and identify, flag means identify potential implementation issues. Technology is effective only if it is used properly. Training and development is essential to ensure that people understand and use the technology efficiently. Continuous training helps to overcome people who are reluctant to change. Automated solutions. There are very many range of automated solutions available. Some techniques includes robotics, automation for data gathering, data analysis, and reporting by dashboards. So these are all various tools which auditors are using. Macros and scripts already. I hope some of you would have used it. Have you? And understanding IT role in business. what auditor has to understand, this point is relevant in this entire question. Auditor has to understand what applications the company is using. An auditor has to understand the IT infrastructure components for each application and the company organization structure and governance. What are the policies and procedures and processes which they're following? The extent of IT integration and use of service organization. Understanding IT risks and controls. These are the various points which auditor has to understand and document like this. Okay, next. What are the key areas for an auditor to understand IT environment? In an IT environment, what auditor has to understand? First, understand the flow of transaction. Okay, like how transactions and information flow through IT system, and changes in flow can occur due to program changes. If application is changed, then the flow of transaction will also change. Identify significant systems. Auditors shall identify what applications, what infrastructures that are significantly affecting account balances and disclosures. Identify where and all companies using manual controls, where and all they are using automated controls, and identify what technologies they are using, like blockchain or robotics or AI, internet of things or biometrics or drone or all that. And assessing complexity of the IT environment. So complexity varies in IT application. The complexity is decided by automation used in the organization, entities reliance on system generated reports, customization involved in IT application. The more customized, the more complex. Okay, entities business model, what changes happen to these softwares during the year, emerging technologies implementation. These are all various factors which auditor has to consider while assessing complexity of the IT environment. 4 marks question. Okay, next. What are the risks that are arising from use of IT? Like, because the technology is being used, what risks can arise? Unauthorized access to data. Somebody who knows your password can easily access your data. Yes or no? Risk of privileged access. Some users in the organization will have higher access powers. Super users, we call them as, and they can unauthorizedly change the data. And if you fail to update the software, that leads to a vulnerability. Inappropriate manual intervention. Suppose the system is processing some data, suddenly in between the, you're pressing escape or something like that, manual intervention. Okay, then data loss. Data loss or corruption can occur due to poor cyber security control or hackers. This can lead to fraud and theft of sensitive data. System downtime. Okay, system downtime. Integration risks. Because what is integration risk? Suppose, if at all the software is so integrated, if that fails, remaining components also stop functioning. So integration risks will be there because of use of IT. Compliance risk. Regulatory compliance risks arise when changing laws and guidelines, and performance issues because of heavy data load, network usage, slow response time. These are all various risks that are arising from use of IT. Five points you can remember. What are the IT risks that are there in the systems? 5 points you have to write. Clear? You see, for every concept I give a heading for easier understanding. Understood? Importance to identify IT dependencies. Obviously, when you're understanding the IT environment of an entity, you should also understand IT dependencies. IT dependency means what? Suppose companies trusting based on system generated report. Yes or no? That's an IT dependency. So documenting IT dependencies helps identify how IT is supporting the business, and also you will get to know potential risks. IT dependencies occur. When IT dependencies will occur? When information technology is used to initiate the transaction, information technology is used to authorize the transaction, for recording transaction, for processing transaction, or to report transaction, or financial data included in transaction. Today, no doubt, every company is IT dependent. Yes or no? All the banks, almost everything is IT dependent. For initiating, recording, processing, everything is dependent on IT. Types of IT dependencies. Automated controls. Like automated controls enforce business rules in IT environment. For example, you say in your bank, if you transfer for a newly added user beyond certain amount, the bank will disable for the first day. Suppose if you change the SIM, for example, if you reactivate the SIM once again, for first 24 hours you will not get any OTP. These are all automated controls. Next step. Reports. System generated reports, they provide information for manual controls and performance review. By the way, this question was asked in May 24. Types of IT dependencies. I think inside that this this entire matter was asked. Okay, if system is performing calculations automatically, IT systems are performing calculation, then that is also a type of IT dependency. Security and segregation of duties are controlled by IT. For example, user ID, account password, user ID was allocated. Okay, so that is an IT dependency. Interfaces transfer data between IT systems, like from payroll subledger to general ledger, from stock record to from stock records to purchase records to trade payables to payments. Clear? These are all various types of IT dependencies. They may ask you what are various types of IT dependencies. Give 3 examples. Next, the auditor has to understand and respond to risks arising from IT. Like first understand IT dependencies, also understand IT general controls. What is the impact on control design? IT dependencies can affect how entity controls are designed and implemented. Evaluating IT general controls and risks. So IT general controls, nothing but general controls. Okay, access security, program change controls, data center and network operating controls. Data center and network operating controls, what is their objective? Their objective is to ensure production systems are appropriately backed up to meet financial reporting objectives. Data center and network operation controls means their objective is to ensure production systems are properly backed up. Program change controls, to ensure that system modifications are still meeting with financial reporting objective. Access security, to ensure that access to programs, access to data is authenticated and authorized so that financial reporting objectives are met. What is financial reporting objective? Ultimately, true and fairness of the financial statements. Next, this is also called as general IT control. IT general control or general IT control. See, controls are again 2 types: general IT controls, application controls. That's it. Next, cyber risks. Cyber risks means what? Cyber attack. For example, cyber attack is an attempt to gain unauthorized access to a system with the intention to damage, steal, alter, disable or destroy the data. So regulators require many financial institutions to assess maturity of cyber security program and manage cyber risk and enhance resiliency against cyber attacks. Common cyber attacks: malware, denial of service attack, phishing attack, spoofing attack, identity based attacks. In the recent May 25, they gave MCQ. Okay, they gave MCQ on various types of attacks. So, okay, malware means what? A file present on your system which is corrupting the system. Okay, like ransomware, fileless malware, Trojan, mobile malware. Ransomware means somebody will hack your system and lock the system. If you want to unlock it, you need to pay some money. Fileless malware means you don't find any file, it is hidden, okay, in the system, but that is accumulating the data, that is creating load on the system, this fileless malware. Trojan, it appears like a legitimate software often installed through phishing or social engineering. You will find many cracked apps, cracked versions of applications. When you're downloading that, Trojans will also be downloaded. Okay, and mobile malware, targeting mobile devices via malicious downloads, phishings, unsecured Wi-Fi, all that. Denial of service attack, DOS attack. DOS attack flood a network with false requests, disrupting business operations. You see, on the results day, I say website will not work suddenly. That's because at a time, all people, at a time, almost more than some 1 lakh, 2 lakh students are accessing result site at a time. So automatically the system cannot respond. DOS attack. Phishing. Phishing is a tactic to steal sensitive information. Phishing means what? You do phishing, right? Yes or no? Yes or no? So the moment fish catches the hook, it will come. Yes or no? Here also they'll be sending some mail or message where you click on the link, automatically your data will be stolen. So spear phishing, whaling, smishing, wishing. Wishing is through voice messages. Smishing is through SMS. Whaling is targeting top level management to steal money, data, all that. Spear phishing means what? Targeting specific individuals to steal login credentials. Okay, spoofing means what? Like you are spoofing involves disguising as trusted source. Okay, suppose no RIL.com is there. Okay, relianceindustries.com or infosys.com is there. I will create a website called infosis.com. Infosys.com. Yes or no? So the moment you type Infosys, I will make sure SEO works in such a way. The moment you type Infosys will come. This my website will come. Everything appears very clear. Just that I letter alone change. Exact company official website will be as it is in this. And I will gather your sensitive data, all that. That and all is called as spoofing attack. Domain spoofing. Right now what I told is called as domain spoofing and email spoofing. Okay. Next. Identity based attacks. Identity based attack means it occurs when an attacker uses compromised user credentials to impersonate a legitimate user. Nothing but your password is stolen by somebody and they can log in your name directly. And insider threats, DNS tunneling, IoT based attacks, Internet of Things attack. Okay, like IoT attacks target Internet of Things devices, which allows hackers to control devices like this one, smart cars, all the smart refrigerators, smart TVs, all this. In companies also they are using all many IoT things. Next, what are the stages of cyber risks? The stages are totally 3. Okay, now assess the cyber risk, identify the impact, manage the risk. Okay, what is cyber risk framework? No organization is immune to cyber risk. Like these common threats are ransomware, phishing, hacking, all that. Company insider might be doing this. Impact of the cyber risk, regulatory cost. This itself can be asked as a question. What is the impact of cyber risk? Okay, cyber risk means what? What is the impact of cyber risk? Regulatory cost, business interruption, data loss, ransomware attack, IP theft. The response cost is very high. Incident response cost, breach of privacy, fines and penalties. So the companies has to follow a strategic approach to mitigate the cyber risk. Now, gain a holistic understanding of cyber risk, assess IT and cybersecurity programs, align security, cybersecurity and IT transformations, and understand accepted risk and document compensating controls, all that. Cybersecurity framework. The framework has totally 5 parts. The framework has 5 parts. Cyber security framework: identify the risk, protect the risk, detect the risk, respond to the risk, and recover. So in a cyber security framework, company will implement policies for identifying risk and protecting the risk, how to protect the risk, and responding to the risk, and recover from the risk. The companies will establish policies for all this. What are control considerations for cyber risks? Controls around vendor setup and modification. This was asked for 4 marks in number 24 or some attempt. In one of the attempt it was asked. Of course, May 24 is the first attempt, number 24 is the second attempt, May 25 was the latest attempt. Okay, only 3 attempts there on this particular chapter. So controls around vendor setup and modification, because most of the frauds happens in many organizations, big companies, is vendor related frauds. Okay, so incorrect fund transfer. Entities may mistakenly send funds to fraudsters, reducing liabilities owed to actual vendors, impacting the financials. So determine who is responsible for vendor master data changes and whether the process is centralized or decentralized. In many companies, no, vendor addition, vendor approval will be IT team will take care. Evaluate whether email is used for vendor data changes, whether multi-factor authentication is enabled. Now you see, almost in all internet banking applications, whenever you're adding beneficiary, official verification is being done. Earlier, no, I can put any name, but I just add account number, right IFSC, that is enough. Name is not matching. Even if the name is not matching, bank will do fund transfer. Now when you're adding the account, it is asking verify the account. If you verify the account, whatever name given by third party and that name matching on it, you can check out. If there is an inconsistency, you will not add it. Understood? Yes. Next step. So assess systems and technologies used for initiating, authorizing, processing vendor data changes. Define authentication protocols for verifying vendor data changes. See, these are all vendor related controls. What are the controls around vendor setup? Who has to do vendor changes? If at all any vendor data is changed, whether email is used, multi-factor authentication is used or not. Assess systems and technologies for initiating recording. Define authentication protocol for verifying vendor data changes. Vendor data change cannot be happened just by IT personnel. CFO has to involve, IT personnel has to involve, multi-factor authentication. Next. Controls around EFT, electronic fund transfer. Ensure the person responsible for wire transfer. Wire transfer is nothing but internet banking transfer. They are educated on phishing scams. They must be given guidelines on, see, you might get emails, all that pretending as an official, so be careful. Define authentication protocol for verifying wire transfer, like callback procedure, dual authentication, like that. So review systems and technologies used for initiating, authorizing and releasing wire transfer. What system they are using for internet banking transfer, all that. Controls around patch management. Entities, ensure that entity has a patch management program in place and run periodic vulnerability scan to identify missing or unapplied patches. Understand how the entity is notified of patches by external vendors, like Microsoft for Windows patches. There are so many softwares that are there which will be incorporated, which will be installed in our system, which will identify patch management. Okay, which will identify loopholes. Wherever there is a loophole identified, they will request you to update a patch. Next, remote audit. What is remote audit? Technically, work from home audit is nothing but remote audit. Yes or no? Today everyone is doing remote audit only, honestly speaking. Okay, you're all work from home audit. Big four employees, some of them, some 10 to 15% are doing work from home, and sitting in India, they're doing audit of foreign companies. How are they doing? Remote audit. So remote audit or virtual audit is now is when auditor uses an online or electronic means to conduct the audit. Today working papers are also completely electronic. It could be partially or completely virtual. Auditor uses technology to obtain evidence and also perform documentation. So when remote audit, what is the most important thing? Feasibility and planning. Agree on the timelines with the management, how meetings will happen, data exchange methods will be what, access, authorization request. The auditor has to agree all these things with the client whenever there is a remote audit. And technology and resources, ensure feasibility of the technology, check whether auditors and clients have required competences so that audit can be conducted virtually, check whether necessary resources are available, and conduct video or teleconferencing and use document sharing platform for transferring audit evidences. Document sharing platform is nothing but working paper platform, caseware, all that. Then in remote audit, you need to be careful regarding confidentiality, security, and data protection. That's why in remote audit, what we use, we use a VPN, and then we do the audit so that nobody can enter into the system. And screenshots of client should not be taken without authorization. First of all, the app will not allow screenshot. Even if at all you took a screenshot, system cannot be shared. You can't share to anybody. Okay, screenshots of documents records should be approved by client organization. Consider laws that may require additional agreement whenever you're doing remote audit. Once audit evidence is reviewed, remove it from the platform and store according to the standards. And restrict access to document sharing platform and encrypted data to ensure security. Once your audit is over, the engagement team will not have access to that folder again. They will not get access to that particular folder. And risk assessment. This is not the small thing. So here, this can be asked as a 4 marks question. Feasibility and planning can be asked as a 4 marks question. What are the advantages and disadvantages? No travel time advantage, work from home environment. Okay, evidence can be collected over extended period of time, you need not interrupt any daily activities. And auditor will directly get first hand information without any mediators involvement. Wider selection of auditors. If at all there is a remote audit, I don't have to restrict to my auditor, local auditor. I can have auditor from across the globe. Disadvantages: network issues, no ability to observe facility culture or body language, time zone differences, doctor documents or omitted information, altered. Doctor means something but altered. Okay, remote access. Crucial challenges for auditors who do not have understanding of local laws and regulations. So these are all advantages and disadvantages of remote audit. Straight away this itself can be asked as a 5 marks question. Next, emerging technologies. Emerging technologies, entire introduction not required. Audit command language, Alteryx, Power BI, and Caseware. These are all various data analytics softwares. These are all various data extraction and analytics softwares. These are all different companies. Okay, why are they giving about all the different softwares? Alteryx is a different company, ACL is a different company, Power BI is by Microsoft, Caseware is by a different company altogether. These are all different companies which are providing data analytics softwares. ACL is a data extraction and analysis software used for fraud detection, all that. It helps auditor find irregularities or patterns in transaction that may indicate. Example, ACL is used for trial balance reconciliation during audit. If a general ledger dump and system trial balance are provided, ACL can ensure data completeness beyond capacity of Excel by performing functions like record count, sum, pivoting with Excel, which Excel cannot handle. Alteryx, this software consolidates financial and operational data, automating analytics and performing machine learning to detect fraud and irregularities. It takes financial as well as non-financial. Both it will compare and give you analytical information. It helps automate periodic processes like reconciliations, consolidations, and continuous audits. Power BI is a business intelligence platform for aggregating, analyzing, visualizing, and sharing the data. Auditor can use it to identify outliers. Outliers means what? Exceptions, unusual things. Okay, for creating interactive dashboards. Power BI. These are all the real softwares actually. Caseware provides data analysis tools for audit engagements. Eliminating routine tasks and integrates everything. Then automated tools in audit, Internet of Things, artificial intelligence and blockchain, and non-fungible tokens, NFTs, and robotic process automation. These are various artificial intelligence tools. So Internet of Things, they are like connected devices. And what are the components in this? They do collect the data, they analyze, and then they connect. Impact business models and exposes new risks. Audit implication, auditor may need to evaluate automated tools and new system, review consumer facing tools affecting transaction flow, train auditors to evaluate IoT related things. Common risks, hijacking, new risks from connected devices, connected cars, smartphones, refrigerators, all that. You see, they give stupid examples. They would have given Amazon warehouse examples, no? Amazon warehouse, all that example, no? Simple, they just Google IoT, whatever matters, copy paste. Artificial intelligence, AI learns and makes decisions based on data analysis and algorithm. like self-driving car, smart assistants like Alexa, all that. Review a algorithm. So auditor, what auditor has to do? You need to review the algorithm, how the algorithm is been written. Is it written with an unbiased manner or biased manner? Okay, and ensure AI outputs are reviewed. Consider AI impact on transaction flow. Self-driving car, AI systems in which will suggest you for flight bookings, all that. So security vulnerabilities, all these are all various risks. See, what is the meaning? This is what auditor has to consider. What is the risk involved? What are the examples? The 4 points are like, what is it, and what auditor has to consider, what risk is there in that, and what are the examples of that item. Blockchain. Blockchain uses a decentralized and distributed ledger with encryption for secure transactions. It is immutable blocks and validation by all the participants. Secures and tracks digital transaction. How audit risk. Review governance security of blockchain transaction. Assess how blockchain interacts with the legacy system. Ensure compliance with laws and regulations. Entire this cryptocurrency NFT, they both use blockchain technology. That's why you just open NFT any particular website, you will understand what are all transactions happening, who are all buying, who are selling, everything you will get to know. Next, what is the risk here? Transaction you can't reverse, irreversibility, cyber attacks, and exposure to compliance issues across geography. Next, for example, Bitcoin and other crypto transaction, blockchains are used for instant settlements in banking. NFT represent ownership of unique item like digital art, music, video, secured by a blockchain and cannot be altered or copied, contains digital signature. The risk, the risk involved in NFT is ownership issues and potential for online frauds. Audit NFT codes for safety. Auditor has to do audit of NFT codes. Review ownership and copyright concerns. Ensure data privacy is protected, like digital arts, music, sports. NFTs as a digital asset secured by blockchain technology. Okay, next, RPA. Robotic process automation, repetitive process via bots that can operate continuously. You open Swiggy, suppose you didn't receive the right order. Initially the bot will text with you, okay, I like order something was missing. It will ask certain questions. It will only give refund also. No manual intervention. See, Swiggy itself is giving refund also. Package is lost. Depending upon your past data, past behavior with the Swiggy, okay, they will have some instructions. AI tools will be developed. This is completely RPA. Next, audit implications of RPA in detail. This is important. Now, auditor must understand robotic process automation processes, like how data is being extracted, how it is being aggregated, how it is being sanitized, and how it is being cleansed. Okay, sanitized and cleansed means nothing but analytics, analysis. A comprehensive audit may require for reviewing source code. Auditor need to know what tools are used for RPA development and review logs, configurations, all that. Common risks of RPA. Operational and executive risk. This itself can be asked as a 4 marks question. Operational and execution risks. Change management risks. RPA strategy risks. Unrealistic key performance indicator, wrong expectation, and poorly defined business goals create uncertainty. So management should evaluate RPS characteristics, potential limitations before starting the process. Before you automate some process, understand what is a business goal, whether that particular activity can be automated or not. Check out. If change management life cycle is not followed or testing is incomplete, it can lead to inaccurate. Whenever an RPA, see any system tool, no, it has some development cycle, system development life cycle, we call it as. It has to be developed, it has to be tested thoroughly, and any deficiencies has to be rectified and again testing. Without proper testing, you implement it. So that is called change management risks. And operational risk arise when robots are deployed without proper operating model. Wrong tools, wrong assumptions, shortcuts, poor security and compliance, they pose major risk. Proper responsibility training and clear role identification helps reducing these particular risks. Then you see, now again here there is another word called control considerations or objectives in auditing digitally. Control considerations. One question is considerations in auditing digitally. Another one, considerations for data, digital analysis. Some question is there, digital audit analysis, first question. Okay, so that considerations is there. Considerations in auditing digitally. This is control considerations. They specifically are saying the word control considerations. So here technology risks point. Reliance on system that inaccurately process the data. This is IT risk. Unauthorized access to data is an IT risk. Unauthorized changes to data, unauthorized changes to systems, failure to make necessary changes, inappropriate manual intervention, potential loss of data. These are all various IT risks. Then next generation audit. Next generation audit is human lead, tech powered, and data driven. combining emerging technologies to redefine how audits are being performed. The next gen audit focuses on leveraging technology to enhance audit quality. Like advanced technologies like 3D printing, AR, VR, biotechnology, drones, and quantum technology, they are all being used for next gen audit. Common risks. Emerging technologies come with risks like public safety, cyber security, data privacy, data protection, lack of standards, and technical challenges. Data tracking raises concerns about taxation, jurisdiction, and customer protection because privacy laws are different in every country. Regulators and auditors need to focus on controls around privacy, data security, all that. Then new technology, AR, VR. I hope you know, right? Pokemon Go game is there, right? Augmented reality, that's an example. Virtual reality, already, you go to any gaming zone in shopping malls, okay, VR games, roller coaster, everything. VR replaces the real world with a simulated one using devices like headset, VR headset, all that. Now AR and VR is used in architect industry, construction industry. VR is, very AR and VR is being used. Metaverse, this was recently asked in May 25. The metaverse is a 3D digital space combining AR, VR, AI, and cryptocurrency, enabling life-like experience. Future considerations for metaverse: building digital monetary systems and economic principles via virtual land, building governance models with user inputs, handling digital identity issues, ensuring synchronicity in real-time transactions, all that. Digital world will be created. Inside that, you will be given one character. There will be a seller. There will be a buyer. There will be a virtual thing. You will be trading there. Tell me, derivatives are there, right? Derivatives are what? Tell me. It's simply speaking, it's a business of emotions. It's nothing but it's a business of emotion. Derivatives, will they contribute to company in any way? Nothing. Yes or no? That's it. Then what are the potential applications of virtual reality? For virtual banking, digital asset management, virtual financial education, virtual meetings and conferences, data visualization and analytics. In all these cases, VRs can be used. Virtual reality can be used. That's it. Digital audit is over. So what you need to understand in digital audit, you should leave it. So, no, it takes time for us to remember that. Lengthy chapter, weightage is 4 only or 5 marks only. By the time you study digital audit, you can study in depth internal audit, group audit, and internal group, and you can also study NBFC also. Okay, so the effort you spend on digital audit, you can spend on 3 different chapters where the weightage will be 10 marks easily, and digital audit 5. And even if you study thoroughly, the probability of scoring is very tough. Okay, that's it. That's why I always tell, digital audit, risk assessment and internal control, and 17th topic is the right due diligence, investigation, forensic, that entire like if at all in that you want to study forensic accounting, you study at least because that's a small topic, simple topic also. Okay, so these 3 you can confidently leave, no problem at all. Like I don't know how many of you are writing for 120 out of 120 marks. Okay, I am an average guy. I write only 80 marks of the paper. I am not writing 120 marks. Okay, so target 80 marks of the paper, that's enough for getting 60 plus. Some students write 120, they'll get 11 only final. It's not how many marks you write, it's about with what perfection you write. Okay, so 3 chapters or 4 chapters you can confidently leave, as long as you're able to attempt 80, 85, 90 marks, that is sufficient. Okay, that's it. Fine. So we'll stop this session and then we'll go for MCQ discussion. Okay, yeah, let's begin the next chapter, sustainable development goal, environment, social, governance, assurance. Okay, now only from exam point of view, whatever points are relevant, that only I'll cover. Okay, now first one, what are the 3 pillars of sustainable development? 3 pillars of sustainable development: 1, economic and social and environmental. All the 3 has to be sustainable: social sustainability, environment sustainability, and economic sustainability. Now economic sustainability means what? Ensuring long-term economic growth without negatively impacting social, environmental, and cultural aspects. Social means what? Equity, human rights, social well-being, and community stability, all that. Environmental means what? Natural resources, carbon footprints, and promoting eco-friendly practices for a healthier planet. So these are the 3 pillars of sustainable development. So the sustainable development applies to a corporate policy. It is built on the 3 pillars. 3 marks question. Okay, this itself straight away can be asked as a 3 marks question. Now What are the three pillars and what are its elements? Environment detail. It refers to corporate climate policies and how are they using energy, how are they generating waste, pollution, natural resource, and how are they treating animals, all that. It includes natural resources such as usage of coal, electricity, water. This covers the processing of these resources into products which results in wastage. So environment covers all these elements. This itself can be asked as a 3 marks question. And they may ask you sometimes about social activities. Write in detail about social aspect. This focuses on relationships that the entity will have, the reputation that it has among the people, among the communities, among the institutions who are involved in its value chain. Okay, it covers labor relations, diversity, acknowledging that every company operates in a broader and diverse society. Then governance, it talks about internal systems, it practices controls and procedures to govern entity, make sound investment decisions, comply with the law, and meet stakeholder needs. It recognizes that every legal entity requires effective governance. The fact is, it recognizes legal governance. That's it. And that approach to reporting on ECG, that and all not required. Yeah, this the approach and reporting on ESG, how on environment and social governance we need to report. The reporting, here no we report, the reporting involves disclosure of information, data, metrics that demonstrate the added value in ESG area, how your corporate is adding value in these three areas. You can demonstrate by showing some information, metrics, all that. The report can be both qualitative and quantitative. You see BRSR report, integrated report, all that. Some of them are BRSR itself, you see inside that there are two levels of indicators. One is leadership, one is essential indicator and leadership indicator. For each principle, essential indicators are mostly of metrics, leadership indicators are mostly of qualitative. The qualitative approach, where the company describes about their strategy and policies with respect to ESG topic. And quantitative approach, they take some metrics, how much water we consumed, how much electricity we consumed, how much carbon footprint we generated, how much we added back. Yes or no? You see, almost on all water bottles we recycle more plastic than we take. You see, like you would have seen this kind of advertisements. Okay, use metrics and key performance indicators to measure progress against ESG goals. Now, what is the best approach, qualitative or quantitative? A mixed approach. Yes or no? To give a maximum value and improve the quality of disclosure. What are you doing? Quantitatively mentioned, and what are you planning? Qualitatively mentioned. So this is the approach for reporting to ESG. This itself can be asked as a 4 marks question. Next, SDG goals not required. Maybe in this, something that can be asked is, what are the key focus areas of SDG goals? What are the key focus areas? Only this you study in this chapter. You don't have to touch any other topic. Okay, whatever I'm telling you, only that you study. What are the key focus areas in SDG? Health and education, reduced inequality, economic growth, climate action, ocean and forest conservation. Whereas United Nations have they developed that total SDG goals are 17. Okay, and if at all examiner who has a special place for him in hell, okay, if at all he's so crack, he will ask numbers also. Okay, and after I saw in the recent May 25 MCQs, they may put symbol and then ask you to identify what the symbol gives. You don't know. Okay, fine, but it is easy actually. You see the symbol ocean. Yes or no? You see the symbol land, planet. Oh, already in this names are there here. Okay, and you see this, collectivity, that unity, partnership, correct only. Some name. Okay, so by looking at the symbol, you will get it. What is this? This is energy. This is energy. Power button, energy. This is water, and this is water. LGBT, gender equality, all that. This is education. This is health. This is food. Okay, poverty, hunger. This is no poverty, they themselves give. Okay, fine. So you understood, right? So remaining you need to once just observe it and then leave it. Next, then this global trends, nothing, not relevant at all. Now integrated reporting, another important concept, integrated. So every corporate, every enterprise, whatever resources they are using, all the resources are broadly divided into 6 types of capitals. Okay, financial capital, an entity will have financial capital where they will have a funds availability for production of goods and services. This financial capital may be in the form of debt, equity, grant, operations and investments. Manufactured capital, nothing but man-made capital. Okay, like plant and machinery, buildings, equipment, all this buildings, equipment, all that. This includes roads, ports, bridges, water treatment plants, all that. This is manufactured capital, nothing but man-made capital. Then natural capital, whatever the input that is available, right, that is natural capital, like water, land, minerals, forest, biodiversity and ecosystem, all that. Then organizational activities can have a positive impact as well as negative impact on the natural resources. I don't know how positive impact will be there. Next, human capital. Human capital means people skills, experience, capacity, motivations to innovate and support, and this is one of the most intangible asset for any entity, and it include alignment with governance and ethical values. It covers leadership and collaboration capabilities. Then the other capital is social capital, the relationships which they have with community, stakeholders, networks, all that. This includes common values and behavior, key relationships, trust, loyalty with customers, and social license to operate, nothing but goodwill. Goodwill is nothing but social capital. Next, intellectual capital, whatever the amount you are investing in R&D, yes or no, future earning potential and link to R&D, innovation, human resources and external relationships. This determines competitive advantage that it has. Asia Pacific leads in sustainable reporting, where 60% of the companies are adopted in 2022. Middle East shows a strong adoption. Actually, intellectual capital until here only, it's accidentally printed. This has to come later. Okay, that's it. Intellectual capital means A and B. Now in exam they'll ask you, what are 3 types of capitals as per integrated reporting and what are they? Define. So any 3 capitals they'll ask you, or sometimes they'll specifically ask you what is intellectual capital, what is social capital, what is manufactured capital. Like 3 questions, 3 parts they'll ask you, 2 marks, 2 marks, 2 marks, or 1 mark, 1 mark, 1 mark, 1 mark. Okay, that's it. Next, these are all not required. Initiatives by ICI. Yes. Now BRSR, business responsibility and sustainability report. Okay, this is over a period of time it evolved. Okay, earlier we call it as business responsibility reporting. Okay, so now it is called as business responsibility and sustainability report. Many companies are giving now integrated reporting, and this both they are giving. Okay, BRSR they are giving, integrated reporting both they are giving. Now it is mandatory from 20 to 23 onwards for all listed entities. First of all, we'll see applicability of BRSR. Okay, assurance in BRSR first. Okay, currently it is applicable for top 1000 listed companies, which is mandated by SEBI. BRSR will be the India's primary reporting framework for sustainability disclosures. Stakeholders, investor, analysts, they will use it for industry analysis and decision making. Since BRSR is being relied upon by so many, assurance on that report is required. Whether BRSR company is presenting, here subject matter is BRSR. Here subject matter is business responsibility and sustainability report, which is prepared by the board of directors, which is prepared by the management of the company. Now since many people use it for reliance, there is a need for assurance on that. That's why an assurance engagement has been introduced, a CA who has to verify BRSR report and see whether the BRSR has been presented in line with the applicable framework. Not financial reporting, this is a business responsibility framework. Okay, so need for assurance. Assurance in BRSR reporting is critical so that it is credible and transparent. Now ESG audit importance, this is where the ESG audit question comes. In ESG audit, now we evaluate environmental and social risk linked to a company products. We help to assess supply chain risks, all that. Standards on sustainability assurance engagement, SSAE 3000, it is an assurance engagement. Okay, other than historical financial information, subject matter is not historical financial information. So standard on sustainability assurance engagement, this standard provides guidelines for assurance engagement on sustainability information. Who are the users? Assurance providers performing. Who will use this standard? Obviously the person who is giving assurance on that, and entities also can use it for getting a professional assurance. Regulators can use it, investors can use it, stakeholders can use it to know what parameters the auditors will check. Next, scope of SSAE 3000, it provides reasonable or limited assurance on sustainability depending upon the type of engagement. Okay, for certain case scenarios reasonable assurance, for certain elements limited assurance, combination will be there. Next, effective date of SSAE. Actually there is an assurance report on SSAE also in some company, where they gave reasonable assurance on some elements, for some elements they give limited assurance. In a single report itself both assurance will be there. And what is the effective date? It is mandatory from 31st March 2024 for all assurance report. So if at all anybody is giving assurance report on business responsibility and sustainability reports, they must follow this SSAE 3000 standard. And there is another standard which is 3410. This is where the auditor has to give an assurance on greenhouse gas statements, which many companies disclose. Companies disclose greenhouse gas as a, all that information. On that again, assurance report. For that, 3410 standard is applicable. Clear? Next, now what are the 9 principles of BRSR? Now first, before that, business sustainability and business responsibility and sustainability report. This report is broadly divided into 3 parts: section A, section B, section C. Section A contains the information about the company profile, like is it a listed company information, what products they deal with, what are their operations, how many employees they have, what are the holding subsidiary, associate, all that. Section B talks about what are the policies, what are the management processes, all that they will talk about, code of conduct, all that. Section C, principle wise performance disclosures. Okay, 9 principles we have. Each principle wise we need to give so many disclosures, and these disclosures are broadly categorized into 2 parts: essential indicators and leadership indicators. Essential indicators are mandatory, leadership indicators are optional. Essential indicators like training programs conducted, environmental data like energy consumption, emissions, water, waste management, all that. And leadership indicator like life cycle assessment, conflict management policy details, like what are the company plans on biodiversity, energy consumption, supply chain, all that. These are all leadership indicators are optional, essential indicators are compulsory. These all are called as key performance indicators. They are all called as key performance indicators in the domain of sustainability. That's it. Now what are the principles of BRSR? Now here we have certain principles which is very easy for us, like principle number 3, it directly talks about employees. Principle number 6, it talks about environment. And principle number 9, it talks about consumers. So these 3 principles very easy to remember. Okay, principle number 9 is regarding consumer, principle number 6 is regarding environment, and principle number 3 is regarding employees. Okay, now principle number 1, where it mainly talks about ethics, transparency, accountability, governance. Business decisions should be transparent, and the companies must develop their policies and procedures and performance related to ethics. That's why you open and see BRSR, they will give you code of conduct links. Many companies will have code of conduct, and those documents and all will be there on the company official website. BRSR report, if you see, you will just click that link, you will identify code of conduct. Encourage value chain partners also to adopt ethical practices. Avoid engagement with non-compliant entities, so violating suppliers, all that. Then safe and sustainable goods and services. Design sustainable products with minimum resource usage. Educate consumers about rights and responsible consumption. Promote, reduce, reuse, recycle the resources. Principle number 3, it mainly talks about employee well-being, where regulatory compliance must be there, respect employee rights, child labor you have to prevent, ensure work-life balance of employees, and ensure timely payment of wages, and promote skill development, training, and harassment-free workplace, safe, hygienic, and comfortable workplace. These are all various innovations, various initiatives which a company has to take with respect to employees. Then principle number 4, stakeholders interest and responsiveness. Principle number 4 is mainly talking about stakeholders as a whole. Transparently communicate your business decisions and what is their impact on stakeholders. Identify and engage with relevant interested parties. Ensure fair benefit distribution. And principle number 5, this talks about human rights, okay, which is nothing but a social element. Understand human right laws, integrate human rights into corporate policies, protect human rights for employees, all that. Human rights means it's general, okay, social aspect. Principle number 6, it is again dealing with environmental element. Assess and rectify environmental impact throughout the product life cycle. Optimize resource utilization. The company has to optimize resource utilization. Measure performance in pollution control, how the waste is being managed, how the energy is used efficiently, all that. Support climate change resilience, which is in line with the Paris Agreement and national climate plans. And adopt industry best practices for reduce, reuse, and recycle strategy. You see, this is there even in the principle number 2. This is there in principle number 2 also. If at all in exam you got a doubt which principle answer to write both the principle answers, no problem. Whatever is relevant, the examiner will pick up. Understand? He will only see what points you wrote right, and that only he'll put mark. Extra answer if you write, he will not know that it's extra answer. He feels that it is, he don't know. That's it. Next. Then influence on public and regulatory policy. Like when a company is making when a company is developing policy, they must involve various associations, trade associations, all that. When they're developing policies, leverage trade associations and industry group for policy formulation. When a company is making a policy, involve all the sectors which are being involved in the value chain. Promote fair competition, prevent human right violations. Business should engage in policy advocacy while aligning with BRSR principle. And 8, inclusive growth and equitable development. Identify and address social, cultural, economic impacts of business activity. Track and mitigate adverse business impact. Align CSR activities. Ensure fair compensation in case of displacement of tribal areas to another place, all that. And respect and equitably share intellectual property and traditional knowledge. Principle number 9, consumers. Value to the consumers in a responsible manner. Fair competition. Transparently disclose adverse effects of the product. Maintain customer data privacy. Educate customers on safe product usage, disposal, overconsumption. Avoid misleading advertisement. Provide a grievance redressal mechanism for consumers. Ensure universal access to essential goods and services in a non-discriminatory manner. That's it. These are all talking about principle. These are all talking about adding value to the consumer in a responsible manner. That's it. Totally 9 principles. Okay, there is only one way to remember them, by repeating multiple times. There is no shortcut here. Okay, at least if at all they gave environment all at one place, social all at one place, like if the environment, social, and then we have governance all at one place, if they give also, at least we can easily remember. It was scattered. Okay, suppose you say principle number 1 talks about governance, principle number 2 talks about environment, again principle number 3 talks about employees, means probably you can say social aspect. Okay, social aspect. You see, GES, governance, environment, and social aspect. Again principle number 4 again starts with governance, again this talks with social, again the third, again next it comes with environment, the later again governance, social, and again governance. You observe, okay, there is some pattern you can establish like this. Okay, first one is talking about governance, second one is talking about environment, third one is talking about social aspect, which is employee related social aspect. Again fourth principle is talking about governance. So first one is talking about governance, fourth one is talking about governance, and seventh one is also talking about governance. Whenever we are talking about governance, it's all about policy making, policy formulations, all that. Governance means higher, top level, hierarchical decision making, that one. And social means what? It is all about people. Yes or no? Social means it's all about people. Actually here consumers is there, right? Here instead of using the word governance, you can take it as social, technically speaking, because consumers is more consumer. When you're thinking about consumer, valuation to consumer means it's about social aspect. I think we can take it as a social aspect rather than a governance aspect. Okay, so this can be taken as a social aspect. So 7, 8, 9, 1, 2, 3, 4, 5, 6, and 7, 8, 9. So governance, social is repeated here. Environment is only discussed twice. Understood? Some sort of mapping you should establish. Okay, there is no one concrete mapping will work. Okay, for everybody, for some no, it is principle 8 is easy for them, principle 9 is easy for them, for somebody principle 1, 2, 3 is easy for them. So you have to figure out some pattern that is suitable for you to remember all these principles and matter inside that. Understood? Next, methodology for BRSR assurance. What is a methodology? Like how should I give assurance on business responsibility? First I will preliminary review ESG report and what are the parameters which a company is giving. Then I will go for on-site assessment and I verify ESG report. Then I issue assessment report and assessment statement. Then I review response of the management and clarification on various issues which I have. Submission of the findings of the on-site assessment and document, draft, nothing but. Then finally I will prepare an assessment or verification report including factual results, and I will also give recommendations. Then social audit standards. Social audit standards. What is social audit standards? They talk about these standards provide guidance to social auditors while conducting independent impact assessment of social enterprises operating in various sectors. These standards outlines audit steps and procedures for conducting social impact assessment. Social audit, the standard minimum requirement. This defines minimum requirement that must be followed in social impact assessment. Laws and regulations may impose additional requirements. What is the role of auditor in social audit? I mean, what is the role of auditor generally in entire this BRSR, social audit, environment, everything? Primary role is reasonable assurance whether financials are free from MMS and ensure that the financials are fairly presented. And in the process of doing audit, the auditor may also consider climate related risks. While understanding the entity, auditor should also assess climate related risk and what is their relevance to audit. Climate related risks are more significant in the following industries like banking and insurance, energy and transportation, materials and buildings, agriculture, food and forestry. In all these cases, climate related risk study is most important. Then emphasis of matter paragraph for climate related disclosure. In some cases, an emphasis of matter paragraph may be required to highlight fundamental climate related disclosures in financial statements. Within the financial statements, some climate related disclosures are going to come very soon. Okay, now the auditor must ensure the entity has properly disclosed climate related information under applicable framework. I think you have any Indias for climate related disclosures? You have any Indias for that? I think there is a proposal on that to include climate related disclosures as part of financial statements. Reviewing other public disclosures for consistency. The auditor must compare financials with other public information, nothing but other information like management reports, press releases, investor reports, and this is also requirement as per 720. That's it. Whatever I have covered, that alone you read in exam point of view, sufficient. That's it. SDG is completed. Okay, remaining entire content you can confidently leave. You don't have to touch. Technically in SDG, there is nothing to explain. Yes or no? Conserve, conserve energy. What should I explain in that? Yes or no? Waste management treatment. What should I explain in that? All are correct. You need to treat. Companies have to. Companies have to ensure that fair competition is there. What I can explain in that? Understand? I need to pick up all strategic management examples and explain. Next. So with this, SDG and ESG is covered.